Happy Monday and welcome to all you watching online and on Fios One News. I'm Brian Sozzi. This is the first trade for October 14th. Deal or no deal, China reportedly wants more talks even as President Trump hypes a partial truce in his bruising trade war. We'll dive into what you need to know about the latest fast-changing trade developments. And making history and helping the poor. For just the second time, a woman is awarded the Nobel Prize in Economics alongside two colleagues trying to fight global poverty. What their research has done to transform the field. And building a tasty future, I sat down with Wendy's CEO to discuss their big expansion plans and why breakfast could be key to selling more burgers and Frosties. Let's hit those futures here ahead of the opening bell. Some red on the screen. Dow futures are down 78 points. The S&P 500 and NASDAQ are also in the red, despite what appears to be a break in the trade war. We'll dig into the markets more even shortly, but first, today's big story. China wants to iron out more details before signing a Phase 1 trade deal. That's according to Bloomberg. But President Trump says the deal is already in high gear. Last night he tweeted, "My deal with China is that they will immediately start buying very large quantities of our agricultural product, not wait until the deal is signed over the next 3 to 4 weeks. They have already started. Likewise, financial services and other deal aspects start preparing. I agree not to increase tariffs from 25% to 30% on October 15th. They will remain at 25%. The relationship with China is very good. We will finish out the large Phase 1 part of the deal, then head directly into Phase 2. The Phase 1 deal can be finalized, signed soon." Yahoo Finance's editor-in-chief Andy Serwer is here with more. Andy, we see some pressure in the early going in the markets here. Why wouldn't the market like this news?
Well, first of all, there's a lot to talk about just even with regard to the president's tweet there, Brian. I think what happened over the weekend is a lot of people realize that maybe there's no beef there when it comes to this Phase 1 deal. I mean, first of all, Phase 1 of how many phases? Second of all, the deal's not signed. Then also over the weekend, China Daily, which is the state-owned media, says, "Keep the champagne on ice," end quote. And now we're hearing from Bloomberg, which has done very good reporting on this story, that the Chinese want to negotiate further and maybe actually change some of the details before anything is signed, even to the Phase 1, Brian.
A lot of people on Wall Street seem to be fixated that no tariffs were removed in this Phase 1 deal.
Yeah, I mean, and that's an excellent point. And getting back to the president's tweet, just sort of taking it line by line, how much product have they bought in terms of soybeans? I think that's what he's mostly referring to, agricultural product. When did they start buying? When will they start buying more? What tariffs get removed? When? Why? At what point? I mean, there's so many questions and so many things not answered at this point.
Is this the president just playing to his base? He sees the poll numbers slipping a little bit. He sees farmers out there struggling. Is that what this is all about?
I think you're onto something here. I mean, obviously, some of these states, particularly let's just take Wisconsin, which everyone knows is a critical state, and the farmers there are not happy right now because of the trade war. So to get any sort of relief there for them would be critical, frankly, when it comes to being reelected. And, you could say the president is playing politics. Well, to be fair, all presidents play politics. However, this is a bit of a self-inflicted wound when it comes to the trade war. So in other words, you create a mess and then you become the hero fixing it. You could kind of raise a cynical eye when it comes to that kind of thing.
And you're always talking to these big name CEOs. Do you think this is the type of announcement where they will say, hey, you know what? We appreciate the certainty. We're going to unleash our capital investment after probably not spending much coming up to this point?
No, I don't. And I think the bigger trend is not your friend right now because of the trade war, number one, but also because you're seeing just sort of a bigger decoupling. And we've talked about this before, Brian, but I don't think we're ever going back to where we were before. It would be great to sort of have a trade agreement in the books, but then you have to think, what's the bigger picture going forward for the next 5 to 10 years? And that's sort of the timetable that CEOs look at.
Andy Serwer, thank you.
Thanks, Brian.
Let's get Isaac Boltanski into the mix here. He's Director of Policy Research at Compass Point. Isaac, always good to see you. What is your first instinct off of this trade deal news?
Yeah, good morning. Look, I think that it's a step in the right direction, but it should be viewed as more of a goodwill gesture than a substantive step forward. I think that there is still too much unknown, and I think that the biggest news story that we've seen over the past weekend has been the Bloomberg report that you cited, as well as the characterization of this agreement by Chinese state media, which is something that my clients are talking about this morning, where they're not even calling it a deal, and there's definitely a tepid response there, and so that's the focus this morning.
Isaac, you wrote in your note, I believe this morning, that a lot of complications continue to exist. What are some of those complications?
Yeah, look, what they're talking about here is just picking the lowest hanging fruit, things that they've agreed to discuss or address over the past few months. And so the real complications and the things that I think the market is going to focus on is how do you actually create a sustainable and viable path to removing the existing tariffs? What's the enforcement mechanism that we are going to have that governs this document? And how do we handle some of the persistent issues like state subsidies and forced technology transfers? So really what we talked about, what the president is talking about there in the tweet, that was the easy part. And it's not even sure if we can get the easy part done. It's the more complicated, the more structural, the thornier issues that I think will take years, if not decades, to actually work through.
Isaac, it sounds as though, just listening to you, we're nowhere near phase 3 of a trade deal here.
Look, my view and what I'm advising clients is I think that we have at least, for the time being, stopped the retaliatory spiraling that we've seen throughout the course of 2019. So I am confident that we will not see the December 15 tariff come into play, largely because about 2/3 of those tariffs impact consumer goods like laptops and computers and video games and smartwatches. So I feel confident that that's not going to happen. I truly believe that the president wants these agricultural purchases for both political and practical reasons. But your previous guest, I think, hit the nail on the head. We are going to fundamentally change our relationship with China. And that's going to be something, this decoupling, that I think is a foundational theme over the next few years and probably our entire lifetimes.
If this is, in fact, this phase 1 trade deal, which is not even signed, which appears to be a dud, shouldn't markets have to adjust? You know, we saw markets trade up favorably into this event. Why shouldn't they sell off now?
Look, I think that most of the clients that at least I've spoken to have had, if they are optimistic, it's cautious optimism, and I think that they will continue with that view. I don't think anyone was changing their overall investment strategy based on what we learned on Friday. I think that appropriate caution should be heeded here. I think that we will have to watch every headline, as we've done over the past few years, to see where the president's mood is at any given moment. And I think we're also going to have to watch closely how any of these talks are portrayed in Chinese state media, because it's not just our political system that has a pressure dynamic. There's also one in China, and that's both the political and the economic realities there, and how that impacts President Xi.
Restricting capital flows, is that still on the table?
Yeah, look, everything's on the table, but I don't see any near-term risk regarding restriction of capital flows. There are a couple bills that I think are worth discussing that would effectively try to increase the auditing of Chinese state firms that I think Congress is going to work on in the coming weeks. But the big ticket items that you've heard in the press, it doesn't seem likely that those are going to be deployed anytime soon.
Isaac Boltanski, always great insight. Thank you. During Yahoo Finance All Markets Summit, our Julio Roche sat down with Blackstone CEO Stephen Schwarzman, and he explained how the U.S. has been approaching trade talks with China.
Fundamentally, we're asking the Chinese to change their system. Their system was brilliantly designed as an emerging market, developing market economy, so that much like the Americans in the 19th century, people forget we had very high tariffs. We were a small country. We had, the ability to protect, our nascent industries. And China just started doing this 40 years ago, and they've had an astonishing result. 40 years ago, they had GDP per capita of a few $100s, and now it's $10,000, and it's going up at $1,000 a year. So China has done some remarkable things, but they've done it in ways that are inconsistent with the developed world.
Schwarzman went on to say that if someone is looking for a full solution to the differences in the U.S.-China trade conflict, it's not going to happen. Now let's head down to the New York Stock Exchange and check in with Yahoo Finance's Inez Ferre. Inez?
Yeah, Brian, futures are pointing on lower right now. There's a couple of stocks which we're watching. One of them included Nike. Nike has been upgraded at Bank of America Merrill Lynch to neutral from underperform with a price target of $98. The analyst note there highlights the accelerated democratization of the world's largest sports brand. We're also today watching Beyond Meat. Beyond Meat, most of last week was a little bit under pressure. It's been initiated at Wells Fargo with a market performer rating and a price target of $125. That's below what it's trading right now. And the analyst note recommends waiting for more visibility on other entrants and also market adoption before buying the stock. Meanwhile, we're also today watching Hexo Group. This is after it was downgraded to neutral at Seaport Global. This is the third session in a row in which Hexo Group would be under pressure. Last week, Hexo issued a surprise revenue warning. That put pressure on other cannabis stocks last week, and also Jefferies on Friday slashed its price target on several cannabis stocks. So you're looking at the cannabis sector that's been under pressure. Brian.
Thanks so much, Inez. Now let's take a look at what's moving European markets. Yahoo Finance's Oscar Williams-Groot joins us now from London. You're seeing markets under pressure overseas a bit, but Oscar, Brexit talks have evaporated over the weekend as talks have progressed. Take us through it.
Brian, Brexit is always a roller coaster, and the last few days have been no different. On Friday, both sides said they could see a pathway to a deal, but things have soured significantly over the weekend. The Financial Times reported last night that the EU was left baffled by Britain's complex proposals after 2 days of negotiations. And Michel Barnier, the EU's chief negotiator, has apparently told ambassadors that there is a big gap that is still left to overcome between the two sides. As a result, we've seen a big sell-off in UK assets today. The pound has been down almost 1% earlier in trade against both the euro and the dollar. And the FTSE 250, which is the measure below the FTSE 100, and often seen as a more accurate barometer of the UK economy, that opened down 1.2% today, giving you a sense of how things have really taken a nosedive over the last few days.
And Oscar, in other news, I understand the Queen visited Parliament today to open a new session of Parliament. Bring us up to speed.
That's right. She delivered what's known as the Queen's Speech, which sets out what the government seeks to achieve in the next session of Parliament. Now, it did set out plans for a points-based immigration system after Brexit, but largely this was about what Boris Johnson hopes to achieve once Brexit is done and dusted. A lot of it was around law and order. He talked about tougher sentencing for criminals and harsher penalties for foreign nationals who avoid deportation orders. We also got news today that November 6th will see the first budget after Brexit. That is, if we can get out by the October 31st deadline.
Oscar Williams-Groot, thank you. And here are your news bites for this morning. President Trump is warning that, quote, big sanctions are coming as Turkish fighters push deeper into Syria. Explosions could be seen along the border this morning in one area that Turkish troops have seized. President Trump this weekend ordered a full withdrawal of U.S. troops there days after giving Turkey the green light for an offensive in the region. Some Kurdish fighters who had been aligned with the U.S. are now partnering with Russia and the Syrian government. The U.S. is reportedly moving forward to restart Taliban peace talks. The U.S. envoy for Afghanistan reconciliation, Zalmay Khalilzad, has held meetings with representatives of the Afghan Taliban to discuss confidence-building measures in order to reach a peace agreement. President Trump has signaled his desire to end the 18-year war, which he called, quote, the single greatest mistake our country made. Hunter Biden is stepping down from his position at a Chinese private equity firm. Former vice president's son says he will not serve on any foreign board should his father, Joe Biden, get elected president in 2020. That comes after President Trump asked Ukraine's leader to investigate Hunter Biden's work in the country while his father was vice president. And Simone Biles is now the most decorated gymnast in World Championship history. After winning her 24th gold medal on the balance beam at the World Championships yesterday, she added to her tally with another gold on the floor, bringing her grand total to 25. Biles shattered the previous record, which had stood since 1996, and now has more gold medals than she has birthdays. Go Simone Biles. Coming up here on the first trade, it's the 5th week UAW slammed the brakes on GM, but is the UAW in the driver's seat or in the slow lane? Also, the Nobel Prize for Economics has been awarded. We'll break down how the winners impacted the field. But taking a look at the futures here, futures have been in the red pretty much all morning long. Dow futures down 62 points. The S&P 500 and NASDAQ also in the red. We'll be right back. Welcome back to the first trade. Taking another look at the futures here ahead of the opening bell. Red across the screen. Dow futures down 61 points. The S&P 500 and NASDAQ are also in the red. The United Auto Workers are taking aim at another big name as the strike against GM enters its 5th week. More than 3,600 hourly workers at Mack plants in Florida, Maryland, and Pennsylvania went out on strike over the weekend. They say they want better pay and benefits. With us now is auto analyst Rebecca Lindland of RebeccaDrives.com. Rebecca, always good to see you here. The UAW is feeling pretty energized here. Unpack this for us. What is driving some of that?
So it's important first of all, for consumers to realize that this isn't about truckers. This is about people that are making the Mack trucks. So it's basically the same union. It's the UAW, United Auto Workers, and the Mack truck people are saying we're not happy with so many of the same issues that the UAW workers are facing in Detroit and around the country. And they include healthcare, overtime, basic pay wages, and a share of the profits. That's one of the things here that we have to realize is, well into this recovery in the economy, these companies are doing really well profit-wise, and the workers are saying we want our share.
Rebecca, this is turning into a real stalemate. First at GM, now at Mack Trucks. Who has to blink first?
Well, it's really, first of all, as we've said before when we've talked about this, nobody really wins in a strike. So the sooner we can get these things resolved, the better. But again, it's important to note that any agreement is going to last, especially in Detroit, it's going to last for 4 years. And there's so many changes that are going on in the industry right now that by 2023, we could be looking at a very different face of mobility and the products that these workers make. So I think in terms of who needs to blink first, I don't think we can't go into this with a stalemate. We have to go into this with the idea that both parties will compromise and both parties will win if we can get this strike over with.
Rebecca, I'm somewhat surprised that GM stock hasn't completely fallen over the cliff over the past month as this has continued. How financially painful is this costing, or is this turning out to be for GM?
You know, Brian, it's incredibly expensive. I think the hope is that they'll be able to recover some of the costs, probably not in 2019, which we're going to definitely see the impact on the stock, but certainly in early 2020. The other thing, too, is that it's actually a testament to the resiliency of the GM stock and to the performance of the company. And again, because if we're looking at profit sharing and such, it's better for everybody if this thing ends quickly and doesn't start chipping even further into GM profits, because then it could impact bonuses and pay for everybody.
Rebecca, we had some news, switching gears slightly, over the weekend that Volkswagen is reportedly looking to sell or spin off or divest Lamborghini. Now, Lamborghini pretty much has been on fire for the first half. So what does the valuation on a company look like
So this is something
right now?
Yeah, so this is something that's interesting because Volkswagen, first of all, is this incredible conglomerate with all these different brands. You go to Autostadt in Wolfsburg, and that's when you start to realize that, wow, they've got Bugatti here, they've got Porsche here, they've got Lamborghini. And as you say, Lambo has really been on fire because of the incredible success of their Lamborghini Urus SUV. And so, this vehicle is just stunning to look at. It's absolutely compelling to drive. And it's really opened up a whole new set of buyers for the brand. So what I think that Volkswagen is looking at is saying, look, we have to go heavy into electrification, and that is going to involve billions and billions of dollars in investment. So how can we raise that kind of money? And I think they're also copying what Fiat Chrysler did with selling off Ferrari. And of course, the Ferrari IPO has been incredibly successful. So they're really looking at how do they raise money? What do they have in their tool chest to do that? And certainly a brand like Lamborghini, who's doing really well, is one of those things that could be up for sale. They continue to deny it, so we'll have to watch it.
All right, Rebecca, tweet me a photo of your Lamborghini. Always good to see you, Rebecca Lindland. Thank you.
Likewise.
Stay with us. Wi-Fi AM is coming up at the top of the hour on yahoofinance.com and our app. They'll be talking about Medicare for all and why Democratic presidential candidate Pete Buttigieg is also against it. The opening bell is coming up next here on The First Trade. Let's get a quick look at the futures here, though. Dow futures down 62 points. The S&P 500, NASDAQ are also slightly in the red. And here's what's up in overseas markets before we head to break. Welcome back to the first trade. The opening bell is just a few minutes away. The futures have been in the red all morning long. Dow futures down 62 points. The S&P 500 and NASDAQ are also in the red. Now let's go around the bell with John McClain, portfolio manager at Diamond Hill Capital Management. Matt Maley, chief market strategist at Miller Tabak and Company is here. And so is Yahoo Finance's Scott Gamm, who's manning the Wi-Fi Interactive Board. Good morning to you, gents. John, let me start with you because you had an interesting note out. You actually say the base case should be a further escalation in the trade war. Obviously, we did get some, what appears to be some positive trade news on Friday, but I'm interested in your base case and why you have it.
Well, did we really get any positive news? I think the market's giving you the collective sigh again here of the classic, again, he said, she said, where the U.S. is touting a amazing phase one global trade deal. And China's saying, wait a second here, we will come to the table to negotiate, but there's nothing that has been inked. The ink isn't dry. So, again, we really haven't seen anything. And what you're seeing now is equity markets, pulling back a little bit from the euphoria that we saw initially on Friday. And global rates also rallying pretty hard here.
And Matt, what's your take on the trade news?
Yeah, I agree a lot with what John has said. Is that really, even if we get this deal, and I do think that they'll ink what they've agreed to now, because the downside is very, very would be big if the thing fell apart and the new tariffs were imposed. It would, we know how sensitive the President Trump is to the stock market, but also would be negative longer term for the economy, both here and in China. So I think we get something like that. But even then, this deal is really not much of a deal. It's as small as they could have gotten and still call it a deal. And many people are just calling it a truce, and that's not really a deal. So longer term, this issue is going to be with us for a very long time. And as John said, yes, we got this little bounce, and we deserve to, because it was much better than getting the whole thing falling apart. But how much upside can we really have when this issue really isn't going to go away? It's a short-term kind of patchwork deal. The longer-term issues are still with us. And let's face it, China kind of got what it wanted. They just gave away buying us some agricultural prices, but they also didn't get the existing tariffs taken off. So neither side really won a lot here.
John, you've been on with us recently, and I believe you called for a fourth quarter market correction. Is that call still in place off of this trade news?
Yeah, it is, because again, what we see here, China wanting to buy agricultural goods, well, it's really in relation to the African swine fever and the fact that they've lost 40% of their hog stock, and hog prices are up 84% year over year at this point. So, I think that they want to get something done in terms of purchasing agricultural goods. But again, what we're seeing, global macro data slowing down. We're going into bank earnings season, so we'll see what the large money centers have to say here. But on a micro level, company by company, what we've been seeing is that the trade war is really having an impact on, the bottom line for businesses. So I do believe that valuations are going to come back to a more normalized type of level and come back to reality.
Scott, over to you at the Wi-Fi Interactive Board.
Well, look, Brian, obviously we saw a big gain in the market on Friday on the heels of that trade optimism, but I don't think you can declare that investors are no longer hopeful about trade just because U.S. stock futures are down. Just 0.2%, that's not enough to really gauge what investors are feeling right now, and those numbers could easily reverse soon after the market opens. I'll also say that you're seeing a lot of optimism across Asia, with stocks there up over 1% across the board.
Yeah, Scott, you are seeing some of that optimism overseas, but certainly not seeing it in the futures coming into the session. But there you have the opening bell on Wall Street for this Monday. Anaplan, we had that CEO on before. Good to see them up there. And stocks are looking to open slightly in the red, despite that news we got on trade on Friday. Matt, let me get back to you. Do you think we're still set up for a fourth quarter correction in the markets? I see a lot of consumer stocks starting to do well. What's the setup here?
I don't think it's all that good. The problem we have is this whole trade issue has been the number one focus for a while. Now, of course, the trade issue will, as I said, will continue to be a focus. But now people are going to go back to other issues, and earnings, of course, is going to be at the top of that list. Earnings season is just getting started, and look at what situation we have now. we of course will beat expectations for the third quarter earnings. We always do. They lower them enough so that the the actual numbers are beaten. But the key thing is that guidance has been coming down all year long. I mean, right now, assuming guidance will probably go down for the fourth quarter, but even if it doesn't, we're looking for a growth of just over 1% on the S&P 500. That compares to an 80% rally in the S&P. That just doesn't compute. I mean, people are correct when they say, hey, if we get an earnings recession, it doesn't necessarily mean we'll get a bear market. But the last time we had an earnings recession in 2015, the stock market was flat, but also had a 12% correction in the middle of it, but flat. Okay, but now we've got an S&P that's up 18%, and we're down with almost flat earnings growth. It just doesn't compute, and I think that we're probably going to have to see some weakness in the fourth quarter.
John, what gets you more upbeat on the markets?
Pardon me?
What gets you more upbeat on the markets as we round the corner to 2020?
Yeah, I mean, again, it's all about trade. I think what we've seen now is quantitative easing is not the right medicine for the market. We need to eliminate a lot of the uncertainty that's around trade. So if we get a real deal in place that's beneficial for both sides, that would get me much more constructive on the overall market.
Matt, beyond trade, what are you looking for in bank earnings? By all intents and purposes, the investment banks can be under severe pressure just because we've seen pretty much IPOs fall off the map in the third quarter.
Well, as much as we would like it not to be the case because we want to look at the fundamentals, and many people like to say, the banks look very cheap here, and they have. But the thing is, they have been for quite a while now.
Pretty much since 2009, right?
Excuse me?
Pretty much since 2009, right?
Exactly. And so we have a situation where if interest rates move higher, that's what's going to get it. If the yield curve has now gone back into positive territory for both the 2-year 10-year spread and the 3-month 10-year spread, that's helpful. And interest rates have moved up off their lows. The question is, how much higher are they going to go? If the yield curve can indeed start to steepen considerably, and if interest rates can move higher, that's going to definitely be bullish for the bank stocks and help them finally outperform. The question is whether that can really happen given the slowdown in global growth.
Scott, over to you at the Wi-Fi Interactive board.
Well, I've got my heat map up of the 30 components within the Dow Jones Industrial Average, and you guys were just talking about the banks. The two financial components in the Dow, Goldman Sachs down slightly, JP Morgan wavering in and out of positive and negative territory. We also want to point out Apple shares, which are down slightly but still holding up rather well. Remember, Apple hit a record high just this past Friday on trade optimism. We know Apple is one of those trade-sensitive stocks. It's also worth more than $1 trillion. Microsoft as well has a market cap over $1 trillion. That stock up about 0.5% right now.
Matt, what do you make on the semiconductors coming into earnings season? I know you follow the space very closely.
Yeah, I mean, this has been a group that's been a key leadership group for the market it's been for a long, long time. But in the last year or two, it's been particularly important because it topped out a couple of months before the rest of the market did in 2018, and then it led the market higher into the first half of 2019. Now it's bumping up back up against its all-time highs. The thing is, it's been able to make new highs or slight new highs a couple of times, but much like the broad stock market, it hasn't been able to hold them. And with this trade war, I believe still going to be with us, whether we get a mini deal or not. It's going to be hard for these stocks to really take off. However, if they do, it's something I'm going to have to turn more constructive on the stock market, at least for the fourth quarter, if we get a real, genuine, meaningful breakout, not just one that's a percent or so, because it has been a key leadership group, and the way these algos trade the markets nowadays, it will be a positive development. So that's one thing we're really got to watch if I'm wrong about the fourth quarter.
Matt, Scott briefly mentioned Apple continued to trade pretty well. You think the stock's overbought here?
Well, yes, it's overbought, but on a short-term basis. I mean, it's the stock. You can have the greatest bull market in history in any individual stock, and it's going to have pullbacks over time. Short-term pullbacks from here and there. The one thing about Apple has in its favor is that a lot of these big cap tech names have this shadow that's going to be or headwind that they've got to face of further regulation. It's an election year. It's a bipartisan issue. These Facebook and Google and some of these others have to face. Amazon Amazon's another one. Apple doesn't have that. Tim Cook has got a nice relationship with the president. They generate a lot of cash, and they have not been involved in looking over people's shoulders the way some of these other companies have. So if you're looking at big tech and you still feel you need to have a certain amount of weighting there, you're going to be more on Apple than you are on other things. So yes, it's overbought, could pull back, but I don't see it as a major problem compared to some of these other names.
And John, briefly, I want to touch on the Federal Reserve. You actually write, monetary policy can't fix nationalism and protectionism. What made you come out with that comment?
Yeah, I mean, again, right, what we've seen is quantitative easing worked the first go around, and now really we're starting to see the diluted impact of QE here. Rates have been low for a very long time, and that hasn't spurred organic CapEx. And, you look at, again, these businesses have been spending kind of the better part of the last year, global businesses diversifying their supply chains away from China. So what we're saying here is that the protectionism, the nationalism that we're seeing across the globe is bad for risk assets, and QE can't really fix that. Rates have been low for a long time. It hasn't spurred the consumer to spend, and it's not spurring businesses to invest.
John, hasn't the Fed put itself in a very difficult position here? They have to come out pretty much later this month and lower rates again. If not, this market's going right in the tank.
Well, yeah, I mean, I think right now expectations about 75% that they cut at the end of October, and that's probably the only cut that we see for the rest of the year. But I don't think the Fed's really put themselves in this position. It's policymakers that have put the Fed in this position. The Fed is kind of the residual outcome of the discussions with trade.
That's a good chat, guys. Happy Monday. Enjoy the week. Matt Maley, John McClain, and Scott Gamm. Thank you. Yahoo Finance's Inez Ferre is standing by now for us at the New York Stock Exchange. Inez?
Hi, Brian. We're looking at the Dow. That's off about 40 points right now. You're looking at energy stocks, which are a little bit under pressure this morning. We're watching CrowdStrike under pressure for the second session in a row. This is after another bearish note. This one is from Citi, with Citi initiating CrowdStrike with a sell rating and a price target of $43. The analyst note says that their trajectory is impressive, but the market opportunity just doesn't enable a sustaining of this growth. On Friday, CrowdStrike got a bearish note from Goldman Sachs, with Goldman Sachs cutting their rating on the stock to sell from neutral. We're also watching Planet Fitness seeing a little bit of a pop, up more than 2% after Imperial Capital upgraded Planet Fitness to outperform from inline, with the analyst note saying that Planet Fitness is a premium consumer growth stock. And then we're also watching AECOM up almost 7%. This is after the company agreed to sell its management services business to a consortium of private equity firms for $2.4 million. Now, that had been that spinoff had been announced previously in June. The terms of the deal just announced, and this will reduce their debt and also help with stock buybacks. Now, apart from, of course, any headlines related to trade, traders here are telling me that they will also be looking, of course, at the bank earnings this week and those retail numbers, which will be coming out this week as well, Brian.
All right, thanks so much, Inez.
Thank you.
SoftBank has put together a plan for WeWork that gives it full control and further pushes out founder Adam Neumann. Yahoo Finance's Emily McCormick is in our newsroom with the details. Emily?
Well, SoftBank may be to the rescue for the struggling We company. The company is reportedly looking at a new package of debt and equity that would help the We company get out of some of its dire straits with some of these cash burn issues and net losses it's been posting over the past couple of years. It's not clear exactly what that breakdown would be in terms of debt and equity, or what that timeline would be to deploy this package. But SoftBank executives do reportedly think WeWork would need up to $3 billion to get it through the next year. This would also give SoftBank majority control of the We company. This Japanese conglomerate already has about a 30% stake in the company. Remember that at the beginning of the year, SoftBank had declined to take a majority stake after making its latest equity investment in the company. So this new package would reportedly have SoftBank pay a lower price per share than it did earlier this year with that equity investment. It would potentially also value the company at less than $10 billion. So we're really seeing that valuation start to slide for the We company. Had fetched as much as $47 billion, and now we're seeing it at even lower than the amount of equity it's raised. It has raised more than $10 billion from venture capitalists. Brian?
And Emily, SoftBank is not the only company here potentially offering money. JP Morgan in the mix too, right?
That's right. So with the JP Morgan package, this would reportedly be for debt financing. So this would potentially be a little less dilutive to the management and executives already in place. Again, this is something that's just in early stages. According to Bloomberg, the bank is said to be in the middle of meetings with investors about participating in a multi-billion-dollar debt deal. Again, all of this is a fluid situation. So this is something that could materialize. It could be the SoftBank deal. We'll have to see how this plays out.
And Emily, what happens to Adam Newman here? Now he got pushed into that chairman position. What's the likelihood that he just gets the boot overall?
Well, he will be seeing a loss of control in the company. This is something we've seen continue over the course of the We Company debacle. Remember in that original S1 prospectus, he'd had 20 votes per share with his super voting rights. That was then scaled back to 10 votes per share. And then when he was ousted as CEO, reportedly had actually voted for himself to step down as well. That was then scaled back again to 3 votes per share. This would see him lose even more control over the company that he built. Brian?
Emily McCormick, thank you. Oil is sliding after seeing its biggest gain in months on Friday. Yahoo Finance's Scott Gamm is back with us at the Wi-Fi Interactive Board with today's commodities report. Scott?
Hey there, Brian. Well, I want to take a look at a week chart of oil because oil had a nice run over the past week, rising about 3%. And a lot of that gain came on Friday when the U.S. and China sort of agreed to that Phase 1 trade deal. But today, the oil trade is unraveling a little bit. Oil prices are down about 2.3%, at least for West Texas Intermediate. That's the U.S. benchmark for crude. And we're seeing the optimism surrounding trade fade a little bit just on the heels of some of those reports that China is looking for additional talks before it signs Phase 1 of that trade deal. So right now, you're seeing oil prices fall below $54 a barrel. That is a significant level that it had held at for quite some time.
And Scott, talk more broadly about how sensitive oil is to trade headlines, and what's the reality that oil prices could make that next leg lower?
Well, it's a really important point, and for that, I want to take a look at a 6-month chart of oil, because as you mentioned, oil prices are sensitive to trade headlines, just like the trade-sensitive stocks are sensitive to trade headlines. And if you look over the past 6 months, you'll notice that oil has been pretty range-bound, right? It hasn't really done much, and that's because there's been so much trade uncertainty. When you have trade uncertainty, you have investors worry about the global growth outlook. When folks are worried about the global growth outlook, they're worried about oil demand, and that is not a good thing for oil prices.
Some of these oil stocks could sounds as though they could be hit this earnings season.
Well, we'll see what happens. I mean, it is interesting to see over the past couple of months, oil prices and oil stocks don't necessarily always have a strong correlation. We have seen several trading days where oil prices are down, but the stocks are up.
All right, Scott Gamm, thank you. Esther Duflo became the second woman awarded the Nobel Prize for Economics. French-American Duflo earned the honors along with Abhijit Banerjee and Michael Kremer for their work in fighting global poverty. Yahoo Finance's Brian Chung joins us now. Brian, walk us through the research these players did.
Yeah, well, they've been studying global poverty and just methods and techniques that they can use in econometrics to lift them out of poverty. And this is required reading stuff. I know it's because it's required reading for the microeconomics grad class that I took. So it's great to see that they were getting acknowledged for it. But they were really studying, the extremely poor, those that make less than $1 a day. They were identifying what their habits are on food and health in terms of spending. But more importantly, they tested methods to try to get them out of poverty. So one example of a study was testing the impact of fertilizer on crops in Kenya, also remedial education programs using computers in India. And they did all this using randomized control trials, which is an economics term where they basically try to take the same treatment and they identify a control group where they don't do that treatment, and then they put it into an actual treatment group and then see what the difference is to actually measure what the impact of that policy is. So pretty amazing stuff in the economics community, and again, regarded with this Nobel Prize today.
Feels like I just went back into college, Professor Chung. There we go.
Next Yahoo U, maybe.
Yeah, seriously. More broadly, how does this research how will it get used?
Yeah, well, I think the RCT, again, the randomized control trial, is a technique that a lot of economists are saying, we can expand from this. We can use this not only to measure poverty in emerging markets or in kind of depressed countries, but see if we can use this technique to verify whether or not this type of technique would use on econometric policies in advanced economies as well. And I think that's what you're starting to see. This research is only about 10 years old, so there's a lot of places to go with this.
Where does this trio go next?
Yeah, well, I think they continue. I mean, their focus has mostly been in impoverished countries, and they've done a lot of travel to do these types of things. I mean, this is very hands on the ground, kind of getting your boots dirty type of econometrics, where they're going into Kenya, going into India, doing these types of studies and finding out, hey, is education or is a change in technology like fertilizer something that can lift these communities out of poverty? And I think that they continue to do that, maybe in new countries and new areas of the world as well.
This still remains, despite this stellar work, this remains very much a problem, poverty.
Absolutely. And I think that you're starting to see that divergence, that as the advanced economies continue to see even slowing growth, it's the advanced economies that are, or rather the emerging markets and the kind of impoverished countries that are still being left in the dust.
All right, Professor Chung, always good to see you. Appreciate it. It's Monday morning, so let's talk some fast food. I got a chance to go inside the C-suite with Wendy's CEO Todd Penegor, fresh off its big investor day. Penegor had a lot to say about the future of that iconic brand. Most notably, he said, quote, "This is a different Wendy's. You think about having the courage to play, to win. We are really trying to create a compelling, accelerated growth story and then carry that into our brand and our stock." Our resident food expert, Heidi Chung, is with me now. Heidi, yeah, it was a fascinating call with Penegor, who I've known for quite some time. To his point, this is a completely different company, or he's pitching, or he's positioning the company to be completely different. Digital, breakfast, you name it.
And international expansion as well, right? Looking to go into Europe as well as the UK in the next 12 to 18 months. And they already have a presence in Canada right now, and they're looking to expand that as well. But to your point, this is the moment of truth for Wendy's. This is the perfect time to sort of take the company into a new direction, because we are in autumn right now, but looking back on the summer, it was the summer of the chicken sandwich wars, right? And Wendy's was really involved in that, as well as you and I covered. But this is their moment. If they can really execute on this breakfast, which I know you think they can, right?
How hard is it for them, or how hard will it be to get into breakfast? Now, Penegor told me they're keeping things very simple sandwich bills. They're going to add 2 to 3 more workers per restaurant. So simplification is key for them, but there are a lot of other people selling breakfast out there, most only McDonald's with its Egg McMuffin.
And as we know, McDonald's is a huge company that has been a player in breakfast for a really long time, but it's still a very difficult part of the day for them. But as we know, breakfast is the most profitable part of the day, and it's also 20% of all QSR sales here. So I think if they can execute, I think to your point, though, the menu is the key part here, because before, when they tried it in the regional areas, they had 45 SKUs, right? Now they've shrunk that, and it's now about 18 unique SKUs. So if they can really just make sure that the franchisees don't have to add any additional equipment, they can keep hiring to each store.
No equipment, he did say, no equipment.
Right, but a lot of people were worried that they have to hire all these people in an extremely tight labor market, right? But he said, well, if you really break it down, it's only about 3 additional employees per store. Yeah. So if you can bring in 2 people at 5:30, 6:30 in the morning, and they can leave by 10 a.m., 11 a.m., it's something that could work.
Heidi, you're way cooler than me and traveled the world.
Okay, I don't know about that.
Trust me, you are. Traveled the globe. Does Wendy's have a place internationally? You know, Penegor told me by 2024, they see their sales reaching $2 billion, up from $1 billion this year. Do you think Wendy's could succeed in Europe and maybe potentially even China down the road?
It's tough because McDonald's is such a big player in Europe, in Asia as well. So will Wendy's be able to pull it off? I think in the next 12 to 18 months, we have to really pay attention to what kind of menu items they come up with and what kind of digital initiatives they push, because only 2% of their entire business is digital right now. So they have a lot of room to grow here, and if they can execute, I think it could be big.
Well, I'm sure you and I will be trying some of those breakfast items. Heidi Chung,
for sure.
Always good to see you. Coming up here on The First Trade, putting pressure on Apple. What you could expect when Google unveils its latest Pixel smartphone. Taking another quick check of the markets here, the Dow is down slightly, about 18 points. Over at the NASDAQ, also slightly in the red. And last but not least, the S&P 500, also slightly in the red. We'll be right back. Welcome back to the first trade on this Monday morning. The Dow is slightly in the red, down about 19 points. The S&P 500 and Nasdaq also slightly in the red. And here's a rundown of the companies the Yahoo Finance team is watching for you today. There's growing backlash against PG&E in the wake of last week's intentional blackouts in California. A scathing New York Times report showed the utility struggled to communicate with customers and officials as it began shutting off power to prevent wildfires. The CEO is pledging to do a better job going forward, while warning there will likely be more blackouts. Current Boeing CEO Dennis Muilenburg is being removed as chairman and will be replaced by current lead independent director David Calhoun. Until now, the company's board has resisted leadership changes and has shown loyalty to Muilenburg, as the company has been under pressure since April after 2 crashes of its 737 MAX jet aircraft killed 346 people. With the trade war hurting its sales, Deere is reportedly making a big investment in its leasing program. The company has funneled billions of dollars annually to buy its own equipment to make up for slowing demand for new products. That's according to the Wall Street Journal. The move has added to sales of new equipment, but the long-term effects could result in less reliable profits for the company. And it may finally be all over for dying Sears. Another 100 of the 425 stores that Eddie Lampert bought out of bankruptcy are closing, according to the Wall Street Journal. Meanwhile, the remaining stores are missing key products on the shelves as suppliers remain scared to ship to the struggling retailer. A Sears spokesman did not return Yahoo Finance's request for comment on the store closures. And Apple is reportedly launching a more economical answer to iPhone, the iPhone SE2. Prominent Apple analyst Ming-Chi Kuo of TF Securities predicts the price tag will be $399 and it will hit stores in early 2020. Kuo also predicts the iPhone will be equipped with the same processor as the one in the new iPhone 11 series. And that is a look of the companies to watch for Monday, October 14th. Let's stay on the smartphone train. The Google Pixel 4 will be revealed at an event in New York City tomorrow, though analysts and consumers already have a lot of information. Here's what is leaked so far. The Pixel is being upgraded from 1 camera to 2, which is still behind Apple's 3 rear-facing camera setup. It will include a radar chip for more secure facial recognition, and photos are circulating of the phone in new colors. As Apple creates demand with higher resolution cameras and Samsung rolls out its foldable phone, some experts believe that Google is falling behind in the smartphone world. Here to break it all down is our tech editor, Dan Halley. Dan?
Yeah, so basically what we're going to be looking at here is 2 different versions of the Pixel. It's the Pixel 4 and then the Pixel 4 XL. It's similar to how Apple rolls out its iPhone. You have the standard size and then the extra large size for people who like bigger screens. And they're basically going to have the same exact components. The screen on the Pixel XL will be higher resolution, so that's something to look out for. But that doesn't necessarily mean that the Pixel 4 will have a blurry or anything unsightly kind of display. It'll still be a very nice panel. The big thing with these, though, obviously, are the new cameras. That's really something that smartphone makers have been pushing for some time now. They're going from 1 camera to 2 on the backside, and we're expecting to have one be a telephoto lens and the other be a standard wide angle. Now, Google, prior to the release of Apple's iPhone 11, was really the king of smartphone cameras. They made a mode called Night Sight that Apple has picked up on, and what we're expecting here is more software tricks that Google could put into this phone to really kind of step it up and again retake that crown as the best smartphone camera on the market. That's really what people are interested in. They want a good camera, they want a good screen, and they want good battery life. And Google's already delivering on the screen and the battery life. And the camera on this one, if it beats out Apple, they could have a really good product. Now, the problem with the Pixel line, though, is that Google just doesn't sell enough. They're not available in many places outside of the US. They're carrier locked if you don't buy them unlocked online to Verizon. So we're expecting to potentially see a Sprint version as well this time around, and maybe even a T-Mobile version. But really what they have to do is get the word out that this is a product that can compete with the likes of the iPhone and Samsung's offerings. And in truth, they really can.
I'm still not dumping my iPhone. Dan Halley, good to see you. And that's a wrap for the first trade for this Monday morning. I'm Brian Sazi. Now let's get one more check of the markets with Inez Ferre down at the New York Stock Exchange. Inez?
Yeah, Brian, we're looking at a pretty flat picture right now with the Dow, the S&P, and the NASDAQ slightly in the red. We're watching AECOM seeing a pop today of more than 5%. This is after the company said it's agreed to sell its management services unit for $2.4 billion to a consortium of private equity firms. This will help reduce debt and also help with stock buybacks. Also, we're watching Blackstone not moving too much on a downgrade from Bank of America to neutral from buy. And then we're watching this morning Hexo under pressure after being downgraded at Seaport Global to neutral. Also, Seaport Global downgrading Canopy Growth to neutral as well. This is the third session in a row in which Hexo is under pressure. Last week, they announced a surprise revenue warning and also withdrew their fiscal 2020 guidance. That put pressure on Canopy Growth, and also on cannabis stocks in general. Jefferies also last week slashed its price target on several cannabis companies, putting the whole sector really under pressure last week. Right now, we're looking at the Dow that's flat, the S&P and the NASDAQ slightly lower. Stay with us. Wi-Fi AM starts right after the break.
Good morning and welcome to Wi-Fi AM at Yahoo Finance at the start of a new week. I'm Dan Roberts. We've got Julia LaRoche and Brian Chung here on the couches on this Monday. Should I even mention it is Columbus Day / depending on what you want to call it, Indigenous Peoples Day. But we are here working because stocks are open. Let's take a look. We are seeing a little bit of a mixed picture. Right now, the Dow is actually in the green, which may be surprising considering how futures looked just about an hour ago. The NASDAQ and S&P in the red, but not by too much. And we have to start the day talking about the latest on trade. China would reportedly like another round of negotiations and talks before actually signing the Phase 1 partial trade deal that President Trump announced on Friday. That is according to Bloomberg. And that was sending markets lower before the open. But right now, as we mentioned, the Dow is in the green. Whatever excitement there was on Friday about big progress in the trade war maybe has dissipated a little bit on that news. Let's check in with Jess Smith live in Washington with the details. Jess, what are you hearing over there about this report about what China wants in the ongoing trade talks?
Well, the Trump administration is stressing that phase one is pretty much done. It just needs to be put on paper. But China is saying that after this latest round of talks in D.C., they made progress. So kind of a different message there. And we did hear from Secretary Mnuchin this morning as he talked to reporters at the White House. And he says there is an agreement in principle. He compared it to buying a building. He said you buy a building and then, or you agree to buy a building and then you negotiate a contract. He laid out the next steps of what will happen. He says there will be deputy level calls this week, a principal level call next week, and then he expects deputies to meet in person, and then he and Ambassador Lighthizer will meet with the vice premier in Chile, and then the two leaders, President Trump and President Xi, would then theoretically meet in Chile or sometime around then to finalize the deal, to sign it. Tariffs will not go up tomorrow. They were supposed to go up from 25% to 30% tomorrow. That won't happen at this point because of this agreement. But the December 15th tariffs are still in play. Mnuchin said in an interview that those tariffs will happen, he thinks, if there is no deal. But he expects there to be a deal in place by then. Some are really skeptical about this, though, because there is at this point no plan to roll back any existing tariffs. Morgan Stanley analysts said in a note that tariff escalation remains a meaningful risk. So we'll be watching from any word on how these conversations, these phone calls go over the next couple weeks.
Jess, given what the Chinese now reportedly want, and that is a little bit more talking before they actually sign a deal, you wonder if on Friday the idea of a first level deal or phase one deal was prematurely announced. And I remember when it was announced, or initially when there were reports that it was coming, we discussed whether it was early to call it any kind of deal. And sure enough, now here we are. It's really not yet done. It's really not yet official. And you wonder if this goes back to the narrative of the president or the administration sort of being too quick to say, oh, look, we got a deal, when, well, really, do we have a deal yet?
Well, at this meeting at the White House, when we saw this meeting with the Chinese delegation on Friday, the president did say that he thought it would take 3 to 5 weeks to get this on paper, but he didn't foresee any problems. And China is saying that there was progress made. They listed some of the specific issues that the president has said they've nailed down, like IP and ag purchases, some of those issues. So there definitely was progress. And Mnuchin seemed very confident this morning. He is really stressing that this is pretty much done. It just needs to be put on paper. Whether that is true, we'll have to see. But he did say regarding that Bloomberg report that China wants more in-person talks. He says no one's afraid of travel. No one's afraid of work. He said if there need to be more in-person talks before the meeting in Chile, then fine, that would happen. But at this point, what they have scheduled are phone calls and then meetings right before that summit with the two leaders.
Hey, Jess and Brian here. Obviously, the other big story in D.C. is the impeachment inquiry. Lawmakers come back to Washington after being off last week. What's the latest update on that?
Well, what I'm going to be watching this week is how Republicans handle all of the questions they face from reporters now that they are back in Washington. They're coming back to Washington this week. A lot of the Republicans have been at home in their red states, their red districts. So it will be interesting to see how they answer these questions that they're going to be faced with this week, whether we start to see any cracks in the Republican Party. A few hearings to watch this week. We know that the president's former top Russia advisor is set to testify today. That will be behind closed doors, but we'll be looking for anything that she might have to say. The ambassador to the EU is also scheduled to testify this week. And then there are some subpoena deadlines, documents from Vice President Pence, OMB director from the Pentagon. So we'll be watching for any developments on that. And then one other note from the weekend, we did hear Hunter Biden say that he is going to step down from the board of a Chinese firm and says if his father becomes president, he will no longer do any foreign work. So that, of course, is kind of at the center of all of this. President Trump is trying to focus on that angle here. So that's just another development on that front.
Jess, while we have you, let's get a quick update on the Libra phenomenon from Friday. We saw it was a little bit of a Friday afternoon news dump, but a bunch of those companies that were part of the Libra Association, that is Facebook's cryptocurrency plans, dropped out: Visa, MasterCard, eBay. And that was after Senators Sherrod Brown and Brian Schatz sent a letter. Plus, we had Steve Mnuchin commenting on it this morning. So what are you hearing now in D.C. regarding that Libra exodus? And how much do you think that lawmakers in their letters were to blame, or I guess, depending on your perspective, to thank for that partial exodus?
Yeah, well, lawmakers are definitely putting the pressure on Facebook and all of the other companies associated here. Senator Brown and Senator Schatz, as you mentioned, wrote that letter warning these companies to proceed with caution. They basically said in a letter to MasterCard, Visa, and Stripe, they said, you know, if Facebook has weaknesses, if you associate yourself with them, those are your weaknesses. And then we did see those companies drop out. Mnuchin said in an interview this morning that Treasury wrote letters as well. He said, don't give the senators too much credit. Treasury wrote letters too, so trying to get in on that there. And he said that maybe these companies are realizing that Facebook and the Libra Association isn't quite up to par yet, and that's why they've dropped out. Senator Brown did put out a statement after we started to see these companies drop out, and he said maybe others will see the wisdom in avoiding this ill-conceived undertaking. So I think the message here that lawmakers are trying to send is it's not going to be an easy path here. You're going to face a lot of hurdles from Congress, from regulators, if you're trying to move forward.
Yeah, it's really interesting to see also that all the politicians want some credit for crushing Libra's plans. We will have to keep watching. Jess, thanks so much. Coming up on the show, Elizabeth Warren spending some campaign money to slam Mark Zuckerberg and Trump at the same time. We will break down the interesting experiment that the Warren campaign carried out. Welcome back to Wi-Fi AM at Yahoo Finance. Let's take a look at markets because in just the last few minutes, all three major averages have flipped into the green momentarily. The Dow right now is up 40 points and it's inching higher. The NASDAQ and S&P just barely in the green as well. And we will keep monitoring, but let's get some more insight on exactly what's happening with Inez Ferrer live on the floor of the New York Stock Exchange. What are you seeing down there, Inez?
Yeah, Dan, and just talking to traders, and everyone's really on watch on any developments really with China this week. Of course, they're also they'll be looking at the bank earnings that are coming out this week as well. We're looking at the Dow that's flipped into the green just minutes ago. It's now up about 40 points. And we are watching the cannabis sector today. This is because Hexo was downgraded at Seaport Global to neutral. Also, Seaport downgraded Canopy Growth to neutral as well. Now, for the last few sessions, Hexo has been significantly under pressure. Last week, the company announced a surprise revenue warning. Also, they withdrew their fiscal 2020 guidance. That sent cannabis stocks lower. Jefferies also on Friday slashed their price target on several cannabis stocks, including Canopy Growth. So you're looking at some pressure in the cannabis sector overall, Dan.
All right, thanks, Inez. We'll check back in with you soon.
See you soon.
Now, we have some new developments in the GM auto strike. The United Auto Workers Union is increasing strike pay for the some 46,000 GM factory workers on the picket line as that strike enters week 5. Now, the strike pay increase went into effect last night, and striking workers will be getting $275 a week, up from $250. Rick Newman joins us now with an update. Rick, what do you make of the ongoing strike now? GM losing money here. Obviously, the workers on strike would like to go back to work, but they just can't come together yet.
They seem to be getting closer, and increasing the strike pay. I mean, that's a signal from the union that they're giving the membership, a little bit more money, so they can, in theory, last this out a little bit longer. They also said that striking workers can now go work temporary or part-time jobs as long as they show up to picket whenever it's their turn to do that. It's also getting cold and in Michigan, and it's no fun walking a picket line when it's cold outside. So that's sort of another factor out there. But it does seem that they're getting a little bit closer. GM did up its offer for investment in U.S. factories from $7 billion to $9 billion. That means GM is saying we're willing to put more money into factories. If we're committing here in the United States, that means we're committing here to more jobs in the United States. There still do seem to be some disagreements about what to do about temporary workers. GM wants the flexibility to downsize its labor force if it has to in the future, which it thinks it might have to do as the type of cars it builds changes. And I think they're also probably still arguing over whether GM is going to move any work from overseas, most notably Mexico, back to the United States.
I guess, how does that pay compared to what they would normally make, and what's to stop someone? I don't exactly know the inner workings of a union versus if you're not a member of a union saying like, hey, I'm kind of tired of striking, that's just not enough pay, I want to go back to work.
But then you're a scab, right?
Well, yeah, you would be a strike breaker. And by the way, you can't just man an assembly line with a handful of people who want to go back to work. So it's basically everybody is either all in or all out, I think. I think typical pay for weekly pay for union members is pretty good. I think it's between $1,200 and $1,500 a week. They're living on a fraction of what they were making before the strike. So this is a hardship for the union workers, but GM is also losing as much as $100 million a day in lost sales.
And on that point, is there any sort of measure on how long we think GM might be able to stick this out based on maybe inventory that they have? And, what does that mean in terms of whether or not they're going to crack first?
So GM is probably getting close to running out of some models available in showrooms. They're already running short of spare parts for, if you need to have your vehicle serviced. So there's some instances where spare parts are not available. So it is hitting GM, and they are losing sales. The way strikes typically work is if it just goes on for a couple of weeks, pretty much the automaker will make up those lost sales, or really won't have lost much in any way because of what it has in the pipeline. But certainly, we're now approaching a month, or we're at a month's point. I think we might be in the 5th week now. At that point, GM is starting to lose sales, and it is starting to lose sales in a way it's not going to recover them. But that's not necessarily GM's pain point. What we have learned from this is GM feels it really needs to allow for some flexibility in the future of its labor force. It is clearly not willing to get locked into the labor force of the present, because it knows that as it shifts to making more electric cars, fewer moving parts, which means you just need fewer workers. And of course, the workers see that too, and they want to be able to lock in jobs when they might not otherwise have them.
That sucks. I'm really glad that you keep highlighting that point, though, because really it's a story about the future and what GM sees coming more than it is about right now, the present.
Yeah, and that tells you that GM is probably willing to take more pain than they would otherwise be willing to take if they just foresaw status quo in the auto industry. They don't.
We talked about this last week, but in many ways it mirrors the ongoing trade war.
Totally.
It really does, and the terrifying. Stay with us, Rick. Let's talk politics. Elizabeth Warren's campaign is now highlighting Facebook's fact-checking issues using Facebook. The presidential candidate ran a Facebook ad that claims Mark Zuckerberg has endorsed Donald Trump for presidency. It says, breaking news, Mark Zuckerberg and Facebook just endorsed Donald Trump for re-election. And then in the post it says, you're probably shocked, and you might be thinking, how could this possibly be true? Well, it's not. She is, of course, criticizing Facebook's stance that it does not police the facts in political posts. So she is basically daring Facebook to take the post down. And indeed, the company has responded, Facebook political speech should be protected. If Senator Warren wants to say things she knows to be untrue, we believe Facebook should not be in the position of censoring that speech. So quite an interesting little trick. Rick, what do you make of it? And, some critics, I'm sure, would say, well, even though she's proving a point, she is still doing exactly what she's saying others do, which is she's spreading misinformation.
And I think what she would say is, yes, I am spreading misinformation. I'm deliberately spreading misinformation. Come on, I think it's very clever. I mean, what do you guys think?
I think she perfectly trolled Facebook.
Totally.
And this is going to give her a lot of fodder when she's, calling on breaking up big tech, going after Facebook, criticizing them. And I got to say, at what point are Facebook users going to say, enough is enough, whether you're Democrat, Republican, independent, not even politically active? This is explicitly saying, look, we're not going to police what the ads say, whether it's true or not. So, I mean, are you going to just post your wedding photo somewhere else and no longer be on the platform?
Interest.
Yeah.
At the same time, I mean, given the events of 2016, you would tend to think that Facebook would want to be more sensitive to making sure that there isn't false information being spread on its own platform. But we saw since 2016 that Facebook has really fumbled in terms of trying to figure out what the proper protocol is and trying to, figure out what is true and false, because, I mean, that line isn't as black and white as it often is in some cases.
So this is a giant.
It has tried, but it hasn't gone well.
This is a giant hole in the way the media has evolved. So we all know that traditional media, old media, broadcast media, has to abide by certain FCC rules and other rules that make them responsible for most of the content published on their website, whether they generate that content or not. Congress made a specific loophole for internet companies in 1996 when they said, at the very beginning of the internet, when they said internet companies are not responsible for direct speech, which is what somebody else, a third party, runs on their website. Facebook keeps, saying like they're taking advantage of the fact that they are not required to police this, but what they are doing is they are just building a case for the government to do it because Facebook is just doing it very poorly. Yeah. And I mean, the problem Facebook has is if you open a newspaper, the old-fashioned newspaper where you'd flip through it, there's a finite amount of stuff there. And it's not that hard to look at what is in one newspaper in a given day and decide if it's true or false. There's so much stuff on Facebook. So, it's a legitimate problem. There's no way they can possibly have the resources to fact check everything. But this is some of the most prominent content on Facebook is political ads. They make a lot of money from this. And they are simply going to have to figure out how to deal with this, or sooner or later, the government is going to just do it for them.
All seen in our own feeds where, a friend will repost something or believe something. Like, say, for example, it's the Pope endorses Trump or something. A fake ad, and people are like, "Oh my gosh, this is so true. This is great," But I mean, we've all seen
shock.
it.
Like, I can't believe this, and it's like you shouldn't. It's false.
And I think that the world has changed, as you were just saying. So maybe this does need to be revisited. And I would have loved to be in the room when the Elizabeth Warren campaign was coming up with this idea. Was it Senator Warren who had the idea? Staffer? I just find it
I wonder
such
how
a
many people.
Brilliant troll.
I wonder how many people are reading the advertisement and actually thinking though.
Yeah, that's
spreading misinformation to make a point still spreads misinformation. I don't know.
At this point, it's been so heavily covered in the media. If you don't know about it, I find that kind of shocking as well.
I think if you learn anything,
so the Warren ad has.
I think a lot of people are not reading any of the news and they don't realize.
The Warren ad does have a disclaimer. It says what we just told you is false, and here's why we're doing this.
Yeah, pretty high up.
They are responding to a Trump ad that is saying Hunter Biden, Joe Biden basically committed some kind of crime in Ukraine by trying to help out his son. That is completely false. And some of the networks
they won't run it.
The Trump campaign tried to run that on some of the networks, and they said no, we're not going to run it because we know it's false. Twitter is doing the same thing, by the way, as Facebook. Honestly, this is getting so tiresome that Facebook's basically saying there's nothing we can do to police bogus content on our website. I would frankly not mind if Congress said, you know what, Facebook and Twitter, social media, you are all have to abide by the same laws as all the rest of the media. That would completely, revamp the way Facebook polices content. It would probably mean there would just have to be a lot less content. The barrier for posting content would be it would totally transform Facebook. It would definitely hurt them, from a profitability standpoint. Tough is my attitude.
Look, all this gets back to the same question that there's always been about Facebook. Can you just be a neutral platform? Is it a media company? Facebook doesn't want to be considered a media company, but
they are a media company.
Yeah, when you have people posting stuff to your platform,
at that scale,
you have to worry about that.
It's like old school Facebook where it's just my status, what I'm doing with my friends.
Like simpler days. All right, we'll have to leave it there. Rick, thanks so much. We'll keep monitoring. And we'll be right back at Wi-Fi AM. Right now, the Dow in the green, NASDAQ, S&P in the red.
Time for today's trending tickers. First off, AECOM, the engineering and design firm. Shares on the rise, up about 5% on Bloomberg reports that the company is nearing a $2.4 billion deal to sell its management services business to a group of private equity firms, including American Securities and Lindsay Goldberg. But an activist twist, Jeff Smith and Starboard Value have pushed AECOM to go even further when the company announced its intention to sell the management services unit back in June. Starboard wrote that the company should also spin off its construction services business. So a little bit of drama unfolding here, but I mean, it seems like Starboard should be happy about this first step.
Yeah, and guys, just to give a little bit of context, this is Starboard Value is the activist hedge fund led by Jeff Smith. You all might recall from back when he went after Darden, after Olive Garden and their breadsticks, not salt in their pasta water. So he's a very well-known, prolific activist investor, and you were just referencing a letter that he sent out. Maybe you don't know much about AECOM. Maybe it doesn't sound like, you know, the most exciting story, but what he's essentially saying is that the company has underperformed its peers and the broader market because of poor execution when it comes to the operational side of the business. So he would view spinning off the management services side of the businesses, which does more like federal contracts, as a positive catalyst, breaking up some of these different business units, which they say are actually really valuable. It's just when they're all together and the operations aren't right, that's the problem.
Papa John's another fun activist story.
Yep.
That is maybe
he's been in Yahoo before, back in the day, and
once Jeff Smith gets involved, if you're a shareholder, you probably get excited that things are going to turn around. But if you are an employee of a company and you read that Jeff Smith is involved, that might not be so good for you.
And what we've seen from the stock movement is that obviously, Starboard Value with some interest in this, but the investors at large are also pretty happy about this this rumor that they're going to spin something off. They said that the announcement could come today, so we'll stay posted on that. But the other ticker of the day that we are looking at is CrowdStrike. That's ticker CRWD, the software company getting slammed in trading today, down almost 7% after Citi initiated coverage on the company with a reported price target of $43. That's quite a downside from where it is right now at about $56. It's the latest bearish call from Wall Street after Goldman Sachs had its own downgrade last week from a neutral to sell with a price target of $66. A little bit higher from where it is now. But Goldman said the company is still a next-gen cybersecurity company. The stock price reflects expectations that, quote, remain elevated. So
it's such an interesting story because for a while what we were saying was the one genre, the one industry that was doing well, bucking the trend is SaaS plays. Yep. Enterprise software, if you are a B2B business. And then even within that, CrowdStrike looked especially appealing because it's security. Everyone needs security. We hear about a new breach and a new hack every day or every week. And CrowdStrike looked very well positioned. And it has been trading nice, not at the end there, but for a while there.
Since the IPO, I think it's up.
No, I think it's now down from its IPO price.
Yeah, So, I mean, the problem with this stock is that, and I guess for the SaaS play at large, is that no one questions their value in the current system, right? I mean, people have demand for these types of services. They won't go out of business, and they'll probably be profitable at some point. But did investors get too excited in pumping the stock price up? I mean, it's the same question for a Workday, for Slack, with a lot of these other types of companies. So I think that it's not necessarily, Citigroup or Goldman Sachs saying, look, we don't believe in this business model. It's just that, look, I think the street is just putting a little too much air into this thing for right now.
It got overvalued, and this is one of the names that on its first day of trading shot up. Yeah. So I think that's part of the problem, is it kind of flew too close to the sun.
I think it's just a very aggressive name for a cybersecurity company.
CrowdStrike.
It's a great name.
Strike it out.
It sounds like a defense contract.
I'm into
it does.
Like
right.
Northrop Grumman or
Whereas
something.
Palantir sounds like a nice, who knows what it is,
Lord
but that's the
Rings.
defense.
It's like the thing from Lord of the Rings where they can look into. Isn't it the orb that the kind of evil wizard has? Sorry, I can't remember the name. It was like Gandalf's rival in Lord of the Rings. I think that's what the Palantir is that weird orb that he looks into.
I did. We'll have to look it up.
Thing.
Yeah, all right.
Google it later. I might be wrong.
Lord of the Rings from Julia. I love it. Okay, coming up on the show, SoftBank considering swooping in to save WeWork. We will discuss that news. Plus, we will parse through that Friday afternoon exodus of Libra's big name backers after the break. Welcome back to Wi-Fi AM at Yahoo Finance, where we are monitoring the markets. All three major indices now in the red. We've seen a lot of movement over the last hour. Right now, the Dow, S&P, and NASDAQ, each one just a little bit in the red. Time now to talk about WeWork, or the We Company. Now, according to the Wall Street Journal today, SoftBank has put together a bid worth several $1 billion that could give WeWork, or the We Company, the cash infusion it needs to avoid disaster. Now, the Journal reports that the potential deal would shift founder Adam Neumann's already diminished voting power and give SoftBank a bigger role in turning around the company's everyday operations. Yahoo Finance's Emily McCormick here with more. Wow. Wow, Emily.
Where does it end for WeWork, right?
Well, on Friday, we were talking about how this company needs cash, and there were reports that JPM could step in and finance it. But what we on the couches were saying, and Scott Gann was on the show, Heidi Chung was on the show, we were discussing, like, well, who would want to do that at this point? And Scott said, and maybe his prediction was right, well, if you're SoftBank, you've already put so much money in, at this point, you might as well double down.
Well, and if we think about it, at the beginning of this year, remember SoftBank had the opportunity to make an investment to take majority control of the We Company, and they didn't do that. And that was when this company was valued at $47 billion. Now it's looking at a valuation of potentially less than $10 billion. So you're getting something like a fifth of that original investment. So this really does look like a Hail Mary if it does come through for SoftBank, just because they're already going to have to write down the stake in WeWork. So really just keeping this company on its feet seems to be the eventual goal here.
I mean, one problem with SoftBank is that they had already fumbled the valuation of this company before it even went public, right? In the private funding rounds, they were waffling around with what the proper valuation of this company is, and it raises questions not about WeWork's underlying business model, but whether or not SoftBank, or for that matter, other venture firms in the Valley or in the United or in the world, for that matter, are doing a good job at properly valuing companies that are currently private.
Especially SoftBank. I mean, that
especially
Vision Fund.
SoftBank, right? But it makes me wonder: are there other unicorn IPOs that are still in the woodworks that honestly have very, very kind of frothy, opaque valuations? And I think that's a really good question worth asking as other companies start to consider whether or not they should be hitting the
Well, and I
markets.
think what it speaks to, too, is just this underlying and fundamental difference in raising money in private equity, of which venture capital is a part of that, versus the public markets. I mean, when you're a founder and you can actually pitch one-on-one to these investors, you can really have that charisma. You can
It's too easy.
Yeah, it's too easy. And then, but when you're in the public markets, look at what happened when WeWork released its S1. All you have are the numbers. It's just they have to speak
The
for
jig is
themselves,
up.
and they didn't.
I kind of wonder how much responsibility goes to the VCs for the IPO flops that we've seen enter the market lately. I mean, this one obviously didn't make it there, but it also makes you wonder because who's going to get hosed on these ridiculous valuations? And I guess it also goes back to the VC models. They put money in a few and hope that maybe one is successful. So, I mean, I think maybe it's just been too easy for some folks to even raise that amount of money.
I think they
in the first
deserve
place.
a lot of the blame, and I wrote last week about how SoftBank is really behind a lot of the biggest mistakes or the ones.
And the people who have suffered have been the employees at WeWork.
Yeah, because
they've either gotten laid off or were compensated in stock that is probably far less value than it was.
Imagine like you think, okay, we're going to exit, and you're envisioning your life. This could have been a life-changing IPO for some people. Maybe you thought like, oh, well, I can buy that house or I can do this, and then no.
So Emily, what is the status for Adam Neumann right now? Right, he got bounced to just the chairman of the board,
Right,
and then
a non-executive chairman of the board, right? And reportedly had voted himself actually out of that CEO position in that board meeting.
It's like he knew.
Exactly.
I gotta go.
Noble, I suppose. No, but so right now his voting stake is at 3 votes per share. That's already been diluted from 10 votes per share, which was already diluted from 20 votes per share. So we're really seeing him get less and less of control over the company. If SoftBank swoops in, it's not clear what his actual fate would be, if he would retain even that non-executive chairman role, if he would stay at the company. He was the founder, though, so he was the one who actually started this company to begin with.
I think another question people aren't asking, because you go back to read the S1, one of the risks is if people aren't signing up to, get become tenants essentially at WeWork, is how much has this whole publicity, this botched IPO impacted potential, I guess, I don't know what you call them, who would take up residence as employee?
hiring?
I don't know what you want to say. Not hiring.
Tenants.
No, tenants. Like actually small startup companies to go and enter a WeWork because it doesn't seem that cool.
Well, if they need space, they still need space, but they might not look to WeWork to do it.
There are other companies, I think, not as big as WeWork, but they're localized, like New York City based or Washington D.C. based. So I mean, we'll see. It's been early. I mean, we need some time.
Right, and other companies that have done it more successfully. I mean, look at IWG. That's a European company.
Right, yeah.
It's a real estate company that isn't just co-working, but we're we're seeing them being very successful in that co-living space market.
And in the wing for women as well here in New York. So.
Right. I want to make sure we mention that just last week at our Yahoo Finance All Markets Summit, we discussed this very topic, the recent IPO failures with a lot of our guests, but including NASDAQ CEO Adena Friedman, and she gave her take.
I think there are definitely every year you have a mixed experience for IPOs. You know, whether or not the company is races off the gate and has a huge run up, or whether or not they might have maybe not as smooth a path into the public markets. The fact of the matter is their success is going to be measured over time. Their success is not determined by the first day, the first month, the first quarter. Their success is going to be measured by, are they building a scalable model that provides value to their customers while also providing value to shareholders? Are they able to demonstrate their vision through their execution over time? When they go on the road, they talk about what is the status of their company and their market today, where are they taking the company, how can you measure me over time? And the key is for them to be able to hit those marks and to show investors that they can, in fact, generate the growth and continue to perform in the way that they have expressed they can. If they do that, they will create value for their shareholders.
All right, that was NASDAQ CEO Adena Friedman. And just a reminder, you can watch all of the clips, including the full interviews if you'd like, from last week's All Markets Summit if you go to yahoofinanceams.com. Well, let's talk now about cryptocurrency. The Libra Association, the Geneva-based governance group that Facebook created to oversee Libra, had a very bad day on Friday. Visa, MasterCard, eBay, Stripe, and Mercado Pago all exited the association. They were founding members. They followed PayPal, which had exited a week before, and it was likely due to pressure from lawmakers. Now, the Financial Stability Board, a body of regulators created after the financial crisis, has warned that Facebook's crypto project could risk the stability of the global financial system. And also, Senators Sherrod Brown and Brian Schatz sent a warning letter specifically to Visa, MasterCard, and Stripe. So on Friday, we saw a big exodus. Now, it looked like Libra kind of stopped the bleeding because we haven't seen any more announcements of exits since Friday night. But what do you guys make of it? I mean, the question now is this thing even going to launch? And worth mentioning, 28 founding members. So we saw, I think, 6 drop out. So still a big group of companies.
Household names dropping out: Visa, MasterCard, PayPal.
Yep.
Didn't catch the others.
eBay, Stripe,
eBay,
yep. All the biggest
all the
names.
the big kind of financial services
The
players.
legitimate big companies.
Yeah, that everyone would recognize. You wrote about this. I guess the question would be more directed toward you, Dan, since you're more of the crypto expert. Is it dead?
No, it's not dead. That's a good question. I think a lot of the legitimacy is in question now, but of course it's been in question since minute one. These companies dropping out, all it shows is they're spooked, which I think was predictable, inevitable. Now, all of the crypto believers have responded to this news by saying, okay, well, Libra doesn't need these companies to be successful. And arguably, if you do think that, you know, Libra cryptocurrency can be a thing and can sort of get some momentum once it launches, then you should believe that it can do that without needing names like Visa and MasterCard on board, especially since if you think about it, the whole original proposition of cryptocurrency was we don't need these middlemen, we don't need these traditional Wall Street names, we can circumvent them. So arguably it was sort of weird since the beginning to see Visa, MasterCard, PayPal on board with Libra.
I agree. I think that looking at these names and understanding that these are all payment processors that in a way are kind of rivals to the whole Libra platform in the first place is telling, but also maybe not surprising. But I think what's important to note, though, is why they even sign on in the first place. Then. And I think the reason why they signed on in the first place is because they didn't want to miss the boat if this were indeed to become the next thing. So it was at some point an acknowledgement from the likes of Visa, from the likes of Stripe, from the likes of PayPal, that this is technology that honestly could be the next big thing if it's done right. And I think that from the regulatory backlash, because keep in mind, Visa, PayPal, they're already dealing with their own regulatory issues as not banks, but fintech players, right? I mean, you look at PayPal with their Venmo, they had a debit card now. I mean, Stripe, they're not necessarily looking for a banking charter or trying to deal with AML provisions or whatever, but it's something that they just honestly said, hey, this is just extra regulatory stuff that we don't want to deal with right now. So for that reason, we're out.
I think it's possible to believe that both sides look a little foolish, or that the exodus puts some question on both sides. For Visa and MasterCard, well, what were you thinking was going to happen? Why were they on board in the first place? But for Libra, for Facebook to try and launch or announce a new cryptocurrency at this moment, I mean, talk about awful timing.
Yeah, bad timing.
Announced back on June 18 amid all of the different cases against Facebook.
And it's not Facebook, it's Calibra.
Right. Right.
So.
It's separate.
It's separate.
Separate but equal. No, it's worth mentioning. Libra Association based in Geneva, a separate governance board, but Facebook is a member, and Facebook's own executive, David Marcus, led the establishment. So come on. Hard to separate it from Facebook. All right, we are going to another short break, but coming up on Wi-Fi AM, change at the top at Boeing regarding a big executive's title. But is it just a symbolic step? We'll discuss.
Welcome back. I'm Ines Ferre here with Tim Anderson from TJM Investments. Tim, we're looking at a pretty flat picture right now. On Friday, we got that President Trump is saying that phase one trade deal. Then over the weekend, we heard from Chinese media that perhaps hold off the champagne on this. What are you hearing? What are your thoughts on this and how this is moving the markets?
I think we have to put in perspective that when we hear something from the Chinese media, the media in China is really controlled by the hardliners in the Communist Party. And they probably weren't happy that the Chinese officials spoke at the same news conference in the Oval Office that Trump spoke at. And they probably weren't happy that they messaged that they had an agreement in principle.
So where do we go from here? Are we going to go sideways for a bit?
Very likely, because with the idea that we will still have knee-jerk reactions up and down based on trade headlines, and we are just over 2% from all-time highs on both the Dow and the S&P 500. We had big gains last week. We're coming up on the beginning of a earnings season tomorrow. And I think that investors just need to determine how much real positiveness they need in the market to commit new funds to potentially drive the market to new highs going into the end of the year.
Thanks so much, Tim Anderson. Stay with us. Wi-Fi AM continues after the break.
Welcome back to Wi-Fi AM at Yahoo Finance. Let's take a look at markets right now. We have seen a lot of flipping in the last hour, and right now the Dow and NASDAQ are in the green just for the moment. The Dow up 18 points, NASDAQ up barely, but basically flat, and the S&P is basically flat as well, barely in the red. Now we have to talk about some updates on the ongoing Boeing saga. Boeing has stripped CEO Dennis Muilenburg of his position as chairman, so Dennis Muilenburg is now just CEO. Now, the idea of splitting the roles is commonly an effort to show more oversight of the business, but you wonder if this is just an optics step. Yahoo Finance's Alexis Keenan is here with more. Hi, Alexis.
Hi, optics maybe.
Yeah, what do you think? What are people saying to this? What's the reaction so far? This happened over the weekend, splitting the CEO and chairman roles.
So it depends who you ask. It depends who's writing the article. But Muilenburg will stay on as CEO and president, and he's still a director. He is just not chairman anymore. Okay. So some people look at this and say this is a vote of confidence, actually, for Muilenburg because he still has his job, right? He's still getting an opportunity to get this MAX back in the air. Some critiques say, hey, if he doesn't get it back in the air in the fourth quarter when Boeing has consistently promised, then things might change. The scrutiny might get a little bit tougher. So it depends who you're asking. And also, recently Boeing made some changes to its organizational structure where its top engineers will report directly to the chief engineer and thus giving more of a direct line to Muilenburg. So in that sense, he has a little bit more control over what's going on at the company. So, remains to be seen.
I mean, what is the actual implication of not being the board chairman anymore relative to the 3 or 4 other roles that he has right now? He's still going to be a director on the board, right, as I understand it. So for those that are maybe unfamiliar with what each different role has in terms of responsibility beyond what you just explained, what actually is the change here?
So he will not now be directing really the mission of the company. And, he's not going to have the kind of oversight that he had as chairman anymore. This is going to go to David Calhoun, who has been a lead independent director since 2018.
He's also executive chairman.
Yes, and he's also been a director on Boeing since 2009. So he's been there a long time. He will take over the chairman's role and have a lot more authority about how things go and over some of these safety changes that they're making at the company. Also, he's been director since 2009. He's also senior managing director of portfolio operations at Blackstone Group. He also led GE's aircraft division for a time. Also, former Nielsen and Caterpillar. The guy's got a lot of experience.
Gotcha. Let me just mention, I remember a few years back when I was at Fortune before coming to Yahoo, we did a story on the fact that splitting the CEO and chairman roles is a very common age-old thing in Europe and in places outside the U.S. But in the U.S., it's very common that one person has the title of chairman and CEO. But we wrote a few years back already about more and more American companies starting to split up those two roles. So as I understand it, it's usually an effort to show that it's not all on one person.
Right,
there's a multitude of voices.
Elon's role at Tesla earlier this year, and you'll also see calls on Wall Street. I remember at one point there were calls to split Jamie Dimon's titles at one point. So it's something that tends to drum up conversations, at least here.
When you say, Alexis, I want to end on this, that there's still pressure on Muilenburg to get the 737 MAX in the air in the fourth quarter. Well, fourth quarter, we're talking about 2 more months. We're already halfway through October.
Not much time.
What really are the chances of these planes getting in the air before New Year's Eve?
It doesn't seem that likely. I could be wrong. However, Boeing has not yet submitted its packet of changes to the FAA. So it hasn't even handed over that information for the FAA to be able to say yes or no. So getting them up in the air when that process is expected to take 2 to 3 months does not seem likely that it's going to happen by the end of the year.
Especially holidays.
Especially holidays. And also important to note here that this change at Boeing, this chairmanship change, is coming right on the heels of a report that was issued within hours before the shakeup. And this was from that joint group of regulators that we've been waiting so long to hear from. They have really come down and criticized Boeing and FAAs here. So this was a really quick response, it seems, to that.
All right, Alexis, thanks so much. I'm sure we'll have an update on Boeing very, very soon. So I'll have you back.
You're welcome.
Okay, Mayor Pete Buttigieg has made it clear that he does not stand with fellow Democratic presidential candidates, Senators Bernie Sanders and Elizabeth Warren, when it comes to Medicare for All. Buttigieg calls his plan Medicare for All Who Want It, and he gave details at the New Yorker Festival this weekend. Our own Adriana Belmonte was there and joins us now with more. Hey, Adriana.
Hi.
So what was the reaction in the room? Now, he had already, at a couple of the debates, mentioned the name of this plan. That was out there. This wasn't like a big reveal. But finally, to get some more detail on that, what was the reaction and what were the details that we got?
So he stressed that his plan is all about choice. So it doesn't force people to
enroll in this plan, they could still stay on their private insurance. Another thing it would do would be limit the ability of healthcare providers to charge certain amounts. It would cap costs, premium, out-of-pocket things. But it all goes back to the idea of choice. He wants people to feel like they have options.
So this is not Medicare for all.
Not at all.
Well, somebody kind of raised that point. They're like, it kind of sounds like you want to have your cake and eat it too. And he responded, why not? His argument is that this is going to force private insurers to, they have to compete with the public ones. And essentially they have to kind of shape up their business, show that they are a good option.
I guess, how much appetite is there for Medicare for all just out there? Because I was just thinking back to our AMS, we had Merck CEO Ken Frazier answer this question from our very own Andy Starwood, and he's like, they say the slogan's Medicare for all, but no good care for anyone. I can't remember the exact quote. I have to go back and re-listen.
Yeah, I remember that.
Something along the lines of that. So, what is the appetite out there? I mean, I'm not thinking about it at the moment. So,
it's hard to gauge it because it seems like public opinion keeps going up and down depending on who's talking about it. I think Buttigieg, just from my experience when he was speaking, it seems like he understands that there is a call for a better healthcare system, but he doesn't know if just making it a universal thing that it's forced upon others is the best option.
I do think this is a critical issue. It's interesting to see if this kind of not Medicare for all, kind of almost like Obamacare's like system is going to appeal to the kind of centrist Democrats. Maybe that's the kind of play he's going for here.
Yeah, and one other thing that I thought was interesting, and I looked through his plan myself as well, he still hasn't said how he's going to pay for it.
Yeah, that little detail.
That little detail, yeah. And how much it's going to cost. There's no official number on it, but an advisor had told somebody that it would be in the ballpark of around $790 billion. Ooh. So the question now is, how is he going to pay for that? Because at least with Elizabeth Warren, she wants Medicare for all, but hers is going to come from a wealth tax. Bernie Sanders has kind of said something along those lines, but Buttigieg has not specified yet.
We will see. All right, good weekend reporting. Thanks, Adriana.
Thank you.
We'll be right back at Wi-Fi AM after a quick break. Welcome back to Wi-Fi AM at Yahoo Finance. Dow up 30 points right now, and the Nasdaq in the green as well, but the S&P for the moment in the red. Let's talk about Netflix. Netflix set to report earnings on Wednesday. It is its last quarter before Disney Plus and Apple TV Plus launch, and many see those as potential Netflix competitors. Now, Netflix stock has fallen over 20% since its disappointing second quarter earnings report after it showed a decline in U.S. subscribers for the first time. Now, subscriber growth, both domestically and internationally, will be the big focus for this quarter, as it always is. So what do you guys expect from Netflix? And of course, to me, the more interesting question, are Disney Plus and Apple TV Plus really threats?
Well, Julia and I were...
Yeah, we're like going down a rabbit hole of the 1970s hits from Disney that are going to be on there. I have one right here called The Biscuit Eater.
The list is pretty comprehensive.
But I might be curious. So, I mean, they're just tweeting out basically their whole inventory of what's going to be on there. It's a lot of nostalgia. It's a lot of excitement. It's all generational.
DuckTales. Ooh!
DuckTales is a good
Darkwing Duck.
But no, here's the thing though. Look how excited we are about Disney Plus right now, but I think the list of all these names, which I had never heard of before.
But our parents probably have. I know aunt probably has watched this.
Right,
at least.
but
She's a diehard
But the thing
fan.
is that like it reminds you that like everyone thinks that Disney is this monolith that just churns out bangers like consistently.
Right, nope.
But, like they had a very much Netflix-like model too,
Yes.
where they're throwing stuff at
Kitchen
the wall.
sink.
There were a bunch of titles that I think one of the most expensive movies ever made was this 2000s film. What was it, John?
I know what you're talking about. And it was like they had to write it down in the earnings report.
John Carter,
the guy from Friday Night Lights.
Right, they put so much money into it, but
huge
no
bomb
one
that
cared
resulted
about it,
in an
right?
executive being fired.
We haven't even addressed Netflix. They had this season 3 of Stranger Things. Maybe that could be.
Yeah, I just don't know. Does that? If you haven't watched the first 2 seasons, do you now decide I'll subscribe to Netflix to watch the 3rd season? Maybe.
The point I'm trying to get at is that, yeah, maybe you don't watch the 3rd season, but Netflix is throwing so much money into producing new content that there might be something down the line that can fill the void of all those people who are no longer watching Game of Thrones. But the difference is that Disney has done the same thing, but they have the capital to do it.
Mhm.
Whereas Netflix is going deep into the negative to try to finance all of
Disney
this,
has
which raises some
something-
questions for investors.
And Disney has something for all ages too, and all. If
a
you want to
more
watch your
diverse
Disney
audience,
Princess
yeah.
or also your Star Wars, there's something for
It's a
everybody.
kitchen sink strategy, but it is a very appealing kitchen sink. I will be subscribing. I won't at launch subscribe to Apple TV Plus. But if I were to hear that one of the shows, like the news show with Reese Witherspoon, is great, then I'd be willing to try it because it's so cheap.
Reese
Apple
Witherspoon,
is pricing it.
Jennifer Aniston?
No, it's both.
Oh, it's both. Got it. Okay.
Or maybe it is a Reese Witherspoon.
I think it's
both of them. Both are in
producer's
it. I
telling
knew
us
it.
it's both
Thank
of
you.
them.
Our great producers remind me. The price of Apple TV Plus so low that it's almost an impulse purchase. But of course, the problem there is Apple's not going to make money on it for a long, long time. But really good and really exciting always to preview the streaming wars. It's going to be interesting to see what happens when those 2 services from Apple and Disney launch and whether they threaten Netflix. We'll be right back at Wi-Fi AM after a quick break. All right, welcome back to Wi-Fi AM at Yahoo Finance. Earnings season is in full swing this week, and the big bank earnings are coming. Tomorrow, Citigroup, JPM, and Wells Fargo will report their 3rd quarter results, and the bank earnings overall are not widely expected to be so stellar. Brian, what do you expect? What are you looking at, and what will the outcome be here if it is disappointing?
Yeah, so everyone thinks bank earnings are so boring, but they kick off earnings season. They tell you a lot about the health of the American economy, and I think the headline is that the inverting yield curve, the flattening yield curve has really punished these banks. It's hard to lend long and then borrow short when the yield curve is so flat, which means they're not making a lot of money on interest. So the key, cutting expenses. And I think that's what analysts have been saying is that banks that will be able to perform and meet their targets will be the ones that have been able to cut costs.
And has that meant cutting jobs?
Well, I don't know.
Automation.
I mean, well, but the headline just a couple weeks ago is automation, what that's going to mean in a decade or so. Speaking of the interest rates, look for net interest margins. That's what people will be kind of honing in on when they look at the reports. Also, when you think about banks, they're not all the same. They're not monolithic. But, I mean, I would just look at the equity capital markets side of the business just because of the IPOs we've seen, or lack thereof, that we've seen lately. That's just something that I would like to look at. Also, M&A activity at some of the bigger investment banks. And then there's the trading activity, whether it's the fixed income or the equity trading. So, again, sometimes you'll see something at one bank and you think, okay, this is going to set the tone for all. and then you realize that it's
all
not
different.
all the same. And also, you can get a read on the consumer, mostly at the JP Morgan Chase, Wells Fargo. Citigroup's also great to look at when you're thinking globally, because it's one of the biggest global banks out there. So lots of details to read into.
And you look at Deutsche Bank and what has happened with DB, and now that is its own case. But you talk about equities trading, I mean, basically shutting down that business moving forward, laying off a bunch of people. Now, the headline you mentioned, we did discuss on this show that automation will supposedly kill, wasn't it like
200,000 jobs.
Over the next, decade?
That was Mike Mayo over at Wells Fargo. But another thing worth watching is that at Wells Fargo, as a separate point, the new CEO just got put into place, Charles Scharf, formerly from Bank of New York Mellon. So interesting to see his kind of wrangling of the analysts on his first call tomorrow.
That's a good point.
Yeah, that will be interesting. A new Wells Fargo CEO. A job that doesn't necessarily seem like the hottest job in town.
I said no.
Maybe there's a reason it took so long to find someone.
If you can turn that around, that would be such a great comeback story. And for your legacy as a leader, that could be phenomenal. But I mean, it could happen.
As we mentioned, bank earnings coming up. That'll be really interesting. As you said, a good temperature-taking moment for the economy. Exactly. But of course, I'm a little more excited about Netflix, as we discussed earlier in the show. Netflix coming Wednesday. That's always a big, big day for us. Big, exciting day to look at Netflix earnings. All right, that is the show for today. That is Wi-Fi AM. Thank you for watching. We will see you right back here tomorrow. And we want to remind you that you can go to yahoofinanceams.com to watch clips from our great All Markets Summit. That was last week, where we had all manner of big business names talking about the economy and about their businesses. Now, don't miss On the Move. That show starts next at 11 a.m. That's in just 2 minutes, so stay right here on yahoofinance.com.
Just another manic Monday here in New York City, 11 a.m. We are 90 minutes into the trading day, and take a look at what's happening. We are gaining now on the Dow. The S&P 500 and NASDAQ have gone into positive territory. We're going to hit all of that as we dive deep into the stream. Deal or no deal? A new report says China wants another sit down before it signs President Trump's highly touted phase one of the trade deal. Stepping in, WeWork investor SoftBank reportedly looks at taking over the troubled company. And money problems, what you need to know as several big-name partners drop out of Facebook's digital currency, Libra. Hello, everybody. Welcome to On the Move. I'm Adam Shapiro. Let's talk about the markets right now because we have seen all three of the indexes go into positive territory. Inez Ferre is standing by on the floor of the New York Stock Exchange with the latest. What's driving us upward?
Yeah, I was just talking to Tim Anderson about this, and he was just telling me, look, expect to see the markets kind of go into this positive territory as we saw on the heels of Friday's announcement that we had those reports over the weekend of perhaps holding off the champagne. But overall, the feeling is here that there may be something from this phase one, and Tim's saying to me, look, any deal is good for the markets, and certainly this is something that investors and that traders here are paying attention to closely. You're looking at the Dow that's up about 40 points right now, and he also noted we are holding the gains from last Friday. If we take a look at the Dow components, Nike is one of the best performers on the Dow right now. This is after being upgraded at Bank of America Merrill Lynch to a neutral rating with a price target of $98. The analyst note highlighted the accelerated democratization of the world's biggest sports brand. And also we're watching this morning CrowdStrike under pressure after a bearish note from Citi, with Citi initiating CrowdStrike with a sell rating and a price target of $43. The note says that the trajectory is impressive, but the market opportunity just doesn't enable a sustaining of a growth for CrowdStrike. Now on Friday also you had Goldman Sachs that came out with a bearish note with cutting their rating on CrowdStrike to sell from neutral. And then we're also watching Beyond Meat, a little bit under pressure. Beyond Meat has been under pressure over the last month. It was initiated at Wells Fargo with a market perform rating and a price target of $125. But of course, Adam, as traders here are watching any developments that have to do with a trade, and also this week they will be watching for the bank earnings and retail sales, which will come out this week, which will kind of give a gauge of the consumer and how strong the consumer is, Adam.
Inez, thank you. We've got breaking news about Smile Direct Club and want to go to Brian Sawsey to explain what this truly means.
Yeah, complicated release here, just hitting the wires, Adam. Basically, California Governor Gavin Newsom signed a bill stating that the dental board continues to have oversight over operations in California. And you're seeing Smile Direct shares get absolutely slaughtered here. What this basically means is that Smile Direct Club, they won't have to cease operations in California just yet, or probably not over the next year per se, but it's going to be hard for them to expand in such a key market.
It says from the release, while this bill does not preclude Smile Direct Club's continued operations in California, it will create unnecessary hurdles and costs to Californians that need care but struggle to afford it. And you can see what's happening with that stock price right now.
Yep, I think this release highlights all the risks or the concerns you've seen since the company went public a couple of weeks ago. Teledentistry remains a big risk going forward.
Okay, we're going to keep an eye on Smile Direct, but the other risk out there is what happens to your investments regarding China and the trade deal or lack of a deal. Deal or no deal? New reports say China now wants another round of trade talks with the United States before it signs phase one of the deal. The two countries agreed to a temporary truce Friday. Let's go to Washington. Yahoo Finance's Jessica Smith has the latest for us. What is it?
Well, China says that the two countries made substantial progress in Washington last week, but the Trump administration said they agreed to phase one of a deal, but it just needs to be put on paper. Treasury Secretary Steven Mnuchin says that agreement includes IP, it includes agriculture, currency, and financial services. He really tried to bolster confidence in this deal this morning. Let's watch.
This is like when you buy a building, you've reached an agreement to buy a building, and now you got to negotiate the contract. There's execution work to be done on the document, but this document is substantially done. We made a lot of progress, and our expectation is this will be concluded and signed by Chile.
Mnuchin went on to lay out the plan for negotiations over the next few weeks. He says there will be a deputy-level phone call this week, a principal-level call next week, so that will be with himself, Ambassador Lighthizer, and the vice premier. Then the deputies will meet between now and the APEC summit in Chile, and then the principals will meet again in Chile one more time before Trump and Xi come together to finalize the deal. Now, the Treasury Secretary went on to say that if they need to have more in-person talks to get this done, then obviously they'll do that. Now, we won't see a tariff hike tomorrow. They were scheduled to go up to 30%, but now that is off the table in light of this agreement. But there's no plan to remove existing tariffs at this point. And this next round of tariffs, scheduled for December 15th, is still in play. Mnuchin said if there's no deal by that point, those tariffs would move forward, but he expects a deal to be done by December.
Jess, thank you. We're joined by today's panel. Yahoo Finance's Brian Sozzi and Dan Howley. Also joining us from Washington is Scott Kennedy, CSIS Senior Advisor and Trustee Chair in Chinese Business and Economics. Want to read you something, Scott, from the China Daily, which was out this morning, and it is, quote, "But while the negotiations do appear to have produced a fundamental understanding on the key issues and the broader benefits of friendly relations, the champagne should probably be kept on ice, at least until the two presidents put pen to paper." Now, we have been at this moment before, almost a year ago. There was an agreement in principle and then nothing. Why are you optimistic that this time we might get something?
I'm actually not very optimistic that we'll definitely get something. In April of this year, they had 150 pages of agreed text, and then the Chinese backed out of that deal. And the Americans criticized them, and the Chinese just responded, well, nothing's agreed until everything's agreed. Here we don't even have a piece of paper to start with. And so the range of issues they're discussing are narrower, so they might be able to get a deal by APEC. But I really think that the only thing that happened of significance Friday was the delay of the tariffs that were supposed to take effect tomorrow.
We spoke with Eric Trump at Yahoo Finance's All Markets Summit. And he gave us his thought on how his father is handling China. I want you to respond to this after we listen to him.
Sure.
I don't think there's anybody that's been tougher on China in the world than my father has been. And you see it, right? We have the best economy in the history of our country, and China's down by 27% this year. A lot of that's because of the tariffs. You see, and I talk to people all the time. People come up to me all the time. You know, I produce X, I produce Y. I'm moving my business out of China because, quite frankly, I don't want to be in the middle of this trade war between the two superpowers of the world, and it's just much easier for me to go produce product in Vietnam or Pakistan or India or one of 100 different places.
Scott, I'm not sure what he was referring to when he says down 27%, but we do know that exports from China to the United States have suffered. The Chinese economy has suffered. So what do you say to Eric Trump about how President Trump is handling this?
Sure. Well, certainly China's economy is taking it on the chin as a result of the trade war, and if we were to fully decouple, it would be devastating for China's economy. On the other hand, the original goals, if we all remember, were to increase U.S. exports, shift investment from China to the United States, and constrain Chinese industrial policy in a way that previous American presidents hadn't been able to do. And we've not achieved any of those three goals. So yes, China is suffering, but the American economy, even though it's doing well right now, it's not because of the policies that we've had towards China. It's a result of other things. And so I don't think we should give ourselves a grade yet until we see if we can accomplish those goals that the administration has set out.
Scott, Dan Howley here. A lot of hay is being made about this deal, but this really isn't the big deal that Trump had been wanting for so long, right? This is still that smaller deal, and now it's kind of getting more momentum, but it's not the major full-on end of the trade war deal that we've been talking about for, feels like forever now.
You're right. We've been talking about, trying to, put a governor on Chinese industrial policy. That was the why in August of 2017, the administration launched their famous 301 investigation about intellectual property rights, issued a report in March of 2018 finding China essentially guilty, and then starting negotiations and increasing tariffs 3 times. And we keep talking about issues that are smaller and smaller, and we keep the issues that were originally generating the conflict seem to be being pushed further back. And so I'm concerned that we're focusing on ever smaller issues, and the big issue isn't going to be addressed during the first Trump term.
Scott, actually, yeah, that's what I wanted to ask you. Do you think the president can make it to phase 3?
Well, let's see if we could get, I think phase one really kind of is like phase zero. We basically have a list of stuff that we might get a deal around. My sense is that the Chinese have lost trust in the Trump administration, that if they make a deal today, the Trump administration will follow through tomorrow and never change their position. And China's economy is doing well enough, even though their stock market is up, that they think they can just wait the Trump administration out and wait until January 2021 and start with either the second Trump term or a new term with Democrats in office. So I think it's going to be really difficult to get to where we had aimed for a couple years ago.
Scott Kennedy is the CSIS Senior Advisor and Trustee Chair in Chinese Business and Economics. Thank you for being here on The Move.
Sure.
SoftBank is seeking to take control of WeWork through a financial package that would further sideline founder Adam Neumann. WeWork recently pulled its plans for an IPO, and Neumann resigned as chief executive under pressure. We want to turn to the panel on this one. Brian Sozzi, if all of this goes through, isn't there a potential for Adam Neumann to use some of the money, whether it comes from SoftBank or if they get the financing from JP Morgan, to pay off, what was it, almost $400 million in personal loans?
Well, he's just the chairman right now. I think that is a very good question, and I think that component of this is unclear. The question here is, if you're at JP Morgan, why are you loaning this company money? By all intents and purposes, we dug into the S1. They may not be in business. It's that simple. They have not proven that this model works. I get why SoftBank is involved here. They have a lot of face to save because they have been completely embarrassed throughout this whole process. So I see them getting involved. But if you're at JP Morgan, why are you stepping up here with $5 billion?
So is the value in WeWork? Adam Neumann tried to convince us they were a tech company, but it's really the assets. It's the buildings that they might own.
Yeah, and they're one of the largest commercial property owners or holders in a lot of cities. So this is a big deal. If the company does go under, then that's going to be a lot of empty commercial real estate in certain areas. And I think that, the idea of this company being a tech offering was just kind of a ploy to make it seem like it's an Uber or a Lyft. And it really was never like that. It happened to come at a sweet spot in time where we saw a bunch of tech IPOs coming out, and they kind of jumped on board and said, oh, hey, we're a tech company.
Well, remember blockchain? Remember when they would just put blockchain into their press releases and people?
Oh, we're a tech company. We do blockchain. Yeah.
Well, they do carefully study or creepily study the workers and how that workplace flow works. They do have some data.
But let's get back to SoftBank. Okay, they need $3 billion to free up $6 billion in loans. Mm-hmm. Why would JPM put that kind of money on the line? Mm-hmm. SoftBank is in a rock and a hard place because if they allow it to collapse, pennies on the dollar for them.
I think it boils down to the relationship. Jamie Dimon, CEO of JP Morgan, Adam Neumann are for all intents and purposes, continue to be close. Jamie Dimon was one of the first people to throw confidence on Wall Street to an Adam Neumann. And I think that's a big part of it here.
And it's not just SoftBank on the line. I mean, I don't recall everyone who was in the different rounds of funding, but Fidelity, I think, has about $500 million into this company.
PayPal invested $500 million before the company went public.
It's just interesting because the way this all kind of came together.
Sorry, that was Uber.
Oh, yes. The way the S1 came out, once it hit and everybody started kind of going through it, they were left scratching their heads thinking, how is this even viable? What makes sense about this? The fact that Neumann owned or used money from the sale of shares to purchase properties that then he would rent out to the company itself. None of that seemed to really square. And I mean, the fact that SoftBank went along with it for so long, I mean, it really...
Than the Bitcoin blockchain. So that is a fair distinction. A lot of times I always like to say that a quick hint that someone doesn't know what they're talking about when they talk about this industry is when they say the blockchain, like there's just one big blockchain in the sky. But yeah, it hasn't launched yet. And I think the big question now is it going to launch? Now, of course, what all the crypto believers have said is, well, Libra doesn't need Visa, MasterCard, and PayPal to succeed. And I think that's a fair point. I mean, I think if you look at Friday's kind of afternoon news dump where all these founding members of the Libra Association dropped out, there's a way to look at it and say that this is a black eye on both sides. Because if you're Visa and MasterCard, why were they ever on board? I mean, it was surprising that they were ever on board to begin with, less surprising that they have now backed out after all this pressure from lawmakers. And on the Libra side, it was nice that they got to have these big names on board, but hypothetically, if its plan is to succeed, then it should be continuing apace, regardless of whether Visa, MasterCard, and eBay are signing on. And now when you look at the companies that left, It's the big financial payments names. It's sort of unsurprising. They're all the payments names, and the companies that are still on board, which is still 22 of the original 28 founding members, are crypto companies. So of course they still support.
And the plan was to grow over time to 200. It's still going to be headquartered in Switzerland, right, in Geneva?
In Geneva, and there's a meeting this week for all the Libra Association backers. So obviously Visa, MasterCard, eBay, Stripe won't be there, but Andreessen Horowitz, the most influential VC firm on the planet, they are still a founding member, and they are going to be at this meeting. And I think that you'll see that Libra will continue, but the pressure and the negativity from lawmakers is not going to stop.
Dan, is this just a Facebook thing? Could PayPal try to get into this market?
Oh, I think absolutely. I mean, a lot of these companies, they've moved from originally saying, we're doing blockchain stuff. As you said in an earlier segment, Adam, a year ago, it was the moment of put out a press release and say, hey, we're doing a blockchain test pilot. And maybe nothing comes of it, but at least they get to show, we know blockchain, we're hip. Now, more of those companies are actually saying that they're hiring people for blockchain-related purposes. They're looking into doing tokens, whether that's a security token or a pure play cryptocurrency. So I do think that what all the other companies get to do, which is nice for them, they get to just watch Facebook take all the heat. And it's like putting Facebook out at the front of the front lines in Game of Thrones before the battle. Facebook takes all the arrows and gets shot up and use Facebook as the shield. And then when the dust settles, other companies which have now learned from Facebook of how to or how not to do it, they come out and they launch their own crypto.
I'm going to quote you to yourself in a second, but first, Yahoo Finance's Scott Gamm spoke with CFTC Chairman and Chief Executive Heath Tarbert about regulating Libra. Here's what he said.
I think all the federal regulators now, as well as other parts of the U.S. government, are studying Libra and seeking to understand sort of exactly how it works. And so we're undergoing sort of a thorough analysis to determine exactly what Libra is and how it would be regulated. But at this point, we haven't come to any firm conclusions. At least I can speak from the CFTC.
Okay, to understand this, I want to go back to something you said earlier, Andreessen Horowitz. There really isn't much more you need to know. I mean, as you said, one of the most influential VC firms, but they certainly understand blockchain. They certainly would understand how to make a go of this.
That's true, and there are other partners on board. Look, Coinbase is still a founding member as well, and that is the biggest U.S. crypto exchange, and that is the company that most people think will be the first crypto industry IPO. But from lawmakers' perspectives, so what? I don't think, Andreessen or other companies that are already huge investors in the space and have a huge stake in cryptocurrency succeeding, I don't think their involvement would convince any lawmakers who are really obsessed right now with going after Libra that Libra is actually safe and is okay. I mean, Steve Mnuchin this morning was on CNBC arguing that, don't give too much credit to Senators Sherrod Brown and Brian Schatz, who sent a letter to MasterCard and Visa, because we at Treasury also sent letters. So it's sort of funny to me because it's like every politician right now wants the credit for going after Libra. That's the hot thing of the moment, is to go after Libra.
Well, we're going to keep an eye on it. We got to wait for presidential candidate Elizabeth Warren. Loves to beat up Facebook. Right. She's going to have something to say, perhaps. Dan, thank you.
Thanks.
Coming up, trouble in the skies. Boeing's board of directors punishes CEO Dennis Muilenburg over the 737 MAX scandal, plus fighting to end global poverty. Why 3 professors were just awarded the Nobel Prize in economics. Earnings season is just getting underway. Major U.S. banks like Citigroup, Goldman Sachs, JPMorgan Chase, Wells Fargo, they will be out with their third quarter results tomorrow. Johnson & Johnson will post their results as well before the opening bell. A lot of big companies are going to report as the week goes on. So what can investors expect from Q3 results? Joining us now, Stuart Kaiser, UBS cross-asset macro strategist. What do you think? We're being set up for contraction in earnings growth, but are we going to be surprised?
Our U.S. equity strategist thinks the deceleration in earnings is real, and it's driven by the growth slowdown we've seen. So the bar is set pretty low. I think operating earnings are looking about 2.1% down year on year, which is a fairly low bar. And I think most companies have in recent weeks sort of tried to guide expectations a little bit lower. So that's probably similar to what we saw last quarter, to be completely honest with you. And the result there was about 60% of companies that sort of made large moves on earnings did so positively. So hopefully the bar has been set low enough that any surprises are to the upside instead of the downside.
Wanted to get your thoughts on trade. The general consensus on Wall Street is that this phase one or whatever we just got on Friday didn't accomplish a heck of a lot. Any reasons for investors to be a little more optimistic today than they were a week ago?
I'd agree with you. I think most investors' mindset has been you sort of fade trade headlines in both directions. If they're too good, they're probably not going to turn out that good. If they're too bad, hopefully, rationality will all sort of come to the fore. I think if you're going to think of what's the positive is they've agreed to something. They're talking. Trump was willing to delay the tariffs, which from an incremental basis, you would argue maybe reduces the downside risk a little bit. But, I think most investors we've talked to, we were in London last week meeting with investors as well, I think would share your kind of skepticism.
So they're not inclined to put more capital to work off of this news?
I don't think so. I think at best what you've done is maybe you've not changed the sort of modal growth outcome, but maybe you've trimmed the tail off a little bit. And, arguably that might get people a little bit incrementally a little bit more positive, but it doesn't feel like a game changer. Our economists don't see what's been agreed to as a game changer on growth, and, we'll go from there.
So if you look at the S&P 500, the last 52 weeks up until last week, we were flat. We've been range bound, 2,750 to 3,000?
Yeah.
The volatility ahead with China, we could still be flat by the end of this year. But you see opportunity in all places. Germany, the DAX actually, why?
Yeah, from our analysis shows DAX is quite sensitive to trade headlines. The sector mix is appropriate for sort of trade. It's a lot of materials, a lot of autos. Europe, obviously, sentiment towards Europe has been fairly negative. So for investors that do think there's more follow through to the trade headlines than we necessarily do, we think DAX is a very good way to express that. Emerging markets would be another way, but DAX is, I think, the way that we've historically guided investors, at least globally. Within the U.S., hedging wise, we think NASDAQ or large cap tech is the way to hedge if you're going to get a reacceleration in the trade concerns. So those are kind of the barbells, I guess, that we'd be looking at. Russell will be another one to think about. Sorry.
The DAX, it's interesting you mentioned that because the DAX has started to break out. Despite all the negative news on Germany, what is driving that breakout?
I think some conversation amongst investors that the data's been so bad in Europe that arguably is starting to bottom out a little bit. You did get a lot of easing from the ECB. You got some easing from the PBOC and the Fed as well. So I think there's some view that hopefully things have maybe bottomed out a little bit. Again, I think generally speaking, people are a little skeptical of the move. It feels like once or twice every year, people try to get behind Europe and how that's going to outperform the U.S. And by and large, those have not really been sustainable. So I think it's a little bit of a sentiment piece and it's a little bit of a growth sort of stimulus piece that is playing into that.
Are the people within your organization giving you any sense of what they're projecting for end of year, where we're going to be on the S&P 500? We've had analysts on who said we'd be above 3,000.
Yeah, our U.S. strategists are much more conservative than that. We're at 2,550 for year end for the S&P, and that's really predicated on the earnings story, which is once you hit negative year-on-year earnings growth, which is arguably where we are or where we're near, that'll be sort of a big drag on equity markets. Our U.S. economists, because of the trade impact, have quite a bit of slowing in the first half of next year, and you would expect equities to eventually sort of be pulled down by that. Hasn't happened yet. As you mentioned, sort of a 2,800 to 3,000 range. So our view is more negative for U.S. equities into year end on the strategy side, and unless the trade headlines manage to change.
And did I hear you correctly? 2,550 or
2,550? Yeah. So that's our year end target for S&P. As again, earnings coming down, growth slowing first half of next year. Markets start to reflect that, and then hopefully as we move through the first quarter or first half of next year, we get a recovery.
Can it happen after Christmas? I need some gifts. That's pretty depressing.
Yeah, I think after last year, there's a lot of scars on December trading.
Stuart Kaiser, UBS cross-asset macro strategist. Thank you for being here.
Thank you. Appreciate the time.
A big change at Boeing as the company continues to deal with the fallout from the 737 MAX crisis. Yahoo Finance's Alexis Keenan joins us from the newsroom with some changes, but not really. Well, is it a huge change what they did to Muhlenberg?
Maybe. So Boeing announced on Friday that it would remove Dennis Muhlenberg, CEO, as the board's chairman. Now, he will remain CEO, president, and also a director still. He just will not have that chairman title. That role is being split. Going forward, the role will be handled by and filled by David Calhoun. He's been a board director at Boeing since 2009, and he's been a lead independent director since 2018. He previously ran GE's aircraft engine business, so he does have some aerospace experience there. Boeing also announced in that statement on Friday that it will add an additional director who has what they say is deep safety experience. We're still waiting to hear who that person will be. The purpose of this change, Boeing says, is to allow Dennis Muhlenberg to focus on returning the 737 MAX to service. The announcement, though, Adam, came just hours after a report was issued by joint authorities, regulators, aviation regulators around the world, a report that we have long been waiting for, that deeply criticized both Boeing as well as the FAA as to how the certification process for the 737 MAX happened. They said that the documents that were submitted by Boeing to the FAA in that process, and particularly concerning the MCAS system known to be involved in both plane crashes of Ethiopian Air and Lion Air, was deeply fragmented, and it made it difficult, they said, in order to recognize how impactful the MCAS system would be. Now, in response, Dennis Muhlenberg said, "I am fully supportive of the board's action. Our entire team is laser focused on returning the 737 MAX safely to service and delivering on the full breadth of our company's commitments." Boeing has maintained that it would get that aircraft back into the air in the fourth quarter, though Boeing still has not submitted to the FAA its proposed changes for the MAX, and we do expect that the evaluation by the FAA would take 2 to 3 months. So that's putting us in a really tight time frame here if Boeing is to get this back in the air in December. Perhaps the company will have some luck if one of President Trump's tweets does come to fruition. On Saturday, the president tweeted a little bit about Boeing, saying that on China trades, he was mentioning mostly about agriculture and a potential deal there. He said, with other aspects of the deal are also great: technology, financial service, and 16 to 20 billion in Boeing planes, etc. So we're waiting here, Adam, and it's getting late. The fourth quarter's here, and still waiting for that FAA submission.
Alexis, thank you. We're going to keep talking about Boeing with the panel. David Calhoun, what do we know about him? I mean, you know GE really well. What do you know about him?
Well, yes, obviously a former executive at GE, but also he's also served as a senior managing director and head of private equity at Blackstone Group. So clearly this is a guy that knows his numbers, knows his operations. Now, where do I think this will play out? Dennis Muhlenberg is supposed to testify in front of Congress October 30th. But anytime you see reports, especially leaked over the weekend, that Calhoun has looked at as a potential successor, you may have Muhlenberg just testify, take one for the team, as he should, and then you replace him coming into the year.
Forgive my lack of scientific expertise. I have a nephew who is a pilot who explained to me this MCAS system, that in the case of the Ethiopian and the Lion Air crashes, there was a feature you could have added on, like when you buy a car and you get an extra and you pay more. The airlines could have bought that, and it would have been a fail-safe against the MCAS system failing. U.S. airlines have it. Other airlines didn't buy it. It should have been mandatory, but that would have required greater training, which is what Boeing was trying not to do to control the costs for the airlines. They're going to have to do this, aren't they? They're going to have to make that standard.
Yeah, I mean, it really is interesting the way, you just described it as an extra for a car. Like, you're not getting the, undercoating with something like this. This is a serious feature that should have been included, and it's amazing that Boeing managed to sell these planes without also requiring it, but obviously that'll change going forward. I think for the average flying public, this still kind of feels too distant. It's difficult to figure out what kind of type of plane you're on. You really just want to make sure you get to the airport on time. So I don't necessarily know if people are going to, see this news or continue to hear about this news and be concerned about the type of plane they're flying on. I think mostly this has to do with where Boeing goes from here, because it's really shaken the confidence in a company that was set to sell these planes by the truckload, I guess plane load. What would that
Oh,
be?
they're in the
large
parking lots
volumes.
right now.
Right,
So where do they go from here? And as you said, maybe Muhlenberg after he testifies.
Boots coming probably.
All right, coming up, Libra or Leper, why companies are fleeing Facebook's cryptocurrency project. Plus, before we go to break, take a look at some of the top trending tickers right now on Yahoo Finance. Beyond Meat is going down. It is 11:34 here in New York City. We are 2 hours into the trading day, and we're getting a mixed picture on stocks. Dow is up, S&P 500 has fallen back into negative territory barely. NASDAQ up a few points. We're going to deal with that in just a bit, but oil is trading down right now, $53.25 a barrel. Cashing out, why several big names are bailing on Facebook's digital currency plans. Lawsuit frenzy, how numerous legal woes could impact Johnson & Johnson's earnings. They're out tomorrow before the opening bell. And Fortnite fans are in a frenzy. Panic reigns as the popular game goes offline. Or are we all just really part of the Matrix? And they're making fun of us right now. Welcome to On the Move. I'm Adam Shapiro. Let's go to London because 3 economists were awarded the Nobel Prize in Economics today for their, quote, experimental approach to solve global poverty. The 3 laureates were among the first to attempt to measure the real-world effects of poverty alleviation efforts. Yahoo Finance's Oscar Williams-Groot joins us from London with more. Tell us about the winners and what they actually did to win.
Adam, the 3 winners are Abhijit Banerjee and Esther Duflo from MIT and Michael Kramer from Harvard, who jointly have been working since the late 90s to try and alleviate poverty globally, as you said. Now, the big innovation was to try and break down the problem of poverty into smaller, manageable chunks. We all know that millions of people around the world live in poverty, but how can you actually make a difference? They ran field experiments to test things such as, do free school meals or free textbooks in developing economies make a difference? Actually, they found it doesn't make as much of a difference as targeted support for weaker students. So that's one instance where they can actually then direct money towards those types of more impactful changes. The Nobel Committee said that their researchers considerably improved the ability to fight poverty and transformed development economics. Now, a special word for Duflo, who is only the 2nd woman in 50 years to win the Nobel Prize for Economics and is also the youngest person ever to win the prize at just 46.
All right, we're going to shift gears right now to cryptocurrency. Global regulators are sounding an alarm on Facebook's crypto project, Libra, saying it could lead to financial instability. So what does the road ahead look like for the effort, at least on the regulatory front?
Well, the road looks pretty bleak for Facebook at the moment, Adam. This, of course, comes after last week when multiple members of the Libra Association left on Friday, this massive exodus on Friday. And today we had this report, the Financial Stability Report. The chair of the Financial Stability Board has written to G20 leaders to warn that that Libra risks replacing national currencies, and it could become systematically important and pose a financial stability risk. As a result, they're saying they don't want it to start unless it's meeting the highest standards of financial supervision. Now, Facebook has said in the past that it would not launch Libra until regulators around the world are satisfied. But this is the latest in a long line of worries from regulators globally, and it shows that the pressure continues to mount. And this pressure is part of the reason why we are seeing this exodus of members. That's because a lot of them signed up thinking, well, this is just an interesting product, we want a seat at the table, and now financial regulators, politicians around the world are saying, actually, we want to know how this is going to work, and they are getting cold feet. So for Facebook, this is more bad news after a difficult week.
Oscar, we're going to keep talking about this more on Facebook and Libra as the defections by high-profile partners continue to plague the digital currency project, with Booking Holdings being the latest company to sever ties. With us now to discuss all of this is Brian Leach, founder and CEO of Ibotta. Brian, it's good to have you here. Help me understand something. I live in the United States. I benefit from the dollar being the reserve currency. The regulators are worried about Libra, but I would imagine cryptocurrencies in general have the opportunity at some point to replace fiat currencies worldwide. Are they right? Could one day the dollar be irrelevant? Could other currencies be irrelevant, or is this much ado about nothing?
Well, it's possible down the road. It's possible that you could have a blockchain approach to payment that takes a substantial amount of the current friction and cost out of the process, ultimately benefiting merchants and consumers. And that, I think, is the promise of some of these blockchain currencies. But we're very, very far away from that. We've yet to have a single cryptocurrency that's actually a stable coin. There's so much fluctuation that you need some form of monetary policy. And that ultimately ends up today descending into a fiat-backed system. I believe in the future, if we could solve that problem and have a more stable currency, the concept of registering payments in a decentralized set of computers managed around the world is one that holds a lot of promise.
Brian, Dan Howley here. I wonder, is it really just that there's a lot more scrutiny from lawmakers on Libra, that these companies are dropping out, or do they just not see a future in it? What's really going on here?
I think what's really going on here is that this represents a massive disruption to the business model of Visa, of MasterCard, of many payment processors like Stripe and others who are backed financially by the incumbent payment networks. And when Facebook comes along and says, we're going to do away with traditional payment processing, that is a threat to the core business model of PayPal, of Visa, et cetera. I think they wanted to be seated at the table to understand before anyone else what that disruption might look like. But it's always been a little bit of a strange bedfellows arrangement, and I'm not sure their interests are completely aligned.
But Brian, Facebook clearly wants to get into payments in some form. So if Libra doesn't work out, why don't they just go out there and buy a PayPal?
It's a good question. I think Facebook needs to understand how to the intersection between a consumer-facing product like a social network or a rewards platform and the adoption of currency. Just because you take cost out of the system and you have a blockchain currency doesn't mean consumers will care. Consumers are pretty happy with their credit cards and debit cards. They're easy, mobile, and secure. So what is the value proposition that causes you to change your behavior if for the last several decades you've become accustomed to using plastic? And I'm not sure PayPal has solved that. Facebook is trying to understand how to do that using a number of different psychological or consumer propositions, one of which may be rewards in conjunction with Libra. But they may also realize that the regulatory landscape and the reputational constraints that they face and antitrust scrutiny that they face is such that they have no choice but to try to build this themselves versus aggregating through acquisitions.
But Brian, I am curious because as a lot of us who have grown up using credit cards or switching to, using digital payment with our phones, a lot of the world doesn't even go that route. They went straight to the phones. So it seemed to me Facebook is going to succeed in what they're doing when you consider how many hundreds of millions of people in developing countries are unbanked. Now, it may take 20 years, but it seems like that's the future.
I agree. I think there's definitely a future that does not involve the same degree of reliance on payment networks that we have in the United States. If you look in China, payments are settled directly with merchants, and they're settled and facilitated through WeChat and through Alipay and other mechanisms that have a fraction of the cost. The United States spent $90 billion in interchange fees last year. That's almost 2% of our entire retail economy. That is not sustainable. And I think both from the perspective of helping the unbanked, but also from the perspective of helping merchants more broadly settle transactions more efficiently, it's just a matter of time.
Brian, here in the U.S., we still haven't caught up with the rest of the world as far as mobile payments go with things like Apple Pay or Google Pay. That's an easier way to make payments versus a credit card. You just tap and go. Introducing something like Libra feels like an additional friction point for a lot of consumers. Do you think in the U.S. something like that is going to catch on, or do you think it's something that's just going to pass us by?
I think it will absolutely catch on if they understand how to bring consumers value that it goes beyond just convenience. The reason why we haven't had faster adoption is because we have stressed that this new form of digital or mobile payment is easy, mobile, or secure. But credit cards are easy, mobile, and secure. And in fact, Apple Pay and Square and others are largely just a digital representation of that same credit card settled in exactly the same fashion. To get people to adopt a more direct form of cryptocurrency or blockchain or paying with another form like stored value or branded currency, you have to cut the consumer in on the deal, make them feel like there's something more for them, some value they get that they couldn't get with a credit card. In essence, sharing the savings that the merchants are gaining through these more efficient forms of tender back with the consumer, because otherwise there will never be an efficient choice of tender in the market, and consumers will continue to choose the same payment methods they always have.
Brian Leach is the founder and CEO of Ibotta. Thank you for being here on The Move.
It's a pleasure.
Coming up, there could be a breakthrough in the GM strike that puts thousands of workers on the picket line back on the factory line. Plus, the deadly typhoon that hit Japan killed almost 50 people, and several more are still missing. Kurdish forces in northern Syria have asked Russian-backed Syrian forces to join them in battles against Turkey. President Trump allowed Turkey to invade northern Syria when he announced the withdrawal of U.S. troops who had previously been allied with the Kurds. The typhoon that hit Japan over the weekend killed at least 48 people and caused severe damage in central and northern Japan. 17 people are reported missing. Forecasters say the rain will continue throughout today, exacerbating flooding and making it difficult to assess the total damage. The United Auto Workers strike against General Motors enters its 5th week despite meetings over the weekend to bring it to an end. The Detroit Free Press reports there may be a breakthrough on health care issues. The UAW increased strike pay to $275 a week for auto workers who are on the picket lines. The hit movie Joker earned another $178 million at the weekend box office, bringing its U.S. total to $544 million. Will Smith's Gemini Man, The Captain, The Addams Family, and My People, My Country round out the top 5 at the box office. Johnson & Johnson is set to report third-quarter results before the bell tomorrow. Now, the news comes amid what has been an interesting year for the pharma giant, which has seen several court decisions, including a recent $8 billion jury verdict, not go its way. Joining us is Reason Foundation policy analyst Jacob Rich. And Jacob, Johnson & Johnson faces several battles, but let's put it into context. $82 billion in pharmacy-related revenue last year. Total awards, these are punitive damages and jury awards, of about $13 billion this year. Can J&J get past all of this to a moment where it's not going to hit them as dramatically?
It'll completely depend on the verdict that comes up in Cleveland later this month. So basically, the Oklahoma trial that went forward, that was about $572 million rewarded to one state. Those amount of damages are definitely something that Johnson & Johnson can take, but there's going to be hundreds of municipalities in Cleveland that are going to be litigating over damages. And Mike Moore, who is the ringleader of all of the cases that are going against Johnson & Johnson and other pharmaceutical companies at the moment, he wants to grab about $100 billion at least. And with net income of about $15 billion for Johnson & Johnson, the time period for them to pay that back will basically be dependent. Okay. That will be the major factor if they can pay it back.
Let's simplify this a bit. You just mentioned Oklahoma. That was a verdict regarding opioids. The others settled, by the way. Johnson & Johnson didn't. So when we talk about just opioids, because the $8 billion punitive damage award was not about opioids. But you point out, when it comes to opioids, that the data that we're all using and that they're using in these cases is somewhat flawed. For instance, Florida said that they had 5,700 opioid overdose deaths in 2016. Centers for Disease Control said it was 2,700. And then you've got the issue that 30% of, I think it's opioid deaths are caused, or 75% since 2017 were caused by black market fentanyl or heroin. So why should a Johnson & Johnson or the other opioid manufacturers be held accountable?
It's not very clear that they should be held accountable. We really need to make sure that the relationship between prescribing and addiction rates is actually true before we blame any of the pharmaceutical giants for opioid distribution, and that distribution may be causing addiction. If you look at the Substance Abuse and Mental Health Services data, this is a department under HHS, the Department of Health and Human Services. They actually measure addiction rates to pain relievers. They measure non-medical use of pain relievers, and they also look at opioid abuse rates. And all of those rates seem to be stable since 2002. There has been some pushback that those data may not be as accurate as we like, but if those data are accurate, it seems that addiction rates in this country have been stable. And if addiction rates are stable, you can't blame companies for causing addiction.
Jacob, this most recent ruling, the $8 billion, obviously that's probably going to be reduced, wouldn't be that substantial, but, it seems it's just hit after hit for J&J. What do they have to do to kind of overcome this? And then where do they go from here as far as regaining shareholder trust if they're hitting these issues one after the other after the other?
Well, first, they need to acknowledge that the opioid crisis is a terrible public health situation. We had about 70,000 people dying of drugs in 2017 alone, about 47,000 of those deaths attributed to opioids. So first, Johnson & Johnson needs to show to the public that it actually cares about what's going on. But while it shows consideration, it should be honest about the data. And whenever the courts bring up accusations that seem not to be true, as many attorneys general seem to do, they need to be completely upfront, show their sources, and try to regain trust in just a forthright matter.
But Jacob, I'm going to ask you this question, and I'm neither defending nor, prosecuting Johnson & Johnson. But it seems that the opinion within the society is not to trust a big company. And you just brought up opioid deaths. And again, I'm going to cite the statistics you gave us from the government that in 2017, over 75% of the overdoses caused by opioids were black market fentanyl or heroin. Again, why should Johnson & Johnson have to prove its case to a public that may not be willing to hear it, even if it's legitimate?
Well, Johnson & Johnson, even though I'm on the side that, from the data I've seen so far, I do not think that their actions have led to more addiction. I think it is incumbent on Johnson & Johnson to prove that and to make that case to the American people. And the reason why people are actually going after Johnson & Johnson isn't because their drugs are causing the deaths. It's because the prescribing of their drugs led to addiction, and then those addictions led people to seek out heroin and fentanyl on the black market. So causing addiction in the first place is what Johnson & Johnson is being blamed for. They're not being blamed for the majority of deaths at the moment.
All right. Jacob Rich from Reason Foundation, you are a policy analyst. It's good to have you here on The Move.
It's a pleasure to be here. Thanks for having me.
Fortnite fans are in a frenzy. That's after the game disappeared into a black hole. You should go, if you can go onto Twitter, you should click the videos and watch it just self-destruct. So the black hole appeared yesterday, and they have not been able to play since. Dan Howley, I've never played Fortnite, but explain to me why. They're going to launch something new, right?
Yeah. This is, I mean, it's really impressive that a company is able to do something like this and not be just ruined by their fans, because people are sitting there literally watching nothing on a screen. The idea is that this world that the game takes place in has collapsed into a black hole. The rumors are that they're going to come out with a kind of Chapter 2 version of this game. And it's really a smart move on Epic's part, because there was some kind of slowdown as far as players were going. But this is just adding to the hype cycle again for this game.
And contributing to the fact that something's going to be launched. I think Thursday's an important day. Mm-hmm. Sony has said, don't worry about the tokens or the currency values that you have. They're all safe.
Yeah.
So Sony knows something is up.
Yeah.
But making your loyal fans wait Sunday, Monday, Tuesday, Wednesday, almost 5 days, dangerous.
Genius. I think it's genius, because all you're doing is building the hype cycle for this. And if you look at it, yes, there might be players who are upset right now, but there are a lot of people that probably stop playing. They see this kind of news, they're going to tune in, and then they're going to go back and see what the game is like. And they make a lot of money off those microtransactions. Yeah. And that's where they're going to be looking for.
Dan, I think the key takeaway here is that Fortnite remains a dominant online digital property. Yeah. I know EA tried to make some inroads via launch of their own a couple months ago, but how can you compete with a Fortnite?
I think, this is a game that's, it's got really good staying power, but, the video game industry is fickle. Eventually it will fall off. As much as people think that right now it's going to stay dominant forever, it won't. Everything that's big eventually falls, and we get a new game that's big. But Chapter 2 is a smart move on their part to prolong the success of this game. I think making the players wait is genius.
Atari.
Yeah.
One word. Thank you. Coming up, Made by Google, what to expect as Google gets set to unveil its newest smartphone. Plus, how Wendy's is going through its biggest reinvention in 50 years. Don't be killing my Frosty. Word on the street, we check in with the panelists. We find out what they're watching. And Dan, you are following tomorrow's Made by Google event. Is anyone still buying Google phones?
No. I mean, to be fair, they don't sell as well as Apple's iPhone or Samsung's Galaxy phones. But this is interesting because what Google has managed to do with its not exactly limited resources, but in the hardware space, they're not a big name outside of the Google Home. But with the Pixel brand, they managed to cultivate this kind of cult following, and they've done it by producing some really excellent devices. And the way they stand out is with the camera, believe it or not. Last year, the Pixel 3 had the best camera you could buy on a smartphone. Pricing on these phones is always incredibly competitive. One of the things that we're looking at for this year is a potential phone that'll cost $999. Now that's at the level of an iPhone 11, and I think a lot of fans are going to be upset about that. But if they can improve the camera again, we're talking about a way for kind of goosing the shadows and the lighting and images when you take
better
them.
than the iPhone camera on the 11?
It could be. It could be. The only thing that they're going to be missing is that third camera lens. They'll have two, but not a third. We don't know if it's going to be a telephoto or ultra wide angle. For my money, I think an ultra wide angle lens is actually the way to go. We've been seeing these phones with the telephoto lenses, but it's so much better and more usable to have an ultra wide lens than it is a telephoto. You just get so much more in the shot. They're also going to come out with a new Chromebook, updates to their Pixel Buds, as well as potentially a new Google Home Mini. It'll be a Nest Mini. But a lot of hardware coming out at this event. I'm really excited for it.
All right, well, maybe they can throw in a free pair of Google Glasses.
Yeah, why not,
Every new
right?
phone, right?
Yeah.
And you are watching Wendy's because they announced they were going to do breakfast a while ago. So what's the big deal?
Yeah, so I talked to Wendy's CEO Todd Penegor fresh off their investor day on Friday afternoon. And I asked him, is it fair or unfair that Wall Street put you in the penalty box in September after announcing breakfast? He says unfair, and I happen to agree with him. I think this is a big, different rollout for breakfast from Wendy's compared to when they did it a couple years ago. No new equipment, you're only adding 2 workers, you're building simple sandwiches. Now, besides breakfast, he also tells me they plan to hit $2 billion in international sales by 2024. Currently, they're at $1 billion. This company is finally starting to make a big push internationally. Overall, what you're witnessing at Wendy's is the biggest reinvention in Wendy's in 50 years. And I think over time will pay off. Will it hurt margins potentially over the next 6 months? Sure. Over time, they're making the right call.
All right. Dan Howley, thank you very much. How do you make a deal? Why Chinese state media says, hold the champagne. Also, before we go to break, take a look at some of the biggest winners in the Dow today. few minutes after noon here in New York City. We're 2.5 hours into the trading day. Stocks are mixed. You can see there the Dow is up, NASDAQ is too, S&P 500 down. We're going to jump into that in just a bit. Deal or no deal? A new report says China wants another sit down before it signs President Trump's highly touted phase one of the trade deal. Stepping in, WeWork investor SoftBank reportedly looks at taking over the embattled company. Spotting the difference, one of the main things Bernie Sanders says sets him apart from Democratic counterpart Elizabeth Warren. Welcome to On the Move. I'm Adam Shapiro. Let's talk about these markets. Ines Ferre is on the floor of the New York Stock Exchange, and we've seen a big mix throughout the trading session. What can you tell us?
Yeah, a little bit of a mixed picture, Adam, of what you're seeing. You're seeing a little bit of movement, but quite a lot of flatness, too, with these markets. There seems to be sort of this sentiment of sort of cautiousness surrounding this phase one trade deal. Meanwhile, also, we're watching WTI, which is under pressure. WTI, which on Friday had rallied, today is down more than 2%. We're also watching the cannabis sector under pressure today as well. Hexo was downgraded at Seaport Global to neutral. Seaport also downgraded Canopy Growth to neutral. Over the last few sessions, the cannabis stocks have been under pressure as last week Hexo announced a surprise revenue warning and also withdrew their fiscal 2020 guidance. That sent cannabis stocks lower. And you also had on Friday Jefferies, which slashed its price target on a handful of cannabis stocks. And then we're watching Smile Direct Club under pressure. This is after California's governor signed a bill stating that the state's dental board continues to have oversight over operations in California, including direct-to-consumer or teledentistry, as it would be. And this bill, according to Smile Direct Club, they say that it will create unnecessary hurdles and costs to Californians. Adam.
We're keeping an eye on it, Inez. Thank you. Deal or no deal? New reports say China wants another round of trade talks with the United States before it signs phase one of the deal. The two countries agreed to a temporary truce Friday. So we want to introduce today's panel. Yahoo Finance's Brian Sawsey and Sabeel Marsalis. Also joining us from Washington is R Street Trade Council, Policy Counsel Clark Packard. And Clark, let me start with you. Sure. A truce is not a deal, yet we're all talking about this as a deal. What are we getting wrong?
I think that we will eventually get to a deal. I think China needs a deal. Their export figures came out yesterday. The Trump administration is looking for a deal as they look toward 2020. So I do think eventually we're going to get a deal, but it seems like there's some sort of misunderstanding on both sides right now.
And when you talk about misunderstanding, the president was, talking about the 40 to 50 billion in ag products that China will potentially buy. Secretary of the Treasury Mnuchin talked about it today. But I was reading over the weekend that might somehow violate, is it WTO policy? I mean, is that really, are our farmers going to be selling 40 to 50 billion dollars worth of ag product, or is there going to be a hurdle to cross?
Yeah, look, that's a lot. In 2017, the last year before the trade war began, the United States exported about $20 billion worth of ag products to China. So, yeah, certainly doubling that or more is a lot. But, yeah, legally speaking, there is potential legal ramifications and legal problems because other countries don't love state-directed capitalism in China. And so other suppliers of soybeans, so Brazil, for instance, would have every reason to be upset about that.
So how much of this is China basically taking advantage of President Trump's vulnerability because of the impeachment inquiry and basically saying, you know what, we see what you would have done for a mini deal, so now we want more. We want you to actually also drop the tariffs in December. So is that really what's pushing China to really refuse to help President Trump save face here?
I think that's certainly part of it. I mean, I have significant problems with the way China engages in commerce, but there's no doubt that they're pretty savvy and they sort of understand the president's domestic politics and the domestic weakness and think that, it's sort of Lucy in the football potentially that, we can keep dragging this along and then they may hope that they can get somebody on the other side in Washington that's maybe a little less hostile and a little more sort of deferential to potentially address what, again, I believe are very serious, long-standing concerns that the United States has about Chinese commercial practices.
Clark, do you think China's winning the trade war?
I don't know. I think it's hurting a lot of people on both sides. What I would say is that China has a higher pain tolerance, right? Because Xi Jinping will never have to face voters, and he's not up under impeachment. So, yeah, I mean, I think that, again, there's pain on both sides, but their pain tolerance is typically going to be a little higher than ours.
All right. We appreciate the update. Clark Packard from R Street Trade Policy Council. We appreciate seeing you here on The Move. Let's keep this talking, though, because part of the trade truce on Friday included the increase in U.S. agricultural sales to China. That will give farmers who have been hit by the year-long trade war a bit of hope. Joining us now is Yahoo Finance's Adriana Belmonte. And from Missouri is Blake Hurst, a frequent guest on this program, soybean farmer and Missouri Farm Bureau president. Blake, it's good to see you again. What should we make of this deal of the sale of $40 to $50 billion in agricultural product? When will people like you start to pocket that sale?
Well, we have to make sure that it's real first. We've been promised large sales to China more than once over the past 18 months, particularly this spring in March, when we supposedly had a deal, and then it fell apart when everybody got back to their corners. So we don't know if it's going to happen. $40 to $50 billion, as your previous guest mentioned, is twice what we've ever sold to China before. And as the screen shows, soybean futures are up 30% this morning. Obviously, the market is not counting on much progress. So I think that has to be a little bit concerning. You're seeing a nice increase over the past 2 weeks. That's because of a decline in stocks, because of our yield drop and our production drop here, but weather.
Blake, I know that you and I had spoken a little bit about this over the weekend, but as more and more details come out about the components of this trade deal, if you had to say, one thing that you hope is included in there, what would it be?
Well, we obviously need to have China remove the tariffs on our agriculture products. We tend to talk a lot about soybeans, but obviously it's a huge potential market for pork. Because of some disease they have in their pork herd and decline in their pork production because of disease. We've sold them ethanol in the past. It could be an important market. And corn, wheat, and cotton all depend on the China market. So we're still hoping, and we just now got the market opened up about a year ago to cattle, which we've been shut out of that market completely. So far, we haven't seen a whole lot of trade. We just have access to it because of the tariffs. It's cut down on the trade. So clearly, there's a lot of ag products that could benefit from this deal. Here in Missouri, our main market for hardwoods, for walnut and cherry wood, is China, and that's completely gone away. And a lot of southern Missouri is forest, and they no longer have a market. So it's a huge deal for us.
So we're talking about President Trump saying that China's promised $40 to $50 billion in purchases of agricultural goods. But what is the importance of the timetable for soybean farmers? Because obviously there's the harvest. If we wait for winter or spring, then China could possibly buy these soybeans from South America. So how important are the details of exactly when China is making these purchases to you?
Well, not so much the timing of when they make the purchases, but the timing of when they sign the deal, when they make sure that they're committed to this large purchase. Because so far, the only person that's mentioned $40, $50 billion is the Trump administration. We haven't heard any numbers out of China. And that's what we've got to hear. The market will anticipate the sales, even if they're several months in the future. We'll start seeing better prices as soon as they think those sales are going to happen.
Blake, let me ask you this. We've heard in the past that the Chinese were going to buy $1 billion worth of soybean and corn. Have they fulfilled those promises? Because we've been led down this road before.
Yeah, it's been, we've seen some sales in the last few weeks, but they have certainly not bought everything that we've heard rumors that they were going to buy. And there's some confusion. They'll make a purchase and people will say, well, which promise was that fulfilling? Because they've made several and maybe only made one purchase. And China also has a history of canceling purchases once they've been made. In other words, they'll already be loaded on a boat and headed east, and then the sale will be canceled for one reason or another. So we really have learned not to believe it till we see as the saying goes, till the check hits the mailbox.
So I know that during all of these, the tit for tat tariffs, that the farmers have remained relatively loyal to President Trump. But for those that started to shift away, do you think that the news of this phase one of a trade deal could kind of bring them back towards supporting Trump?
Oh, I think what I've seen in what we call ag Twitter and people I've talked to, people are very excited about the opportunity to sell $40, $50 billion. It would be a huge market for us. But we're, Missourians, what we say, we're the show me state. At this point, we're going to see a little more concrete proof of an actual deal before we get very excited.
All right, Blake Hurst, Missouri Farm Bureau President, you are always welcome here on The Move, and it was good to see you, sir. SoftBank is seeking to take control of WeWork through a financial package that would further sideline founder Adam Neumann. WeWork recently pulled its plans for an IPO, and Neumann resigned as chief executive under pressure. Joining us now is Yahoo Finance's Emily McCormick. She's got more with what's going on here, and there are billions of dollars that they need almost immediately. Where do they stand?
That's right. So SoftBank is reportedly looking at a financing package that would be for equity and debt. No word yet on the timeline of deployment for that or exactly how much that would entail. But the Wall Street Journal is saying that SoftBank executives are reckoning that the We company would need about $3 billion to next year. Remember, this is a company that has an annual cash burn of about $2.5 billion. That's just about the amount that it has in cash equivalents now as of that S1 prospectus. This would also give SoftBank control of WeWork. Remember that this company does have about 1/3 control now, but with this new package, it would take a majority stake in the company, even though earlier this year it had actually pulled back plans to take a majority stake when it made its last equity financing at a valuation of $47 billion. With this new financing, SoftBank would reportedly be paying a lower price per share than it did earlier this year, potentially valuing the company at less than $10 billion. Earlier this year, that valuation had been as much as $47 billion. Now, that's just one option available on the table. Bloomberg is also reporting that JP Morgan Chase is vetting other investors to potentially come in with a debt deal for the We company for about $5 billion. This would be a little bit less dilutive if we think about corporate governance. It wouldn't necessarily see some of these stakes that the executives and management has in the company now, but it would require that it actually is able to come up with these investors to make debt financing for the We company. And then finally, if we think about beleaguered founder Adam Neumann, who is now a non-executive chairman of the company, he would probably see his control rolled back even further. He initially had 20 votes per share in that initial S1 prospectus that was then rolled back to 10 votes per share. That now stands at 3 votes per share. And with the SoftBank deal, that could be rolled back even further. Adam?
Emily, thank you. Brian, who stands to lose more? I mean, SoftBank might go in, as Emily just described, and take control. But with this company, people are talking about bankruptcy. So would SoftBank then, trying to save itself, or would the real estate market as a whole suffer some kind of black swan event if this company were to go down?
Well, I think SoftBank has the money. Certainly, it would take its right down and get its medicine. But I think the real losers here are WeWork employees and Adam Neumann, because all of them collectively steered the ship, what appears to be the ship, right into the ground, especially Adam Neumann.
But if you've got a company that's valued at less than $10 billion and you're SoftBank and you're about to throw $3 billion at it, where's your return?
Yeah, so that's why we're seeing that they're saying, well, if we're going to actually do this, if we're going to spend billions of dollars, invest it in terms of new equity and debt, we want Adam Neumann to be sidelined. We want to be in control. And that makes absolute sense. I feel bad for Adam Neumann because as the founder of this company, of course, he would like to maintain control. He's no longer the CEO, but he still has voting power. But that's the gamble he's going to have to make unless the JP Morgan deal works and he gets other types of financing for debt.
How much does SoftBank have in on WeWork right now? Does anyone know offhand?
Don't know offhand.
Okay, because what I'm getting at here is the company is valued at less than $10 billion.
Yeah.
We know that.
Oh, there's a lot of haircuts coming.
This could be bad money chasing the money you already lost.
A lot of haircuts coming, but going back to what I said about the employees, a lot of employees have left WeWork during this whole uproar. Now, look at all these stories, the partying, the drinking. How are they going to get a job somewhere else? And you know who to blame is? That's Adam Neumann and his management team.
Well, I think there's still some upside, obviously, if SoftBank still wants to maintain control of this company, still wants to invest and help them raise debt. So there's still potential. I mean, they've been revolutionary in the sense of creating this office space for people where you don't have to meet inside your home. You can actually meet at a place, rent it for a while. But I think the IPO really damaged them a lot because it showed all the weak points in their finances, and now they got to shore it up.
I used to work at a Starbucks. Works for me.
Look, the upside is going to be, if they should go belly up and under, it's going to be the bargain basement prices for real estate, and watch REITs come in.
Adam Newman might be calling you, Adam.
I doubt that. I worked at Publix. You were at Starbucks. I was a bag boy at Publix.
That said, Adam's invited anytime.
Well, there you go. And I have shoes. Adam Newman doesn't. Coming up, telling them apart, Bernie Sanders says there is one big difference between himself and Democratic opponent Elizabeth Warren. Plus, take a look at some of today's trending tickers on Yahoo Finance. Stocks are trading mixed right now as investors weigh the latest trade developments between the U.S. and China. For more, we want to bring in Adam Phillips, Director of Portfolio Strategy at EP Wealth Advisors. And one of the discussions we've been having is the S&P 500 has been essentially range-bound between 2,750 and 3,000. We get the news about the truce deal, whatever you want to call it, Friday. Everyone gets excited. But now we're not so excited. I want to jump ahead. Where do you see us ending, 2019 on the S&P 500?
I still think we have a little bit more to go here. It's obviously been a great year thus far, and in spite of a lot of the headwinds, the headline risks that we've had to endure. But we're still positive on equities. I think right now what we're seeing is obviously the market is digesting the news over the last few days, and the way that we are really interpreting this mini deal or light deal, however you want to call it, is we've kind of taken the approach of fool me once, shame on you; fool me twice, shame on me. So I think to us, we certainly like the idea that this was not a further escalation. It was but it was also not a de-escalation. To us, it's really more of a status quo until we actually put pen to paper here. And so for us, it's not a definitive buy signal. It's not enough to go back in, but I think it's still a positive development. It's a step in the right direction.
And help me understand something that you shared with us before we came into the segment, that greater than 60% of S&P 500 stocks are trading above the 10-year Treasury, and usually the average would be over 30 years, 17%. Put this in perspective.
Yeah, that's right. I mean, one of the things that we've had working in our favor in the equity markets is this TINA trade. There is no alternative. I think a lot of people are familiar with that, and the theme that, the nice thing about one of the nice things about yields coming down on the bond side is that they've made stocks relatively more attractive. And what we've said is that stock valuations, they're full. They're not overvalued, but they're also not cheap. But relatively speaking, they are pretty attractive compared to the bond market. And so I think that's led to a lot of demand there for equity investors, certainly on the dividend paying front. And so that's one of the reasons we're overweight things like REITs, things like consumer staples. Not every bond proxy, so to speak, is still attractive. Utilities to us are overvalued, so we're underweight utilities. But to us, it's certainly one argument, one catalyst for seeing equity prices move higher from here.
Adam, what's your probability for a fourth quarter correction?
It's a good question. I think we are not. We don't see one coming. I think predicting over the short term is always, pretty difficult. But I will say, to extend that, do we see a repeat of what we saw last year in the fourth quarter? And the answer is no. But I do expect that this volatility will be with us. We're kind of still in that period where it's really the perfect storm. We have these trade negotiations, which is ongoing, Brexit discussions, which are ongoing. We're hoping for more information there over the coming days and weeks, certainly as the clock ticks down towards that deadline. So I think there's the possibility that we see stocks move lower if we don't get some positive developments there. But I don't think that a 10% move from here is not something that we're calling for.
All right. Adam Phillips, you have a great first name. You're also the EP Wealth Advisors Director of Portfolio Strategy. Thank you for joining us from California.
Thank you. Appreciate it.
Bernie Sanders is trying to separate himself from the policies of rival Democrat Elizabeth Warren, the Vermont senator responding to Warren's recent surge in the polls, describing one of the most fundamental differences between these two candidates.
Elizabeth Warren has been a friend of mine for some 25 years, and I think she is a very, very good senator. But there are differences between Elizabeth and myself. Elizabeth, I think, as you know, has said that she is a capitalist through her bones. I'm not.
Yahoo Finance's Rick Newman is going to join us now. Rick, I got to tell you, I'm registered independent. If I were a Democrat, I'd be furious. Bernie Sanders is a socialist, nothing shameful about that. But he jumps in to run for president as a Democrat, and now he's going after Elizabeth Warren.
Well, we've seen this show, though. I mean, that's what he did in 2016, and, voters were kind of fine with it. He was I think he actually surprised a lot of people in 2016 by catching on as much as he did, especially among, big surprise to me back then, young people. I mean, young people liked Bernie Sanders back then. Of course, he didn't win the nomination, and I think it's fair to say he's fading at this point. I mean, Elizabeth Warren is just running a better campaign, a more energetic campaign, new ideas, and she's really kind of capturing some of what Bernie Sanders captured in 2016. But so Bernie, I guess he's trying to differentiate himself by saying, look, I'm the only socialist in the race. That's not going to win him anything. And I think Elizabeth Warren is basically getting a grip on that, the leftmost half of the Democratic Party.
And even socialists or people in the United States, when they point to European socialist countries, what they're really pointing to is capitalist countries with some socialist policies.
Right. Yeah.
But is that a selling point for a Democratic candidate? I'm not a capitalist in this country?
I don't think so. And that's why Bernie Sanders didn't win the nomination in 2016. It's why he's even less competitive this time around. The real challenge is going to, let's not get too wrapped up in terminology. We do know that President Trump is going to throw the socialist label at whoever the Democratic nominee ends up being. And there's an increasing likelihood that it is going to be Elizabeth Warren. I mean, she's got the momentum right now. She's tied with Biden at the front and in some polls ahead of Biden. But she's rising and Biden is stagnant. So she's got the momentum right now. I think think the better question is just how capitalist is Elizabeth Warren. She says she's, Bernie quoted her in that interview as saying she's capitalist through her bones. I have no idea what that means. Capitalism is not a medical condition. And she's not capitalist, she's not deeply capitalist. I mean, one example that I think we're going to start hearing a lot more about as she becomes more prominent, she has said that if she becomes president, one of the first things she's going to do is ban fracking. That's hydraulic fracturing. That's a really important American industry, and she wants to do that for environmental reasons, obviously. But it's not real capitalist to say we're going to address a problem by banning an entire industry. What economists would say is, look, we understand you need to make a transition to a new form of energy, but by banning an industry, you're going to push current energy prices way up, natural gas prices, which people use to heat their homes, that's fairly clean. Carbon fuel, that's going to go way up. Oil prices are going to go way up. Gas prices are going to go way up. Economists would rather you do it with a carbon tax that's phased in over time that everybody knows about, and let market forces do the work for you, and you get the most efficiency that way. That's not what she's proposing. So she is going to come under pressure for being just how capitalist is she.
So obviously calling himself a socialist is probably not going to do Bernie Sanders any favors. But when it comes to his policies and his plans, how much do voters actually care about the label and more about what he's willing to offer? One example that I want to pull out is, for example, he wants to make sure that CEOs don't make a lot more money than the typical worker. I mean, that resonates with the Democratic base. So will they possibly not care so much that he's a socialist because they like what he's saying?
I think it's a good question, but again, I think it's a better question with regard to Elizabeth Warren than it is to Bernie Sanders, because I think Bernie's fading. Voters, so some of these things work with voters, and some only work until they start to ask, well, how much is this going to cost me? The best example of that is Medicare for All, which Bernie originated back in 2016, but Elizabeth Warren now supports. Elizabeth Warren, interestingly, has a plan for everything except health care. With health care, she says, I'm with Bernie, and what some people think she's doing is she's going to ride Bernie's plan through the primary, but then if she wins the primary and becomes the nominee, she's going to come up with her own plan that is not quite as dramatic as Medicare for All. But that's a good example. So when you tell people, would you like free government health care, no strings attached, they say, it sounds great to me. When you say, oh, by the way, you can have that, but it's going to involve a major tax increase for businesses, consumers, yes, the middle class, yes, the working class, they say, oh, it doesn't sound like such a great idea.
All right. Rick, thank you very much.
Thanks,
Coming up, voting for your future. A new Yahoo Finance report breaks down just what your retirement could look like under each Democratic candidate. Plus, take a look at some of today's winners on Wall Street. 12:32 in New York City, 3 hours into the trading day. Stocks remain mixed. We're keeping an eye on things for you, but we're also watching gold. Gold last week fell below $1,500 an ounce. Today it's going up, $1,495.80 an ounce. Democrats and your money. A new Yahoo Finance report breaks down just what your retirement could look like under each candidate. E-cig crackdown, the latest as lawmakers launch yet another probe of that embattled sector. And writing your future status. One university wants to help influence students' futures, literally. Welcome to On the Move. I'm Adam Shapiro. Let's talk about funding your future. The 2020 election is in full swing, but several presidential candidates have yet to address some key issues. With that in mind, Yahoo Finance teamed up with the Funding Our Future campaign to get more details on where the candidates stand on retirement. Jason Grumet, Bipartisan Policy Center President, joins us now to discuss this. So what are the main takeaways from the report?
Well, I think we learned a lot together through this survey, and I'll just start out with maybe kind of two broad takeaways. The first is that regardless of how much money we spend as a nation on top-notch political consultants, the basic campaign strategy hasn't really changed since 6th grade. The candidate stands up at the front of the room, promises to cancel homework, and then throws candy. On the Republican side, the candy is tax cuts that aren't paid for. On the Democratic side, the tax cuts are basically benefits that are either completely or largely unpaid for. So that's the first kind of, hey, it's a campaign realization. I think the second, which requires a little more nuance, is that we're getting to a point where the idea of making any modifications to benefits is seen as a third rail. So you may remember a couple cycles ago, the Republican candidates were asked, who would support deficit reduction that was 90% spending cuts and 10% revenue, and no one raised their hands. And I think we have to be concerned if the basic premise of the Democratic candidate is that there's no willingness to contemplate any kind of modernization of benefits if that would require anybody to give anything up.
Look, put this in terms we can all understand. Social Security. It seems that the debate among Democrats, at least the field of Democrats, is how much to expand the program. Yet we get told that Social Security, if they don't do something, will only be able to pay roughly 70 cents on the dollar somewhere around 2032. Won't go bankrupt, but 70 cents on the dollar. So what divides the Democrats more? Do they want to answer that?
So there's one idea that I think is responsible that does unite the candidates, and they are all agreeing that we should increase the amount of income that is covered under the payroll tax. Right now, it kind of cuts off at $130,000. The candidates are all saying that above $250,000, that income is also taxable. So that would bring some revenue into the program. But then it's really a question, as you point out, of just how much benefit increase. I think the Sanders and Warren plans basically just provide kind of more stuff for everyone. The Bennett and Klobuchar Biden plans are a little bit more focused. They suggest that there are essentially kind of three categories where they would increase benefits. They would increase benefits for the lowest income Americans. They would increase income for people who have left the workforce as caregivers. And they would increase income for survivor benefits, because I think one of the challenges is that when one spouse dies, the other spouse often has their income cut almost by half. And so if you see that distinction, that kind of tells you the two different kind of governing philosophies that would start, I think, to mature if any of those members become president.
Well, what about Beto O'Rourke on Social Security? I mean, assuming he's going to live past this debate if he even gets in.
Well, so I think, the one thing that Beto O'Rourke has done is he has endorsed a piece of legislation from Congressman Larson that I believe you're going to be talking about. And what that legislation does is it actually requires the folks in the middle to start to pay additional revenue into the system. So it's at least probably the most responsible step towards kind of fiscal sustainability.
I had the pleasure of interviewing Marianne Williamson a couple months ago. She didn't make the stage. I mean, but her plan's out there.
Well, credit to candidate Williamson. One of the things she has proposed, which is focusing now more on the private side, right? We have the Social Security debate, but kind of focusing also on this question of just private savings. She is focused on the access issue, and there's a little bit of a hierarchy of access, right? There's the Secure Act, which we've talked about, which just basically provides incentives for companies to offer plans. Williamson's endorsed this idea of kind of a minimum offer, which would require all companies to offer a plan, would not require an actual contribution by the companies. And then it escalates from there. A number of candidates are talking about kind of a guaranteed retirement account. Senator Klobuchar's idea is that companies would have to put 50 cents away for every hour candidates worked. There are others who just say the government would basically put a chunk of money in everybody's guaranteed account at birth, and that would become like the nest egg that would grow from there. Go ahead.
Oh, I was going to say, how far are Democratic candidates willing to go when it comes to concerns that the wealthiest may be paying less in Social Security than, say, a truck driver or a nurse?
So I think the basic idea that motivates a lot of the candidates is to say that wealthy people should have the 2/3 high end of their income also paying into the payroll tax system, right? So right now, middle class folks up to $130,000 income goes into the payroll trust. If you make $7 billion, there's nothing else. And so I think the argument is that we should, in fact, have larger portions of people's income covered. Then, Warren and Sanders take the next step with just kind of generalized wealth taxes that would be, brought into the system to support benefits.
Is there anything else you want to highlight about this survey before we say goodbye?
Yeah, well, so the one other thing where I think there's some creativity, which is probably where legislation could move forward, is on this kind of reforming retirement accounts to recognize modernity. So there's a lot of discussion about portability, right? The fact that we just don't have jobs for 40 years with a kind of lumbering 401k. This kind of gig economy, part-time work requires a different imagination for retirement. Shout out to Senator Bennett, who has come up with a plan called the 401k in the sky. A little bit of kind of a Beatles metaphor there, I'm not sure, but it would essentially have the 401k kind of float behind you, apparently, as you change careers and enable you to continue to have kind of a continuity of savings. And so I think, those kinds of ideas which will make the system more secure, but at the same time not necessarily raise the overall cost, are probably, I think, the sweet spot for some collaboration.
Jason Grumet is the Bipartisan Policy Center president. We appreciate your partnership with Yahoo Finance. All the best to you.
As do we. Thank you.
Coming up, it pays to be a fan. We're going to talk to the maker of a new app that wants to help artists like Leanne Rimes reward fans for their loyalty. Let's take a look at some of today's most actively traded stocks by volume. Bank of America banks out this week with their earnings. Let's take a look at the top trending stories on Yahoo Finance right now. The state of Michigan pulled $600 million in state pension funds from Fisher Investments. That move comes after billionaire founder Ken Fisher made lewd comments at a conference last week. The funds pulled by the state of Michigan will now be managed internally. Fisher has issued a formal apology. A swine flu contagion is threatening the Korean peninsula. South Korea will send military snipers and civilian hunters to its northern border to kill infected pigs wandering south from North Korea. 5 wild boars have been found dead in or near border areas this month. And the Panera employee who posted a video of how the fast casual chain prepares its mac and cheese says she has been fired. The now viral video, which was posted on TikTok, shows a frozen block of mac and cheese wrapped in plastic being dropped in a boiler. Commenters were up in arms that the dish wasn't prepared fresh. A spokesperson for Panera Bread declined to comment on the employment status of the woman who posted that video. Loyalty pays, especially when it comes to social media, and a new app wants to pay you for spreading the word about big names and big name brands. Sweet is a new app that lets fans to turn their social media use and music streams into reward points. Those points can then buy experiences with your favorite brands or celebrities. We're joined now by Tom Mazzone, Sweet founder and CEO, and we should point out today is the day Sweet went live. Correct?
It is. Thank you.
How does it work?
Sure. So first of all, thanks for having me. Very excited to tell this story. So consumer engagement is very valuable, right? If you think about traditional loyalty or the way brands value consumers, it's typically through a purchase. But it's a new day, right? As consumers and fans, we're creating hundreds of millions of dollars of value, literally not just by making purchases, but by our actions. Things we do from consuming content, our data, our consumption. And what Sweet does is basically it allows you as a consumer to take some of that engagement and literally put it in a digital wallet. We monetize your engagement. We put it in a wallet that can be spent on some of the most incredible experiential rewards with some of the top talent in the world.
So what kind of talent do you have on the platform? So what are the to-do tasks for fans and who you get access to besides LeAnn Rimes?
Sure. So here's what's so cool. When we reached out to talent, nobody knows the value of engagement more than a talent brand, right? And we got this incredibly overwhelming response from hundreds and hundreds of artists that wanted to give back to fans. There's literally hundreds of things that you can do to collect what we call sugar, which is our point system, from streaming music to adding songs to playlists, consuming content, literally even showing up at a physical location and collecting sugar at what we call a sweet spot. And this could be a concert, it could be a retail location. Some of the artists that are launching, K-pop superstar Wenji, 28 million followers, LeAnn Rimes, young blue hip hop artist, Kevin Quinn, big Disney pop star. So it's a big array of incredible talent that are launching on Sweet.
Who do you compete with?
It's a really good question. So we've been meeting with some of the top media companies, and what we hear consistently is this was the idea I wanted to do. Like, this concept is very well known, but no one's actually executed on it in a very strong way. We're not seeing a lot of direct competition, which is action-based loyalty or action-based rewards. With that said, there are other things that dance around different aspects of the platform, but nobody directly is doing what we're doing.
I have Spotify. Does it play nice with Spotify? If I'm listening to an artist, is it then somehow giving me points on Sweet?
Correct. We're not trying to become a new streaming platform, right? You can leverage your existing platforms like Spotify, Apple Music, YouTube, and others. We're just letting artists reward you for that stream with sugar.
And how do you make money?
Very good question. So as we scale, there's hundreds of different ways that we can incorporate brands into the Sweet platform. For example, we have a game called the Sugar Rush. It's a weekly celebrity-hosted game where you get to listen to a single for the very first time by your favorite artist in a live listening party. So the artist is getting all the streams, you're in this fun listening party. Brand integration into that game is one example. Another example are the sweet spots. Wenji, for example, has a new line that she's launched at Target. She's dropping sugar at every Target. in the U.S. where you can go collect sugar just by visiting. So there's a big revenue opportunity there as we think about marrying traditional brands and retailers with that particular application. So there's lots of different ways that we can incorporate, sponsored concert and brands into the app.
What made you create this? What's your background?
Really good question. So this is my fourth tech company. I've been running tech companies since 1996. My first was like a broadband ISP. I did a voice over IP company. Every company that I've started, you start with a problem, right? And you see a need in the marketplace. To me, it was really understanding that consumers are sort of fed up with the fact that their data is being leveraged and it's being used. They're valuable promoters, right? Consumers are valuable promoters. And just not seeing any technology applying sort of traditional loyalty to actions versus purchases is really what sparked it. And just on a personal note, I have a few kids that were jamming on YouTube one day, ended up on David Letterman, just from the value of the fans pushing them up, right? Mm-hmm. And we didn't have a label, we didn't have a publicist, we didn't have anything. I saw the direct value that fans can really do for a talent brand, and that kind of sparked this idea.
Sweet. Live today, Tom Mazzone, Sweet founder and CEO. Thanks for being here.
Thanks for having me.
A congressional committee is looking into whether manufacturers of vaping products engaged in misleading bot-generated social media messages. Now, the messages about e-cigarettes may have confused consumers about the safety and health issues. Zach Guzman is here to tell us more about it.
Yeah, Adam, I mean, obviously, people have been looking into this for a while, right? Now you can talk about the multiple state attorneys general looking into these vaping companies. You can talk about the FDA, the FTC, but right now at issue is what's been at issue since the beginning, and that's marketing practices when it comes to targeting teens and other people who might not know the concerns when it comes to vaping. So the House Energy and Consumer Committee here looking into the idea that companies have been using bots to target these people because there are rules in place when it comes to tobacco, and getting around those rules by using robots to basically target people and maybe mislead them when it comes to health concerns.
But some of the companies, I think Juul is one of the companies denied ever using bots, right?
Yeah, I mean, when we're talking about the vaping companies out there, you can't not focus on Juul, and they control 3/4 of the overall market. But we reached out to Juul, and I just want to read the statement because, yes, you're right, Adam. I mean, they denied ever using bots, but they also went on to go further. They said, we do not engage in social media marketing of our product, and our brand protection team utilizes advanced web crawling technology to scrupulously monitor social media platforms for counterfeits, trademark infringements, copyright infringements, and violations of platform policies, content containing counterfeits, infringements, and policy violations, whether bot-driven or not, are reported for removal as soon as they are identified. So clearly Juul hitting back at the idea that they were the ones behind this. So the question becomes, if not Juul, what other vaping companies out there might have been using bots to promote this?
But doesn't this show like a real challenge for House investigators? Because they ask these vaping manufacturers, are you using bots? And they're all like, nope, not me, not me, not me. So can they actually crack down on it? Can they figure out who is actually pushing for these bots to tweet all this misinformation about the health values of e-cigs?
I mean, specifically at Juul, there's a criminal probe. So they've been obtaining documents when it comes to what marketing practices that company specifically may have been doing. Outside of Juul, though, the same investigation is being applied to all of these different companies and internal documents specifically when it comes to marketing. A lot of documents been requested, some forcibly obtained. We talk about the way that people are being investigated here. So whether it's bots or not, it's marketing practices across the board that all of these vaping companies might be participating in when it comes to misleading the public around those health concerns that we're now seeing come to the forefront.
Zach, completely outside of this, is the bottom yet in cannabis stocks?
Cannabis stocks?
Yeah, you're a cannabis expert. I mean, the cannabis, like this whole space has gotten completely ravaged in the past week. What the heck is going on?
I know, we were just looking at it. Canopy Growth, the biggest weed stock in the space, down 30% now for the last month.
I think you're sitting next to me. I got to ask you.
You might think that vaping might be tied to that too, because we've talked about THC, the active compound in marijuana, being linked to more of these vaping-related illnesses. So there is a piece of that might be at play here.
But linked with the black market sale of the cartridges. It was the black market THC cartridges, not necessarily THC that might have been done appropriately under regulation. They don't know yet.
Yeah, I mean, a lot's still left to be learned, and the same thing on the vaping front, just to tie it back to Juul and all the rest of those nicotine-based vaping companies. A lot more is being studied right now about the potential health concerns through nicotine itself, something that a lot of people had in the past, including the FDA, said is a safe thing to be included here. So a lot being found out.
World.
You can never predict when the bottom's in, Sazi.
It's a different world.
Wise man. Wise man.
I'm the generation that grew up with candy
Impressive.
cigarettes, so y'all missed out.
Yeah.
Coming up, influencing your future. One university wants to help you study how to be a social media star. Yep. Plus, take a look at some of today's losers on Wall Street. Time for the buzzer beater round. 3 stories, 1 minute each. We're going to start with this. Lyft and Uber are suing New York City over a new rule limiting the time drivers are allowed to spend cruising in Manhattan without passengers. Now, New York implemented this rule to avoid congestion. I'm going to ask what the two of you think, but I've already heard from Uber and Lyft drivers who are losing income because they're not allowed to drive if they don't have a passenger.
And this is just another risk. Barry, going back to the S1s in both of these companies, you need the drivers happy. And I think you're seeing a lot of governments really sticking it to Uber and Lyft here, as they probably should.
Yeah, I mean, I understand why Lyft and Uber are saying it's not fair, because that means that, yellow cabs are going to get the advantage and get more passengers. But as a person who also drives in the city, it's ridiculous. The congestion is insane. And this rise in ride-hailing services has definitely contributed to that.
Well, it's contributed, but on the other hand, it helps alleviate some issues as well. Wouldn't it make sense, if you're going to do something, make everyone who drives into the city have the same rules? Because now you're playing favorites with the yellow cabs. Now, granted, the yellow cab drivers have to rent the medallions.
Yeah. Right.
But which would you rather ride in? A yellow cab with the smell or an Uber or Lyft? Well,
Uber all day.
A nice Uber personal vehicle, someone's car.
You can now get a degree in being a social media influencer. Save your money. The 3-year program is being offered, at an Italian online university and is backed by Cristiano Ronaldo. Is there really a market for who is going to spend the money for this?
Well, if it's good enough for Cristiano Ronaldo, it's good enough for me. I mean, this guy's a superstar in football. I love him. But that said, it is kind of ridiculous. Spend 3 years for influencing. I mean, you can do that without a degree.
Well, here's a newsflash to Cristiano Ronaldo. What happens when Facebook takes the likes button or the like button off of Instagram and on Facebook? There go all your influencers that are absolutely flooding up my events. Every event that I go to is now flooded with Instagram influencers, and I'm tired to it. I'm there to report stories.
Anybody who spends the money to buy a 3-year degree in being an influencer is not going to be an influencer.
Right. Exactly.
The bubble's burst. I'm ready for it.
We're gonna pop this buzzer. Boom, done. Elizabeth Warren ran an ad on Facebook that begins with a lie claiming Mark Zuckerberg endorsed President Trump. The ad goes on to say that Facebook will cash in on Trump's lies and helped elect him the first time around. So, should Facebook ban Elizabeth Warren's ad?
I think she's playing with fire here because when it comes to misinformation, Trump is king. He knows how to do it better than everybody else who's been doing it longer. And for her to try to venture into this space, I think could backfire. She should just stick with the facts.
No, that's a great perspective, Sabila. The only thing I will add here, President Elizabeth Warren is going to go full-on attack against Facebook, and I think she's clearly taking the steps to point that out.
Well, she's using it, though. She hates it. It's a love-hate, though.
Mm-hmm.
She hates it, but she's using it. She's spending money to do it.
Exactly. Her campaign's spending money on it, so they clearly think it's a good strategy, but it's really not. In the end, she should stick to the facts, because that's really her firebrand.
Well, thank you both for being here. Wi-Fi PM is going to take you through the next hour of trading.
It is 1 p.m. in New York City, and the major indices are seesawing as investors continue to digest where U.S.-China trade talks will go from here. On tap for today, why China says it wants more rounds of talks before it signs the partial deal the White House is celebrating. We'll chat with the Milken Institute's chief economist for more on how the U.S. might be able to pour on the pressure. Plus, GM's auto worker strike hitting week 5. We'll have why Ford is closely watching the latest negotiations with a watchful eye as a new healthcare precedent becomes an even larger sticking point. And the best airlines ranked. With the holiday travel season fast approaching, the Points Guy will join us to break down the best and worst airlines in the U.S. All that and more. This is Wi-Fi PM. Good afternoon. Hope you're having a great start to your week. I'm Zach Guzman, and joining me on Wi-Fi PM today is Yahoo Finance's Brian Chung, along with Flat World Partners CEO Anna Marie Washer. Guys, happy Monday.
Happy Monday.
It's a big Monday right now.
So excited.
When it comes to market action, maybe a little bit less exciting. Right now we're about flat. The Dow up by about 13 points. The S&P off by 2.8 to be exact. And the NASDAQ right now off by the slightest margin there behind the Dow, 0.09% for now. We'll see where things go throughout our hour. But first, the main story we're talking about, the U.S.-China trade deal is top of mind for investors as questions linger following the announcement of a first phase trade agreement. And Treasury Secretary Steve Mnuchin explained the status of the deal, which has yet to be signed. He explained it earlier on CNBC. Take a listen.
We have a fundamental agreement. It is subject to documentation, and there's a lot of work to be done on that front. But it includes intellectual property rights. It includes financial services, it includes currency and foreign exchange, and it also includes very significant structural issues in agriculture, on top of significant purchases. So I would describe phase one as quite substantial. As the president has said, as soon as we get phase one complete, we'll move to phase two.
All right, so joining us now to dig through all of this is Milken Institute Chief Economist William Lee. William, it's good to see you again. Right now, I just want to go through the other details we have because Bloomberg's reporting China wants to hold more talks this month to hammer out the details of phase one. What's your take on where we got to now and how big of a change it might be moving forward in these negotiations?
You know, Zach, we have to remember that when we deal with negotiations, especially international negotiations of this sort, where the two major powers in the world are essentially determining the trade and economic and even social political framework for the 21st century, we can't expect a deal to be done in a bunch of few meetings that take place over the course of maybe even 6 months or a year. Remember what it took to open up China. It took years. And I think one of the things that we should remember is that when we have negotiations like this, success is measured in talking. The fact that talks continue is a victory. When talks shut down, that's when markets should worry.
I mean, when we talk about worries right now and the market reaction as well, it's interesting because when we got the news of a partial deal, the market really didn't jump all that much on the news on Friday. And I think part of it is still wondering where we might go from here. Right now, the December 15 tariffs right now are kind of the negotiating tactic and the power that the U.S. is holding over China's head right now. How big of an impact do you think that tool might be to continue to drive China to the table?
I think that's absolutely critical. It's very smart for the U.S. side to hold back any kind of decision on those December 15th tariffs because those are the ones that will really have bite, both on both actually our economy and also the Chinese economy. And the Chinese negotiators want more than anything else to throw those off to essentially resolve that problem. And so in order to do that, they're going to have to give something to the U.S. negotiators. And so I think that's the strongest negotiating lever the U.S. has got right now to try to get a structure where we have agreements for how to resolve disputes. That's what tanked the discussions back in May when there wasn't a dispute resolution mechanism, and that's what they're going to have to put in place. And using those tariffs as a bargaining chip is a great idea.
Well, Goldman Sachs right now is predicting about a 60% chance that those tariffs, more tariffs, might be added by the end of the year. Would you peg the same probability to that happening?
I'm a little more optimistic that both sides want to have something done. And I think the nature of the discussion so far, especially when Liu He and President Trump both said we're driving toward a signing ceremony on the part of the principals, President Xi and President Trump, in November. I think that means that those tariffs will be resolved before that.
All right.
Hey, William, Brian Chung here. So it seems like phase one hasn't done too much to address what are the more structural issues of the forced technology transfers and also intellectual property protection. So I'm wondering, is that an expectation for a component for phase two? I mean, we're all talking about phase one, but what does that even mean for phase two or three? Or why even stop there? Why not phase four after that?
Let's remember, phase one was to get sort of the immediate low-hanging fruit on the table and into print, right? And they have to be able to have an agreement that actually specifies how much they're going to buy from us and what we're going to do and what the nature of the framework is for intellectual property protection. They'll be ironing that out in phase two because that's the thorniest part of the problem, is how to have intellectual property protected, how to reduce state subsidies, how to do all the structural changes that the markets are so worried about. But again, I have to remind you all, and the markets in particular, WTO discussions took decades in order to resolve even the most minor disputes about timber and other kind of trade minutia. This is not minutia. This is really a big deal. So I'm thinking that this stuff will not be resolved until 3, 4, or maybe even phase 5. But there will be steps along the way to make the process credible. And that's what the negotiators have got to do. Come out with negotiating strategies that show the markets they're actually making progress in terms of putting in place something that will work to address these very thorny structural issues.
Well, here's the problem with that, too, though, right? I mean, we're talking about how long these things might take. China already is feeling the impact. Just want to highlight the new data we're getting. Chinese shipments to the U.S. slumped nearly 22% in September from a year earlier, according to data from the General Administration of Customs. So, William, I mean, when we're looking at that number, how can China wait for those thorny issues to get figured out? I mean, obviously that's what the U.S. wants right now, but if that's what China is seeing on the export front, can they wait decades to really get this resolved?
Well, they will have to wait decades in terms of having all this stuff buttoned down, because I think, as I said, WTO-type negotiations always take long times, and they're measured generally in decades. And if you measure them in months or years, then you're doing a really good job. Now, the Chinese economy really is slowing down, but partly by design. Remember, they're still trying to deleverage, and they're focusing their fiscal stimulus on raising domestic demand, which means domestic services and the private sector in China that is less export-oriented than the state-owned sectors that dominate some of the export industries. So what we should look for would be the GDP numbers that actually will come out to show how effective their domestic policy fiscal strategy is to try to shift the demand from exports into domestic demand and consumption.
All right, so real quick before we let you go, give Donald Trump a report card grade here after he's now completed phase one of his China negotiations. What do you give the president?
I would say the accomplishment would rate an A-, but the way he got there is probably a C- in terms of the verbosity and all of the tensions that were raised because of the abruptness and how he negotiated this deal so far.
All right, there you go. William Lee breaking it all down, plus a grade as well. Thank you so much for taking the time. Appreciate it.
Thanks for having me.
All right, well, the head of Boeing is facing more backlash after the two deadly 737 MAX crashes earlier this year, and the company's board is now stripping CEO Dennis Muilenburg of his chairman role, stating the move will allow the executive to focus on running the company as it works to return the MAX fleet to service. Guys, Boeing has been under, obviously, a lot of scrutiny right now, but are you surprised by the move to kind of take that chairmanship away from him? And what do you think it signals when you think about Boeing?
Well, I think Dennis Muilenburg here, he obviously facing a lot of pressure, but I would not say that the timing of this was any surprise. I mean, I think the change happened hours after there was a report from the FAA, from NASA, from 9 international regulators saying that Boeing hadn't done the due diligence to actually explain to federal regulators exactly how its MCAS system, which was to blame for the Lion Air and also the Ethiopian airline crashes, didn't explain to regulators how exactly it worked. So that, that means that Dennis Muilenburg was probably responsible for not going through the due diligence to actually do what he wanted to do to make sure that this plane was actually cleared for flying. So no surprise necessarily, but apparently it's not bad enough to remove him as the chief executive of the company either. So I don't know, you can look at it both ways.
Yeah. I mean, it would be interesting, and I'm sure they'll do a review at some point on how much he really knew going on. I think this is a very good move for the board and from a governance issue, not separating, church and state, but you are having some oversight now, and someone who steps in as the chairman, which is another board member, will have more control on what's happening internally in the company versus him being able to kind of play two sides. So I think it is the right move. I'm surprised he's still CEO.
Do you think that, if that's one move, a lot of the questions now are if that could come later, if it's a signal of what might happen later on, but not necessarily always the case, that if you remove someone from their chairman role, that they would also be removed from their CEO role.
And I don't think all the information on Boeing's come out, right? There's another 737, which isn't the MAX, that's having some issues on the structures of their wings. That hasn't been resolved yet. I think it's going to be a long time before Boeing recovers. It's not a huge pop, but you see the market seems to like the decision to remove him as chairman. So.
Yeah, I think the key next step for him is just getting the 737 MAX back into the sky. He hopes to do it by the end of the year, which seems like a pretty lofty goal when you consider that they haven't even cleared the current fixes with the FAA yet.
Yeah.
So, if he can't get that done, maybe that puts him back on the hot seat.
And not the worst thing, too, when we talk about governance, to have someone else also there when you think about policing what had been done in the past and what might need to be changed moving forward as well. While we're talking about Boeing, let's shift to from planes to cars. The United Auto Workers strike against General Motors is entering its 5th week as it continues to drag on, with the union increasing strike pay for auto workers on the picket lines to $275 a week. So not a lot, but potentially helping the cause there. Meanwhile, the Detroit Free Press reports there may be a breakthrough for negotiations on health care following GM's previous agreement to leave workers' shares of healthcare fees as they are at 3%. But a new deal could come at a cost to rival automaker Ford, and that's because the company employs the most hourly workers in the U.S. and pays more for healthcare as a result. Guys, obviously healthcare has been at at the front of these negotiations because the workers don't want to have to pay more and brunt the cost of health care, especially that might come from, physical labor that is pretty dangerous when you think about what some people do on the job. What are your thoughts on the way that this might spill over to Ford as well, just because, their workforce is so large?
Yeah, we've had Rick Newman, one of our columnists here who also is pretty dialed into the auto industry, say that, this is really impacting GM, and this is GM's strike to deal with just simply because of the way that the contracts are timed. But really, this is a bigger automotive story for all of Detroit. It's not just Ford that you mentioned, and they do have a lot of hourly workers, but it's also Fiat Chrysler. They have a large amount of production here in the United States and a large workforce as well. The GM auto force of 48,000 in this UAW strike is obviously quite impactful, but Ford and FCA executives are watching this very closely as well to see what the impacts are. But the problem is that we still don't know exactly what the provisions are that GM would be agreeing to with the UAW, simply because the contract negotiations are still ongoing. I think it's been, a month now?
5 weeks?
5 weeks, yeah.
It's a long time. These are issues that are needing to get resolved, not just at GM, but again, as we talked about, it spills over.
But I think this is a bigger issue, if you tie back what's happening with Uber and Lyft in California right now, right? So you have the hourly wage war and the discussion on healthcare, and there's a lot of innovation kind of happening within the healthcare industries in the U.S. as is, and most workers now are starting to be either independent workforces or hourly workers. And so in this kind of new workforce, I just don't think that wage rights or worker rights have caught up to what the new economy is shifting to, and so maybe creating more flexible healthcare programs is the answer versus trying to create, strikes on historic issues is what I'm looking for.
Yeah, and another bit on Anna Marie's point was that, the new economy also involves a lot of automation. And I think the reason why you have GM pushing back against these 48,000 workers is because they know at some point down the line they would ideally not want to employ 48,000 workers in the first place. They would like to automate a lot of that line where they don't have to worry about these healthcare costs or worry about what the proper hourly wages are per state and local law. This is part of the structural change. Not to bring another econ angle to this, but there was an IMF study from last week that said the more permanent damages to labor markets are actually done by productivity changes with regards to automation, not trade-related shocks. So when we talk about these two negotiations going on at the same time, U.S. versus China, and then UAW versus GM, there's actually something to be said that maybe the more longer-lasting effects are being seen in the UAW-GM debate because of the fact that automation is kind of the biggest threat to displacing labor.
And probably not surprising then to see some of the Democratic candidates, including Andrew Yang, talk about automation so much on their platform, since these are real effects of it, and now we're seeing it play out for GM and their workers. But before we go to break, I want to highlight some of the names that we track on this show right now, and just a painful Monday for our cannabis friends. Right now, Aurora Cannabis off nearly 4.5%, as well as Canopy off by about 3% after getting downgraded by analysts at Seaport. A tough day in the cannabis space seems to be a trend that we've continued to highlight here on Wi-Fi PM. Well, coming up, why a New York City official is calling to adopt a rule from the NFL to ensure companies like Disney and AT&T interview diverse candidates in CEO and board member interviews. We'll chat with the controller behind the new push next. Plus, Congress is probing e-cig companies over allegations of using bots to push vaping on the public. More on that when Wi-Fi PM returns. Welcome back to Wi-Fi PM. We are checking the market action right now on a bit of a quiet Monday as the Dow is up just 9 points. The S&P and the NASDAQ right now flirting with break even. We'll see where things go throughout our hour. Well, a New York City official is calling for the Rooney Rule in the C-suite. For those unfamiliar, it's a rule that the NFL has implemented to require teams to interview minority candidates for head coaching jobs or other senior positions. And our next guest has sent a letter to over 50 S&P 500 companies, including AT&T, Boeing, and Walt Disney, to implement the same guideline when searching for new board directors or CEOs. So joining us now is New York City Controller Scott Stringer. Thank you so much for being here.
Great to be here.
It's a very interesting push here, right? Because obviously a lot of people, I think, understand that diversity right now is lacking in the C-suite or on the boards of companies. But why do you think that necessarily interviewing diverse candidates will directly lead to a rise?
Well, you're absolutely right about the question of diversity in financial services. It's almost non-existent. When you look at the CEOs of Fortune 500 companies, 6.6% are women, and I think there's 4 African-American men who are who are the chairs, CEOs of these companies. So it's a 1950s model that doesn't bode well for the 21st century. So what we want to do is say to firms, look, interview someone of color, interview a woman. When you do that, the floodgate opens. You actually increase the chances that you will have a woman as CEO, more people on the corporate boards. And why do we want this? Well, one, it's a big civil rights issue, right? We want diversity. We have women and people of color going to the best schools, getting the best degrees. They want a career in finance. They get hired. They start moving up the elevator. And then something happens right before the C-suite and the corporate board. And we want to change that. And the way to do that is by implementing a rule that would force people to interview well-qualified candidates. They will get hired.
Now, a clarifying question might be, what is New York City's jurisdiction in being able to put something like this into effect? Is it only for institutions that are domiciled or incorporated in New York City, or those that have presences in New York City? What can you do about it?
Well, I'm the chief fiduciary of our pension fund, which is $200 billion. It's the 4th largest in the United States, 14th largest in the world. So we're sending letters to 50 companies that we invest in where diversity is not a priority, and eventually we will turn these into resolutions. You know, I have a right to protect the pension fund, and the way to do that is to look at companies and say, how can I make them better? And studies have shown time and time again, when you have more diverse boards, you actually have stronger companies. That's actually fact. It's been studied, and yet that's not happening in financial services. So we want to give companies the opportunity to go find the best and the brightest and not worry about, the standard 1950s model of what a CEO looks like. The CEO looks like everybody today, only we got to give people chances.
Yeah, I mean, we just signed a partnership with Titan Advisors to actually work with multiple shareholders, so large hedge funds, to also think about what their hiring practices are on diversity, because obviously the same traits fall in financial services where there's a lack of diversity on investment teams or partnerships in these funds, and these are also major shareholders. So how are you working with other shareholders in the companies that you're sending these letters out to also change their framework of thinking around the diversity issue?
The companies that we invest in, we have a right to ask these questions.
Absolutely.
But we've also taken this throughout the country. When I first got elected controller 6 years ago, we began the Boardroom Accountability Project. We believed in proxy access, the right of people to run independent directors. When I started this campaign, there were 4 companies that had proxy access rules. After years of campaigning around the country on the corporate boards and in financial institutions, we're now up to 600 companies. So change and collaboration really go hand in hand. I do think there is, as we look at our changing country, it was only inevitable that financial industry would also have to confront that look in the mirror and say, look, if we're going to be stronger and better and grow our companies, then we're going to have to change our practices, and that's something that is a real priority right now.
Well, we should note that one of those companies that you sent a letter to is our parent company, Verizon. So that's something that we got to put out there as well. But when we look at it, what would you say to people?
Last time on the show, bye.
No, of course not. But when we look at it, what would you say to people who might push back on the idea? Because you're saying that you're giving companies the opportunity to go out and hire these diverse candidates, when they might say, we already have that opportunity, we're actively trying to pursue these, so go ahead and put this requirement in place. It's not going to change our push. Have you heard that from the companies when you reached out?
But you're saying it does change the push. When you actually have that 1 in 3 comes in the door, the chances of more diversity at the board level and the CEO level, we've seen this in other models, it just goes up. It actually works. So if you're really committed to diversity, then bring people in, get that person that everybody's talking about, but no one wants to interview, and put that person in the room, and you really will change the company. And by the way, when people see a more diverse corporate board and CEOs with real opportunity, well then, think about it. Your company is going to attract the best and the brightest, the young people who are also changing how they view the world. And they want to come into companies that are going to honor their work ethic and give them an equal chance to get to that C-suite and the corporate board and those big compensation packages.
There's enough studies now that show that more women on boards and diversity actually show better returns to shareholders.
There's no question, and I would argue that perhaps if there was less groupthink at Enron and WorldCom and more women and people of color on those boards, perhaps the scandals of the financial collapse would not have happened.
I love that. My thoughts exactly.
All right, there we go. We've reached some sort of agreement here on this board. All right, Comptroller Stringer, thank you so much for taking the time. Appreciate it. All right, well, while we're talking about New York City, it's also facing pressure from ride-hailing companies. Right now, Lyft is suing the city to block a new rule that limits the amount of time drivers are allowed to spend on the road without passengers. And according to the Taxi and Limousine Commission, they are enforcing the cruising cap rule to avoid congestion on the roads of the city. Guys, we should note that Uber also sued New York City last month on the same issue. Now Lyft is joining in that push here. Anna Marie, I know that you are invested in Lyft.
Thick and thin and Lyft all the way.
When you look at this, I mean, what do you make of this kind of fight now between the city and these big ride-sharing companies to kind of?
I think this regulation's candidly just a little out there and nonsensical, right? Telling drivers to pull over and not drive around when they don't have someone in the car. Why don't taxis follow that same rule? I don't think it's going to significantly shift congestion. I think you're going to have stack-ups on the side of the road of people just waiting around. And Lyft and Uber actually, I know Lyft for sure tried to add technology to switch off apps during low periods of users in their system. So they are cooperating, but putting in regulation in place, and certainly an organization like Uber is just going to find the next loophole. It's not a good argument for reducing carbon emissions. I think requiring Lyft and Uber to convert a percentage of vehicles to electric vehicles or alternatives would be a much stronger argument, and probably something that Lyft would be much more willing to comply by. Not sure about Uber.
Yeah, and I think that when it comes to figuring out congestion, I mean, who's to say that the city has the best measure of what the right amount of vehicles on the road should be from these ride-hailing companies? I think that there was a question to what degree, when these ride-hailing companies were really coming onto the scene, of how much they were actually replacing traditional people just driving their vehicles as one person, one car, and kind of clogging up the city, and whether or not that was being replaced kind of at a 2-for-1 or 3-for-1 with these ride-sharing cars. I think that at large, for New York City at least, I mean, there are other ways to try to tackle these issues that don't specifically target these companies. Suggestions like the tax, the toll that would be below 60th Street for anyone getting into Lower Manhattan. I mean, whether or not you think that's a good policy is up to you, but that's another way that kind of confronts the congestion issue in a kind of blind way towards drivers, but also Uber cars as well.
Yeah, and demand.
Or a carbon tax, right? I think that would be just
also that
super interesting.
Yeah, or I mean, just the way that you talk about caps versus taxes on these things, generally it seems to be a safer approach to slap the tax on there to figure out who's actually in most need of transportation here. A lot of people, when you talk about specifically how you might adjust for these things.
Another way is fix the subway.
Bold take there, Brian Chung, right? When our comptroller's here, no less, in the studio. All right, well, scrutiny is also mounting when it comes to e-cigs in the U.S. It's not just New York City going against the ride-sharing giants out there. And now the latest development when it comes to investigating big vaping has to do with bot accounts that companies may have used to push its products on the public. And the House Energy and Commerce Committee is teaming up with Massachusetts Attorney General to probe whether manufacturers used bot accounts to mislead consumers about the safety of e-cigs and health benefits, according to the Wall Street Journal. The Congressional Committee put in requests with the 5 biggest vaping companies in the U.S., but Juul Labs, which controls about 75% of the e-cig market, told Yahoo Finance it has never engaged in bot advertising as a company. A spokesperson told us, quote, "We do not engage in social media marketing of our product, and our brand protection team utilizes advanced web crawling technology to scrupulously monitor social media platforms for counterfeits, trademark infringements, copyright infringements, and violations of platform policies. Content containing counterfeits, infringements, and policy violations, whether bot-driven or not, are reported for removal as soon as they are identified." So it's not Juul apparently doing this, if you believe the company there, not engaging in bot advertising. But of course, we've also seen Juul remove their social media accounts when it comes to kind of the questions around putting their products in front of teens, trying to target teens. So they just straight up said, we don't need it anymore.
Exactly. I mean, they've already gotten in trouble for blatantly targeting, younger generations to start smoking again. I think these companies are candidly horrific and they need to go away.
Wow, all right. So that's an
smoke.
interesting take because you've pushed, you talk about what your company focuses on in terms of investing in ESG type things. E-cigs had been put in that category for a long time. So you never thought it was good?
Never thought they were good. Impact or ESG is all about taking an investment and optimizing for creating something better towards the future world and future society.
Yeah.
And in a future society, no one would be smoking, right? And that generation that is now smoking Juul or other vapor companies' products, they weren't into cigarettes, right? They weren't going to start smoking in the first place. And I think you've seen that move for the realization to remove different flavors from the marketplace because that does target a younger audience quite blatantly.
Yeah.
I think there's a lot of risks associated with these companies, and the amount of information that's negatively coming out on them now is just scratching the surface. So I would short every company that owns large shares in these vaping companies.
And there's a hard count on those that have been diagnosed with vaping-related illnesses. So independent of whether or not they become smokers or not is an issue in and of itself too.
And a short period of time, right? Cigarette smokers don't develop lung disease and cancer in a period of 3 years unless you're, doubling down.
It's pretty fast, yeah.
Yeah, well, it's
vaping
not.
is how many years old, right? We're talking about 2-3 years.
Yeah, well, we should know. We had the professor behind the NYU student, the first one linking cancer in mice to vaping. But that, of course, mice living cycles are very different from humans. But also, we should note, not necessarily when we talk about the vapor-related illnesses, not really cancer-linked there. And also, not to defend these e-cigarette companies, but the truth is still out there that cigarettes are able to be sold, even in the states when we're talking about states that have banned e-cigarettes, cigarettes still on the shelf. And we know that those are bad.
Yeah, with really compelling photos of, lungs missing and half your face missing, right? And vaping doesn't have that same regulation.
Yeah.
This has only been around for so long.
It's only, and the policies need to catch up quickly. I think there's just a lot of policy risks.
It seems like it's definitely happening, though, when you talk about the pressure, not just the FDA, not just the FTC investigating this, multiple state attorneys general, and now, as well, bot accounts, potentially a problem there. So every facet of these companies being investigated, so we'll see what comes from that. But for right now, let's check in with Scott Gamm on the floor of the New York Stock Exchange for more on this quiet market Monday. Scott?
Hey there, Zach. Well, stocks are taking a bit of a breather after the big gain we saw on Friday, driven by optimism over the trade talks between the U.S. and China. And it's natural for stocks to kind of take a pause after a big move in either direction. But even with some of the slight declines we're seeing today, we're holding on to the bulk of last week's gains across the market. Now, within the Dow Jones Industrial Average, your leaders are names like 3M, Nike, and Pfizer. You even have a name like Apple slightly in the green, building on some of the record highs that Apple made back on Friday. Apple is one of those trade-sensitive stocks. And then in terms of broader leadership, we are seeing financials lead the way. That is the best performing sector in the S&P 500. It's slightly in the green right now. And of course, we do have bank earnings starting tomorrow with JP Morgan, Wells Fargo, Goldman Sachs, and Citigroup all releasing results tomorrow morning. And bank earnings tend to set the tone for the rest of earnings season just because the banks are so levered to the economy. But the stock reaction to bank earnings is a little bit harder to pin down just because lately there are so many narratives surrounding the banks and their stories. It's not just about whether they beat earnings expectations or not. You also have plenty of yield curve worries out there, Zach.
All right, Scott Gamm on the floor of the New York Stock Exchange. We'll check back in with you later. But right now, we have some breaking news to get to. Uber has laid off roughly 350 workers, according to our sister publication TechCrunch. The layoffs reportedly impact employees in Uber Eats, its advanced technologies group, and recruiting. The company's CEO wrote in an email to employees saying, quote, "We all have to play a part by establishing a new normal in how we work." As you can see there, Uber's stock up by about 4%, not necessarily moving on this news. It's been up for most of the day. So that's an interesting development. We've also got in the email that TechCrunch acquired, the CEO saying that it's its final round of layoffs, something that's been going on at Uber for quite some time.
Yeah, I mean, I would say that the market hasn't even caught this news yet, or they're rewarding them by cutting back some of their costs. But I still think, a lot of the motivation from analysts on Wall Street is saying that Uber Eats is the growth areas of the businesses or their technology, and they're laying off from those core businesses. So that seems to be not the right story, or maybe it's a reflection even of what happened with WeWork's IPO and tech companies being more responsibility for where they focus their energies to be faster to cash flow positive.
Yeah, there has been a lot of pressure on companies that aren't yet profitable when it comes to that specifically in terms of where they're allocating resources. And we know Uber's marketing team has seen layoffs before this round. So that had been the trend either way when we talk about Uber.
I mean, the stock's been punished, and I think investors have acknowledged that there needs to be some change in the way that this company is targeting its profitability goals over the long term in a way that maybe has incentivized them to rethink their strategy with Uber Eats and maybe trying to change or at least shift around their workforce. I mean, for what's worth, 350 people, that's about, I just did the calculation based on about, I think, 19,000 employees that they have. It's about 2%, so it's not sizable, but I mean, of course, when you have your colleagues getting laid off, it does have an impact on morale and whatnot, so interesting to see.
That's not going to get them past their billions of dollars of losses.
Yeah, so I don't know if that's enough to move.
I don't know what that does to the bottom line.
I don't know if that's enough to move the needle.
Haircut.
But for now, it says it's the final round, so we'll see what happens there. But next on Wi-Fi PM, Senator Elizabeth Warren is trolling Facebook over the company's hands-off approach to political ads. We'll explain more on that as the social media company faces new concerns as more partners join PayPal and MasterCard in ditching Facebook's crypto project. The latest on the Libra apocalypse when Wi-Fi PM is back in 2. Good afternoon and welcome to Wi-Fi PM. I'm Zach Guzman, and joining me today, my very good friends, Yahoo Finance's Brian Chung, along with Flat World Partners CEO Anna Marie Washer. I don't know why that was funny. It's very honest.
You're my best friend.
All right, now it's funny. All right, let's check the market action we're seeing right now. And right now it's red across the board, just slightly. The Dow off by about 13 points, the S&P off by about 4, and right now the NASDAQ keeping pace, off by about 8.5. We'll see where things go throughout our second act. And as we move on in Wi-Fi PM, another company is calling it quits on Facebook's Libra. Bloomberg reporting that online travel company Booking Holdings is now dropping out of the coalition. And this comes after Visa, MasterCard, Stripe, eBay, and Mercado Pago announced last week that they are pulling out of the crypto association. And of course, CEO Mark Zuckerberg is set to testify on Libra before the House Financial Services Committee next week, guys. So that hearing just got a little bit more interesting when we talk about all of his friends now removing themselves from this project. How bad does that look before you go to Congress?
It's not good, but it doesn't also look good to be launching your own cryptocurrency blockchain project around the time that you're facing increasing scrutiny on Capitol Hill for all the privacy-related issues that you've had over the past few years. So I think that it's no surprise that you have some companies that are backing out. We knew for some time that the agreement to have these, I think, 26 or 27 members as part of this founding network was not binding. So they could have bowed out if they wanted to. And I think it was no surprise that you had the payment processors kind of dip out first. I mean, they were kind of just probably part of the project just to see how the tech would work. But I mean, in essence, PayPal, Visa, all those guys are actually should be invested against any sort of technology like this that could disrupt their entire business model. Yeah. I think when you see Booking.com kind of dip out, that's what I think a bigger deal here, because here's the company that isn't necessarily in direct competition with Facebook's Libra just bowing out because they just probably don't want the regulatory scrutiny, even though they're not directly tied to the business model. So I think that's kind of interesting. It'll be kind of fascinating to see if Lyft and some of the other kind of consumer-facing products do the same.
Yeah. Definitely some hair-raising activity there. But, I just wonder what the appropriate behavior of Facebook is to kind of take control of becoming a bank, essentially. And I think it's a very smart move because they have the user base there. But I agree with you. It's interesting that it's mostly the financial firms. I think because they are under more regulation and scrutiny, they don't want to be associated with an organization that's still testifying and under a lot of scrutiny themselves. I was surprised they signed up for this. I mean, cryptocurrency still has a lot of regulation, and Mark Zuckerberg does not go by the rules of regulation.
No, but I mean, when we talk about this too, that was kind of the point, right? The point of bringing all these other companies on board was to say it's not just us. This is a coalition of all these companies coming on board with us. But when you have PayPal, MasterCard, Visa, eBay, Stripe, Mercado Pago, as I said, and Booking Holdings all now saying they don't want to be part of this, it does kind of remove that shield from the regulation, because if that trend continues, it will just be Facebook there stuck alone in this partnership, and no longer do you really have the shield to say, look, it's not just us anymore. And that all goes away.
Yeah, I mean, I think also what's important, though, to note is that this whole Calibra, Libra, whatever you want to call it, project is still very young and it's in its infancy. We don't really know what it's going to look like. Yeah. The white paper, which is all we have, is basically just a concept. There's no real mechanics to how this would work. There were rumors about what even the currency basket would be for backing a unit of Libra. So this could all change as the members change. Maybe they add new members that make the use case different. I mean,
sure.
But they wanted to get this out by next year. I think that's very unlikely.
But Facebook is still the largest population in the world. So do they even really need anyone else? Like, they can use this, incubate the idea, get their users to buy in, and force the market to change, which might be actually a better approach and slow the process for changing regulations, which is what the government asked for.
If they can get over that hurdle of the government being fine with it, and we'll see what happens later on in the month when Zuckerberg does testify and how ugly that'll get if this trend continues, but we will see. Meanwhile, when we're talking politics and Facebook, Senator Elizabeth Warren is ramping up her fight against Facebook's political ad policies. And the presidential candidate's campaign ran an ad on the platform that falsely claims CEO Mark Zuckerberg endorsed Donald Trump for president. It reads, in part, "You're probably shocked, and you might be thinking, how could this possibly be true?" Well, it's not, sorry. But that's what Zuckerberg has done, is given Donald Trump free rein to lie on his platform and then to pay Facebook gobs of money to push out their lies to American voters. So a little bit of a stinging kind of their own medicine, I guess, being it's just Elizabeth Warren
love
trolling
Warren's
him.
move. I mean, that was such a solid move to lie on Facebook and say, oh, you can play this game, I can play this game too.
Yeah, I mean, she's trolling, but I think that, the poll numbers speak for themselves. I mean, Warren is rising in the polls, and I think she's really landing on her own platform of trying to break up big tech, trying to break up the big corporations. I mean, Wall Street is not most afraid of Bernie Sanders, who's his kind of running joke was, I got to break up the big banks. Actually, Warren is the one that I think Wall Street is the most afraid of. And I think her to kind of own on that platform and take the really more progressive stance compared to those kind of maybe in the more centrist, like a Biden or a Buttigieg, I think is really interesting. And as we get closer to 2020, we'll see if that's a strategy that ultimately pays out for her.
She has said that she has capitalism in her bones, so that was something that Bernie Sanders has...
Well, that's the thing you say in the United States.
I wonder that Wall Street's really afraid of Elizabeth Warren. I think Bernie Sanders is scarier from a financial markets perspective, but Elizabeth Warren is starting to take a fresh approach because I think her message has been somewhat outdated, and that was one of the arguments around Hillary Clinton, is showing character and presence. And I think this move shows a tremendous amount of character and presence that our generation can appreciate.
Yeah, that's a good point. That's what got Donald Trump elected in 2016.
Yeah.
Trolling?
His personality. Just personality.
That too.
Everyone,
Personally, yeah.
Millennials appreciate a good troll. I appreciate
Behave
a good
like a
troll.
maniac, and you will get a
He's got to tweet more, though.
Oh, well, it's tough
Broken
when you break up.
sentences.
You want to break up big tech. Tough stuff. But she is trolling, and it is a very creative way to get your message out there, no doubt. But it was a big weekend in entertainment as El Camino, a Breaking Bad movie, made its long-awaited debut. And interestingly, the beloved series made its return on Netflix rather than AMC, where the show originally aired years ago. And here now to discuss the latest in the streaming wars is Yahoo Entertainment senior writer Ethan Alter. And Ethan, good to see you.
Good to see you.
Obviously, the El Camino movie, we talked about it last Friday. There's a lot of buzz around it, but what do you think about the move to put it there on Netflix rather than the old AMC approach?
Well, I mean, it just goes to show how Netflix was instrumental in building the show to begin with. I mean, when it originally aired on AMC, the first 3 seasons were sort of famously low rated, it wasn't exactly the biggest hit. Suddenly it goes on to Netflix early on when it's still building up its streaming library. People start watching it. That's how I watch it, actually. I didn't watch it in its original run on AMC, those first 3 seasons. I caught up with it, and by the time it came back for season 5, I think they said the numbers had jumped about 10 million. So a lot of that has to do with people just catching up on Netflix, and so they went there first.
What have you been hearing on the review front? Have you watched it? I mean, what are your thoughts about the actual content itself?
Well, there's a lot of Mr. White out there on the interwebs.
Yeah.
I sort of fell in between. I mean, I thought that there were some really great sequences in it, and certainly it was fun to see some of the characters again. Like, spoilers. I don't want to give too much away for people who haven't watched it yet, but there are definitely some return of some famous faces. You might see a certain, chemistry person or two, so that was fun. But I also felt that there were some sequences went on a little too long. There were some characters I didn't feel really needed to be there.
Sure.
Where it ends up was like, well, do we really need 2 hours to tell a fairly 10-minute story maybe? So yeah, I have mixed feelings about it overall.
I think there's an assumption about the quality of a movie if it's released, kind of straight directly to consumer, or if it's played in the theater, right? And I'm comparing basically El Camino to what Downton Abbey did with releasing their film in theater. So you've watched both of those films.
Yes.
Was there a noticeable distinction in quality between El Camino because it was released on Netflix? I mean, Netflix does have a lot of money compared to maybe the budget that was used for the Downton Abbey movie.
I wouldn't say that just because, El Camino, it's certainly a little bit. I mean, certainly El Camino is very, like with Breaking Bad had a very specific directorial style. And so everything that Vince Gilligan, who created Breaking Bad, does afterwards always tries to mimic that style. So El Camino is very much already in the world of Breaking Bad, so it follows that style very, very much to the letter. And so it actually feels of a piece. I think with Downton Abbey, the idea was let's really, as you said, let's really blow it out. It's on the big screen. Let's give it a reason. You get to see much more of the house because that's what people want to see in the Downton Abbey movie. You get to really use a lot more of those rooms. I think Breaking Bad and El Camino, it was much more about continuing the visual language that was started on the show. And so if you reinvented that too much, it wouldn't feel like Breaking Bad. So
I'm not necessarily the biggest Breaking Bad fan, and I know that's going to alienate me among some people out there, but shifting away from Breaking Bad to focus on the general theme, which is, of course, the streaming wars here. I want to highlight Disney, of course, released a preview of some of the titles that will be made available on its platform, Disney Plus, later next month, and a lot of content is new and old, a good mix of these names. Of course, we just saw what the Breaking Bad franchise has done for Netflix and driving people to watch this.
Yep.
But if you think about what Disney has in its arsenal, the same can be made about what's going to be coming there.
Absolutely. And certainly one of the things that by sort of announcing this is everything you'll see on Disney Plus when it launches on November 12th, the whole idea is to try and say you have a reason to want to get this right away because you're coming to a library filled with content. Netflix has a very big advantage that way in terms of the amount of stuff they have on. They've had 5 or 6 years to build up this extensive library. Yeah. People want to know what's on Disney Plus. What am I going to be watching when I sign up for this? So a lot of these tweets today are saying, here's everything you've got. And so and then there are little things, depending on what pops, that gives them the impetus to go back and maybe make continuations of those things. Swiss Family Robinson, the classic 60s Disney movie, right? That's a great one. I grew up watching it. What if enough people stream it, suddenly it becomes they do a sequel series. Yeah. Like in the 2020, someone's stuck on an island. Oh no, they don't have their iPhones. What do they do? It's that sort of thing. They can find a way to remake it within that ecosystem.
Yeah, and I mean, we don't even talk about Marvel, but maybe talk about the comic book cachet as well, was also very much on display. Right. I know it's not necessarily a comic book movie, but the Joker is what everyone's talking about right now. I should just say Joker, because that movie's laughing all the way to the bank. The movie held the top spot for the box office this weekend, according to Box Office Mojo. Ethan, many analysts predicted this movie wouldn't do so well. Of course, it's pretty controversial when we talk about kind of the fears about what this movie might be doing out there to the public. I watched it. I thought it was phenomenal. I thought Joaquin Phoenix might be finally getting that Oscar here. Do you agree?
He certainly is in the running. I mean, he certainly is. The big question is, will the controversy work against him or in his favor when it comes to Oscars? I mean, I think the other thing to remember is that the Joker is one of the most successful Batman characters of all time. So even though the controversy could get in the way of the grosses, I think in the fact that there was that element of danger to it only made people want to see a Joker movie more.
Did you guys see it? You guys watch that?
I did not.
It's on my list.
Oh man, it was good. I thought it was very good.
And you could see again, like if since this did well, HBO, Warner Media has HBO Max launching. Maybe there's a Joker series in there somewhere.
It's about time DC got a W.
I know.
It's about time. It's been overdue.
They had Aquaman last year. You know, they had a series of wins.
Aquaman.
Yeah,
everyone loves Aquaman. All right, Ethan, thank you so much for bringing it down.
Thanks so
Appreciate
much.
you taking the time. All right, well, coming up with the holiday season just about a month away, the Points Guy will join us for a look at the best and worst airlines for your trip back home if you need to take to the skies. And next, we're going to chat this when we're back in 2 minutes. Welcome back to Wi-Fi PM. Right now we are watching a very quiet Monday when it comes to the market action. You can see they're right across the board, but the Dow off just 2 points. We might see that move into the green again, where we started the show, when we come to the end of this show as we approach 2 p.m. Eastern Time. Well, the holiday season is quickly approaching, and the Points Guy is out with the best and worst domestic airlines for families. And JetBlue took the #1 spot, flying past last year's winner, Southwest Airlines. And Allegiant Air was ranked the worst. So tough break for those guys. Want to dig into this a little bit deeper, so joining us now to break it all down is the Points Guy's Director of Travel, I should say, Summer Hill. Not just summer travel you cover, Summer, but also the holiday season as well. So why don't we break down this list? What actually makes JetBlue #1 when we talk about travel?
JetBlue does a lot right. And to win this, basically, you just got to do more right for families than everybody else. So they have free snacks. They have the largest economy seats in the U.S. They have entertainment. They've got the free DirecTV. They've got the free Wi-Fi. And they make it pretty easy to get a seat assignment without paying extra. So They nudged just past Southwest this year. It's the second year we've done this report, and it was interesting to see them take the top spot.
Hey, Summer, Brian Chung here. I'm kind of interested to see Alaska in fourth place. They recently had that merger with Virgin America. So I'm wondering, I mean, how has that affected them in some way? I think there used to be rave reviews for both Alaska and Virgin America, but I'm wondering if maybe that kind of synthesis has changed the game for them or changed their experience for customers deciding to fly with them.
Yeah, when it comes for families, some of the things, I mean, Alaska did really well, but some of the things that hurt them for us was it's not as easy to get pre-assigned seats on them as some others, and there's no built-in entertainment on their planes for the most part. There's none of those little things that made it where JetBlue got the top spot and they came in just a little bit below, but they still did really good overall.
Well, let's take a look at that last place there, Allegiant. I mean, when we're talking about them, behind Spirit, which I think says a lot to a lot of our viewers out there. Some people have problems with Spirit, so to be behind them, not very good. What's going wrong there at the bottom of the list?
Yeah, they were last of the pack. Allegiant doesn't have really a traditional frequent flyer program, which is something that obviously will ding them in a points guy reports.
Sure.
They have, no built-in entertainment, seat assignments cost extra. All of those things that are common for all of the low-cost carriers, but Allegiant just took an extra hit with not even having traditional miles you can use for your reward flights.
All right, tough break for Allegiant, but still strong showing for JetBlue. Summerhill, thank you so much for breaking all of that down. Appreciate it.
Thanks for having me.
All right, well, Kenyan runner Eliud Kipchoge stunned the world for finishing a marathon in less than 2 hours' time. It was the big story over the weekend, but it won't go down in the record books. And that's because the running track did not meet rules of the athletics governing body, and wind resistance was vastly reduced for the race as the superstar runner trailed an electric car. So that'll help you out when you're trying to draft behind a vehicle. But the other piece, and this is very interesting, Brian Chung, as a big fan of Nike, you're wearing Nike shoes right here. He was actually wearing a brand of Nike shoes that has historically been worn by the other record holders when we look at marathon time. So a lot of people calling that out as well as a potential unfair advantage here as well. The Vaporfly Next shoe is what it's called.
Yeah, well, I mean, I think it's also important to note, though, that yes, I mean, there might be some technology in the shoe that could kind of help you shave a few seconds off your time. Ultimately, running a marathon is about the technique by which you train for it. I did the Chicago Marathon a few years ago, and I was wearing a pair of Adidas shoes. I highly doubt that if I had just simply switched to this pair of shoes, I would be able to shave off 30 minutes
I
off my
disagree.
time, right?
I'm now signing up for a marathon with those shoes.
We'll see. We'll test it out.
There's an opportunity here.
It's
yeah.
shocking. Only 4 men have ever run a regular marathon, the ones that actually count, in less than 2 hours, 2 minutes and 57 seconds. And all of them, I repeat, all of them, did so with the assistance of the Nike Vaporflies.
Well, how about this?
Strong branding.
She'll wear the shoes, I'll wear my regular shoes, and then you can wear your dress shoes, and we'll see who runs the
See who
fastest,
runs.
right? How about that?
Somehow I knew I was going to
We'll do
put on
this.
blast for my
Sign
shoes.
us up. We're ready. Let's
Yeah,
go.
it's very. You ran the actual full marathon, the Chicago one?
All 26.2 of it.
Wow,
So they
very
said.
impressive.
So
You
they
haven't
told me
run
it.
one yet, but you're thinking about it.
Thinking about it.
You should
on the fence.
definitely do it.
Okay, well, now that I have the shoes.
Now you gotta do it.
I've run 2
Send
half
it on air.
marathons, and I always think that counts.
If you add them up,
if you do 2 halves, it counts. And these, of course, we're not in the Vaporfly. So there you go. Anna Marie Washer, thank you so much for taking the hour. Brian Chung, thanks to you as well. My good friends, we're going to send it to another good friend of mine, Scott Gamm, on the floor of the New York Stock Exchange for more market action. Scott?
All right, Zach, thank you very much. I'm joined now by Peter Tuchman. So, Peter, after Friday's big gain, fueled by trade optimism, do you think the market's level right now is justified?
It's really hard to say. I think we saw the market react. Look, there's always the old premise, buy the rumor, sell the news. We were up 500 points on all the hope and all the irresponsible dissemination of information that we really kind of had a deal Friday. And in the last moments on Friday, which I think are important to watch, we saw the market take off about 200 points of the 500-point rally. I think that was either the buy the rumor, sell the news story, or that was the market really saying, you know what, we don't have a deal. These are just headlines. These are little blips. Nothing is etched in stone.
So the fact that we're not selling off today, what does that tell you?
Well, I'm not clear whether it's the fact is that there will be a deal in the wings and people are hanging their hat on that hope, or the bottom line is that we do have a bank holiday today. If they really wanted to sell them, they could have sold them today, and they didn't. I think the next thing we need to know is that the market tends to have ADD. What are we going to see in the coming weeks? Are we going to really be wrapped up in whatever happens with this China story, or are we going to focus on earnings? And I don't think we have a clear direction on how the earnings are going to be, because the two stories are really interrelated. We saw that come out of about a month ago when the head of JP Morgan and a number of the other banks had to say, you know what, I can't really give you clear guidance on what the next quarter is going to look like until we have a deal with China, because there's going to have a lot of bearing on what's going on forward.
And JP Morgan reports tomorrow. So, I mean, is that an important factor in this market, or is it all about trade?
I think we have two narratives happening. One's a trade story, whether that's a go or not, and one is the earnings going forward. We really have to wait and see.
Okay. Peter Tuchman, always great to have you here. Thanks so much. Zach, we'll send it back to you.
All right, coming up, why one analyst is advocating buying Nike's stock despite the NBA's fallout in China. He'll explain why he says now is a buying opportunity just ahead. The ticker all over it starts in 2.
Good afternoon and welcome to the ticker on Yahoo Finance. I'm Akiko Fujita. Let's check the market action to kick things off today. Things feel like it's been in a bit of a holding pattern. The Dow is up 25, though. The S&P 500 pretty flat right now, and the Nasdaq's up roughly 4 points there. Let's start with the big headline today, the U.S.-China trade deal, a top concern for investors following that announcement of a Phase 1 trade agreement on Friday. Now, Treasury Secretary Steven Mnuchin provided a little more color on the status of the deal, which is yet to be signed, on CNBC earlier.
We have a fundamental agreement. It is subject to documentation, and there's a lot of work to be done on that front. But it includes intellectual property rights. It includes financial services. It includes currency and foreign exchange. And it also includes very significant structural issues in agriculture, on top of significant purchases. So I would describe Phase 1 as quite substantial. As the president has said, as soon as we get Phase 1 complete, we'll move to Phase 2.
Let's bring in Anna Ashton. She's the director at the U.S.-China Business Council. Anna, you heard the Treasury Secretary there. It seems like we've got the one side, the U.S., saying this is a Phase 1 deal where there have been fundamental agreements in place. And then you've got the Chinese who have yet to call it a deal. How would you characterize what went down on Friday?
Well, I would characterize it as very similar, Akiko, to what happened in late June when President Trump and President Xi met on the sidelines in Osaka. I think, coming out of that, the president was very firm that there was a deal for significant ag purchases and that they had agreed to restart negotiations. And of course, that's not what ultimately played out. And so I think that there's reason to worry that this won't ultimately play out as optimistically as the administration has described it to us. Also, I do think that it's positive that Mnuchin has stated that all the things that were included in this negotiation were the things that the Chinese said they were ready to make compromises on. So, we could yet see a written agreement, but 5 weeks is an awfully long time for, misunderstandings to surface, and it sounds like maybe they already have.
Let's talk about what we should look for next, because there's still a lack of clarity here, I think, on both sides. And that is the 5-week window that we're talking about, where both sides are expected to come to the table to at least hammer out something in writing. Secretary Mnuchin, they're saying the deputy level talks are next. They will be speaking by phone. What should we be looking for on that front?
I guess we should be looking to hear from the Chinese side, really, what kind of commitments they're making. We haven't heard anything public from the Chinese side yet, and that's been pretty characteristic of them throughout these negotiations this year. But privately, when we talked to the Chinese government, we have heard that they came to the table ready to talk about financial services openings, ready to talk about progress on IP protection and enforcement, and ready to talk about ag purchases. So hopefully we will see all of that in some way in a statement from the Chinese as we move forward and get closer to the APEC summit in Chile, where the presidents might meet.
The ag purchases, at least based on what we've heard publicly, seems to be the one certain thing, anywhere from $40 to $55 billion in purchases on the Chinese side. There's some question around what was actually discussed on IP. Secretary Mnuchin in that same interview said that, yes, intellectual property was discussed at length, but he also said that that's going to be part of Phase 2. What's your understanding from those who are close to the talks in terms of what the Chinese agreed to and where the sticking points still are?
We actually don't have a lot of insight into that just yet, but we're hoping to get more this week. On the ag purchases, I actually think that that's less certain than it sounds. 40 to 50 would be a good 10 to $20 billion more than China has ever bought in a single year from us, the highest year being 2013 when they bought $29 billion in ag goods. Certainly there's a lot of room for China to buy more because, they could buy beef, which they haven't really bought in the past. They have the swine flu to contend with, so they could buy a lot more pork. But that's a really big number, and, we have yet to hear details on what it will include.
From a market perspective, no question investors are looking at the data on both sides of the equation to say, well, who has more of the leverage here? Chinese shipments to the U.S. slumped nearly 22% in September from a year earlier, according to data we got from General Administration of Customs. Yet we've also heard that the Chinese are willing to see a bit of they're likely to see the slowdown of the economy and maybe tolerate that a bit more, given that they've been going through a lot of domestic structural changes as well. How do you see that dynamic playing out in terms of who holds more leverage?
Yeah, I mean, it is, as always, really hard to say exactly who holds more leverage, but this is a really interesting point because obviously it's bad for China that their exports to the United States are down 20% in September compared to a year earlier. But on the other hand, it's bad for us too, because it indicates that people are buying less. And we're seeing that in other statistics that have been out recently, like a recent report that 1 in 5 Americans is, spending more conservatively in preparation for a possible recession, and that 1 in 5 are also hiding cash in their homes in case of a recession. So part of the reason that exports to the United States are down is because Americans are buying less because they're worried and the uncertainty has continued for so long. And then there's the other factor that, with a global slowdown, even if tariffs were suddenly lifted, China might be, maybe has to expect that there won't be some quick rebound in their exports to the United States or even elsewhere because consumer demand is down everywhere. So the leverage that tariffs were supposed to be giving the United States in these negotiations just might not play out as leverage at all.
Okay, Anna Ashton, I appreciate you joining us today.
Thanks for having me.
Well, meanwhile, Goldman Sachs is predicting a 60% chance more tariffs will be added by the end of the year. Let's bring in Kathy Entwistle, who's a senior vice president at UBS Private Wealth Management, as well as George See. He's the CEO of Annadale Capital. George, I know you disagree with some of what Anna was talking about in terms of the leverage that is at play here, but let's pull back a bit to talk about what exactly played out on Friday. How do you assess the results from an investor standpoint?
Well, I think it's comically precise for Goldman Sachs to say there's a 60% chance that tariffs are going to be put on in December. Nobody has any idea what the Trump administration is going to do on tariffs. It changes all the time, and I think the market reflects that. The market has been acting like a yo-yo the last several months because they really don't know where this is going, and they don't have any idea what the extent of the impact on our economy is going to be. So that uncertainty is creating a lot of choppiness in the markets right now.
Yeah, what we do know right now is at least the tariffs that were set to take effect tomorrow have now been put on hold. The December 15th tariffs are still on the table, as Secretary Mnuchin has said. What do you make of the reaction that we got on Friday, where we actually saw a huge rally, and then once the announcement came down, we saw a bit of a pullback?
That's true. It was interesting. I would say that was our 13th conversation, 13th negotiation, and we thought, well, maybe this is lucky 13. And it turns out that things did go a little bit better than expected. The market reacted. But once I think people had a chance to really look into it and see what was happening, they realized it wasn't quite as tied up as nicely as they had wanted. So I think that was just a reaction.
The common thread, it sounds like, from a lot of the trade groups that came out, whether it was the farmers or the tech association, was that, look, it's a good thing that the truce is in place now, but yet not knowing what's coming after that adds more uncertainty. What do you think this does in terms of the confidence?
Markets hate uncertainty, so it diminishes confidence. And I would agree with what Kathy said a minute ago in that unless you're a farmer, what happened on Friday is just a rounding error. It's tiny. And all we did was not take 25% tariffs to 30%. So it's a step in the right direction, but it's just a step. And the reality is we're going to be walking this walk with China for the next several decades because they're going to be our arch competitor, both in trade, commerce, national security, every area you could think of for some time to come.
I know you are an investor, but you're also involved with the Republican Party as well. I'm wondering what you think of the way this was announced on Friday. Do you think it was a bit premature from the Trump administration, given that nothing is in writing and there's still a lot of details that need to be hammered out?
I think it was mostly political. I don't think it was that substantive, and I think the administration wanted a small win for political purposes, and I think that they crowed a little bit too much about it because it's just one small step, like I said. But they wanted to put a win on the board, and I have to say a win is good for America, even if it's small.
You agree?
Well, I would say in terms of agreeing, I think a win is always important. In terms of whether we should consider politics when we're thinking about our economics and our markets, I would argue that the two should be very separate, and we should not consider that the markets are going to go up or down from a political standpoint. I think we can consider the tariffs and business issues when we think about the markets, but I think it's really more healthy to separate the two out.
So from an investment standpoint, are we any different? Are we at a different place than we were when we started Friday morning? Because trade has been the big overhang. At least we know now that there's not going to be an escalation in the short term.
Right. I would say the difference is there's a little bit of a light at the end of the tunnel. We're starting to see that perhaps there's opportunity for agreement and maybe some tariff rollbacks and things like that. I also agree that December we have $190 billion that can have the 15% tariff assessed to those products, and that will bring back to the consumer their decision of whether or not to spend or not spend. And I think that's really how everything will be affected.
George, I'm going to give the final word to you. You could argue that because this has been so prolonged, the definition of a deal in some ways has been muddled. What exactly would be considered a win? How would you define an actual deal that the administration can point to as a win that would actually resonate with the market and investors? I know we're connecting a lot of dots here, but clearly even investors saw that this really was just an announcement.
I think there's the short term and the long term. And in the short term, we got to win on Friday. And I think that if things in the Middle East stay somewhat stable and we don't get further unrest, it's a huge if. And if we don't have escalation in the tariff battle between now and year end, the markets just don't have any alternative to stocks, and I would expect we'd get a Santa Claus rally in that instance. But in terms of a real win, which is what we really want to talk about, because policy and politics should be completely two separate things, and unfortunately they blend together almost all the time because politicians just can't be purists on these kind of things. But in the long term, we've got to have ironclad intellectual property protection. We've got to have open markets for our companies. We've got to have a lack of this piracy. We've got to have transparency, and we've got to have enforcement mechanisms if the Chinese lie, cheat, and steal like they have for decades now. And that's going to take a long time. And I wouldn't expect even half of that before the next election. I think the Chinese are going to try to wait out the administration. And the problem for them is their economy is getting really dinged by this. Their exports last month were down 11% to the U.S. So they're feeling real pain.
Okay. George and Kathy, good to have you on today.
Thank you.
Let's get to our big three tickers. UAW workers are seeing a bump in strike pay as a walkout against General Motors enters its 5th week. Boeing is stripping CEO Dennis Muilenburg's chairman title as the 737 MAX jet crisis persists. And a crucial meeting for Facebook's Libra project gets underway as major backers pull the plug on their support. But first, the United Auto Workers strike against General Motors now entering its 5th week, with the union increasing strike pay for auto workers on the picket lines to $275 a week. Inez Ferre is with me. Inez, what should we be looking for, and is there any sign that a deal will be reached soon?
Well, certainly the fact that they've extended this payment, so the union extended their payments to $275 a week for the workers, means that this could go on a bit longer. Now, the union had sent their members a letter on Friday night saying that progress had been made. Where we stand right now is that on Friday, the UAW gave a counter proposal to GM. We know that there were talks that went on throughout the weekend on Saturday. GM last Monday had given a proposal to to the union, so that counter proposal was that proposal that GM gave on Monday. But certainly, this is starting to get tough for the workers as well. I mean, GM is losing money here on lost production, and the workers are also they have bills to pay. It's the weather's starting to get colder, and there's real concerns about about meeting those bills. Now, one other important announcement with this expansion of the weekly pay by the union is that workers, their members, can also get part-time work that exceeds the $275 a week and still be able to get that $275 per week.
Okay, thanks so much for that, Inez. Let's move on to our next ticker, and that is Boeing. The company's board is stripping CEO Dennis Muilenburg of his chairman role. The executive responded to the changes in part, stating, "Our entire team is laser focused on returning the 737 MAX safely to service and delivering on the full breadth of our company's commitments." Heidi Chung is with me. Heidi, let's talk about who the new chairman is, first of all. And this is David Calhoun, somebody who has a reputation for really coming in to some of these companies that are really in crisis mode. So it's interesting to see how investors are going to interpret this. Is this a sign that Boeing officially is kind of in this crisis mode? They need somebody like him to come in, or is this a good sign that maybe they are starting to turn the corner?
I think both of those points are extremely valid right now, Kiko, but yes, I think you're right to say, well, who is David Calhoun to begin with anyways, right? So he's not a new face. He's been on Boeing's board since 2009, and like you mentioned, he has dealt with crises before. So he was actually the head of GE's aviation unit at one point as well. So he's not a new face when it comes to Boeing or aviation and aerospace. So he is not someone that people are concerned won't be able to run the ship, let's say, in case CEO Dennis Muilenburg may not be running the company at some point in time, right? So I think there are two ways to look at this situation right now. And since the announcement on Friday evening, we've heard two separate sides. So on one hand, folks are saying, well, this is a non-executive position. So all Calhoun is really going to be doing is really speaking to shareholders and communicating with them, as well as running the board meetings. So right now, Dennis Muilenburg still does oversee the day-to-day moves throughout the company, and he will be overseeing making sure that the 737 MAX gets into the air as soon as possible, and that will be his main focus going forward. Now, on one hand, we have people saying, well, this is kind of a slap in the face for Muilenburg, right? This is stripping him of his chairman title. But on the other hand, you also have people saying, well, I think investors should feel better about this because now he can really focus on getting those 737 MAX jets into the air as soon as possible and really focus on making sure that this drama is really behind the company. But this is the start of the fourth quarter, not a necessarily great start for Muhlenberg, but he has a lot of stuff on his plate. First of all is obviously getting the 737 MAX in the air as soon as possible. Second is maintaining the production of these 737 MAX jets. Now, there have been some reports that Calhoun and Muhlenberg aren't necessarily seeing eye to eye when it comes to the production of these jets. So right now, Boeing is producing about 42 of these 737 MAX jets per month. Now, some of the reports are saying, well, Calhoun thinks that they should bring the production number down, especially because they don't know exactly when the 737 MAX jet is going to be in the air again. But optically, it also doesn't look good if that's the case, right? If they bring down the production or even halt the production altogether, that makes it look like, okay, this is a bigger crisis than a lot of people were thinking. But on the flip side, of course, we have Muhlenberg saying, no, we should keep production at 42 per month, because if they do bring down the production and halt it, what does that mean for Boeing's suppliers? Are they going to have to start laying off their workers as well? As we've seen with the GM strike as well, it's not just GM that's at the forefront, right? It's not just Boeing. They have the suppliers to think about. It's a lot of trickle-down negative impact if there is something that comes down to halting production altogether. Now, I just do want to mention, they have a big congressional hearing scheduled for October 30th. So if Muhlenberg does not deliver at this hearing, it could be a big blow to Boeing. So perhaps maybe this splitting up of the chairman and CEO role was seen as a way to potentially mitigate future damages in case Muhlenberg doesn't do so well at this hearing. I think all eyes right now really are just on this hearing at the end of this month. But if we take a look at Boeing's stock price today, since the grounding 7 months ago on March 13th, the stock is essentially flat. So in terms of investors and the stock performance, maybe Muhlenberg has done okay. We don't know. We'll just have to wait and see, I guess, at this point.
Yeah, and maybe there's an argument to be made that the risk has not all been priced in just yet. All right, thanks for that, Heidi. Our third ticker of the day is Facebook. Bloomberg reporting that online travel company Booking Holdings is now dropping out of Libra. This comes after Visa, MasterCard, Stripe, and eBay announced that they are pulling out of the Crypto Association last week. Dan Halley is with me with that story. So Dan, walk us through what we have seen play out over the last several days. We know the Libra Association is meeting today. What are we expecting to come out of that?
Yeah, we're really just supposed to get kind of a groundwork for how the Libra Association will be governed. And that's really what this big meeting is about. It's nothing more than basically laying out how they want things to be run in the association, have all the major players come together and kind of sit down in the same room. But a lot of those people who originally were going to be there are no longer there. We had PayPal drop out originally. Then, as you said, on Friday, we saw MasterCard and Visa leave, as well as Stripe. And then we also just saw Holdings leave. So a lot of people, a lot of companies rather, seem to be either feel a little cautious about this Libra cryptocurrency, or they simply just want to duck out now before there's any kind of controversy ahead of Mark Zuckerberg appearing before Congress next week.
Dan, one other thing we've been following on Facebook is this face-off that we've seen between the social media platform and Senator Elizabeth Warren, who, of course, the presidential candidate. She intentionally posted what was a false ad saying that, look, she's putting the challenge to Facebook to try and see, whether they are going to, in fact, tackle some of the disinformation out there. Can you talk a bit about where Facebook is in all of this and what this means, more than a year out from the 2020 election?
Yeah, Elizabeth Warren is, not hiding the fact that she's a major critic of Facebook. She wants the company to be broken up between Facebook, Instagram, and Messenger. And this is one of a number of kind of attacks that she's launched against the company. She previously took out an ad near Facebook's campus, basically saying that it needed to be broken up with her face on it. And this is kind of her way of poking at the company and saying, look, you want to allow politicians to be able to post inaccuracies or outright lies in their ads. We're going to do that and see how far you're willing to let them go. And she's pointed that there was an ad posted about Joe Biden getting $1 billion or something along those lines from either Ukraine or China. So this is something that she's really trying to push in on. It's been something that a lot of people have been critical of Facebook for. They've talked a lot about how they're trying to secure the network ahead of the 2020 elections after the fiasco that was the 2016 elections. But this really doesn't seem to be the answer to the way they want to do it. They constantly say from Congress or to critics, look, we don't want to be the arbiters of truth. We want to be hands off with things like this. But when it comes to these kinds of ads, Elizabeth Warren is essentially saying you can't do that because you're allowing lies and fake news to be spread. And she's really testing them on where they stand on that now.
Okay, thanks so much for that, Dan. Well, coming up, can Netflix's upcoming earnings reverse its recent big slide? A top expert weighs in next. Plus, a fresh blow for Canopy Growth and the cannabis sector. We'll have those details ahead. Welcome back to the ticker. Let's check the markets halfway into the show here. Green arrows across the board. We've seen trading stay pretty flat today amid some of the uncertainty around what exactly that phase one agreement was on the U.S.-China trade announcement on Friday. Let's head out to Scott Gamm on the floor of the New York Stock Exchange. Scott.
Hi there, Akiko. Well, yeah, stocks are wavering. No real meaningful direction in either way, either to the upside or the downside. Stocks are largely flat, and that's natural just given the big gain we saw on Friday. It's typical for stocks to take a breather a day after a big move in either direction. When it comes to the stocks leading the way today on a flat day within the Dow, we're looking at names like 3M, Nike, and Pfizer. Those are your best performing Dow stocks. Even a Dow component like Apple is still in the green today for the second straight session. It's up about 0.2%, building on some of the record highs Apple saw back on Friday. Apple is one of those trade-sensitive stocks. And then when it comes to broader sector leadership, financials, that's one of the best performing sectors in the S&P 500 right now. We do have bank earnings starting tomorrow with JP Morgan Chase, Citigroup, Wells Fargo, and Goldman Sachs, all set to report third quarter results tomorrow morning. And we know that bank earnings tend to set the tone for the rest of earnings season just because banks are highly levered to the economic outlook. But remember, the stock reaction to bank earnings is a little bit hard to pin down just because there are so many narratives surrounding the bank stocks right now, not just what their revenue was or by how much they beat earnings expectations. There's a lot of yield curve worries when it comes to the banks right now. And then one other stock we're watching today, Akiko, shares of Uber are up over 4% today. There was a report in our sister publication, TechCrunch, saying how Uber is laying off 350 workers. That's about 1% of its total workforce. This comes months after Uber has laid off hundreds of other workers so far this year, Akiko.
Okay, thanks so much for that, Scott. Well, Netflix is gearing up to report quarterly earnings this week. This comes as the streaming company is facing more competition in the space from Disney and Apple. Shares of Netflix have fallen roughly 20% in the last 3 months. Let's bring in Ray Wang. He is the founder and principal analyst at Constellation Research. Ray, you know, Netflix coming off of a big week with that release of El Camino, and yet there's still a lot of questions about what if they have the right content mix to compete with Disney as well as Apple. How do you view the stock right now?
Oh, I think there's a lot of upside. This was probably the worst performing FANG of the year. But the upside is coming because of the turnaround in content. It is a battle for content and time and attention. And Netflix has proven that they are serious about investing in the content business. And so what we saw in the last quarter was really a revamp in terms of getting the content strategy right, picking up shows like Seinfeld for $500 million so that they could offset the losses they were getting from people cherry picking Office and Friends away from them. And then also creating new content like El Camino and, of course, Stranger Things. So we're starting to see that mix come into play. The real question is, how's international growth? People are guessing 6.1 million subscribers. And can we get any more new ads in North America, which is looking like they might get 500,000 to 600,000 more ads. But we think they might be able to get somewhere to close to 7 million new ads. And that's the number that everybody's really looking at.
Yeah, a lot of the discussion around streaming has been kind of framed in this zero-sum narrative, if you will, that essentially Disney's win is a loss for Netflix, or Apple can gain but Netflix loses. How do you think investors should be looking at all of those services right now? And do you think Netflix has been maybe a bit oversold on the back of some of these big announcements from competitors?
You know, Kiko, that's completely right. People have the wrong sense that it's a zero-sum game. You know, the most people can handle is about 2 to 3 services. So you're probably going to do Netflix plus Roku, Netflix plus Apple, or Netflix plus Disney. But Netflix is the constant in all this, right? People are going to have Netflix plus something else that they might not be able to get. And so we see Netflix as the bigger winner behind this and capturing most of people's mind share. Having Disney in the marketplace and Apple priced the way that they're priced, those are all and strategies, not or strategies. And I think that's what investors need to know. But they're going to see that not until Q4. Well, they're going to watch, okay, people actually spent more overall on streaming services, and they included Netflix plus something else.
Having said that, you pointed to some of the big shows that Netflix lost over the last few quarters, Office as well as Friends. Where does Netflix, content-wise, make up that loss?
They have, and that's the purchase of Seinfeld for $500 million. That's probably one of the biggest deals in the marketplace. And the content creation machine is on full force at Netflix. So they're definitely looking at that and building out additional franchises. So that's why Stranger Things was good. El Camino's launch is a big one. But more importantly, I think you're going to see over time that Netflix is going to find that right demographic because it's got data from users and they've got preferences from users, so they can understand what shows are working and know when to cut shows earlier than before. And these data-driven networks that Netflix is part of is part of that ability for them to actually tailor that content in the right way.
And Ray, finally, you know, so much of the competition that we talk about is really domestic, and yet Netflix a while ago started to see much more growth on the international side as opposed to what's happening on the domestic front. Who poses the biggest risk for Netflix in terms of the competition outside of the U.S.?
I think it's regional players that are in the area. For example, in India, right, Netflix has a great stronghold, but in the long run, companies like Reliance are going to get into that market. Netflix may have not as big of a stronghold in APAC, right? So they're competing directly with Tencent in the future, right? But in each of these cases, Netflix has built an international brand, and the fact that they're not ad-supported gives them a lot of trust in the markets, just like people trust Apple because they know that they're not going to broker their personal information. And that trust factor is very important. Now, once they get into an ad model, if they were ever to do that, they would break that trust. But it doesn't seem that that's where the direction is headed with Reed Hastings and the company.
Okay, Ray Wang, always good to talk to you. Appreciate your time. Coming up, a grim call against Canopy Growth is triggering deep losses for the cannabis sector. We'll explain. Plus, how much the NBA China controversy could affect Nike's bottom line. Don't go away. Welcome back to The Ticker. I'm Akiko Fujita. Let's give you a quick recap of the tickers we've covered in the show today. Our first ticker was General Motors. With the UAW worker strike now in its 5th week, the union is boosting its strike pay to $275 a week. That's up from $250. Union members will be also allowed to seek part-time work as negotiations between the two sides continue. Second was Boeing CEO Dennis Muilenburg being stripped of his chairman title as the company struggles to navigate its 737 MAX jet crisis. David Calhoun, who currently serves as Boeing's independent lead director, will take over as non-executive chairman. Our third ticker, Facebook, the consortium for its Libra cryptocurrency project, meeting today in Switzerland to review a proposed charter. The gathering coming as more than half a dozen major backers, including MasterCard and Visa, have cut ties because of intensifying regulatory scrutiny. And we're checking the closing price of oil. We have seen some big moves in this session today, down more than 2%. 53.53 a barrel is what we are looking at. Investors focused on the global demand outlook as questions linger over the progress of that U.S.-China trade deal. Well, let's get to our next group of tickers. Tapestry is tumbling in the wake of a tough downgrade. A gloomy assessment for Canopy Growth triggers a new sell-off for cannabis stocks, and a major bank warns of intensifying competition for Beyond Meat. First to Tapestry, though, the parent company of Coach and Kate Spade getting a downgrade from buy to neutral at UBS. The bank says the resale market will pressure Tapestry's brands. Heidi Chung is back with me. We'll get to the resale market in just a bit, but this note isn't just about Tapestry. It's about sort of these mid-tier brands, and the outlook certainly isn't looking good, even going into the holiday shopping season.
Right, and when we take a look at Tapestry specifically, Stuart Weitzman is seen as sort of a higher end shoe brand. But when we take a look at Coach and Kate Spade, like you mentioned, they're mid-tier luxury, right? So I think that entire industry has sort of been struggling to find its group of consumers. Which group of consumers are they even targeting at this point? Because if we take a look at the struggling parts of Tapestry, it's certainly Kate Spade, which they acquired in 2017, as well as Coach. Now they're doing a lot of partnerships with really relevant celebrities like Michael B. Jordan, as well as Selena Gomez. But on the flip end, that still gives a lot of question as to, okay, what is really the message here?
What is the brand's identity?
Right, who are they even trying to target at this point? So when we take a look at this note, now there was a downgrade to neutral, but they did maintain the price target of $25 per share, which is roughly where it's trading at now. So I can't necessarily say that's a solid price target call right there. But of course, the stock is down 25% just this year on a lot of these concerns that, well, this analyst says the resale market, which is booming. Specifically, though, Kiko, when we take a look at the resale area, it's all about the RealReal, which actually IPO'd earlier this year. The stock is again at its IPO price at about $20 per share, but this resale market not just appeals to the younger generations because you can buy luxury goods for the same price that you can buy a brand new Coach purse, but if you think about socially responsible investing, right? You're not paying for a brand new leather purse, you're reusing a leather purse that was already previously made. So those folks out there that want to buy things that are more economic or eco-friendly, I should say, I think that really appeals to them. But UBS also saying that the U.S. consumer holiday spending intentions are looking lackluster. That is actually not good news.
Talk about low single-digit growth.
Right. So that's not just bad news for Tapestry here. That's bad news essentially for the entire retail market if we look at this holiday season, because a lot of what's riding on this economy is health of the U.S. consumer, right? So if we don't see a big, vibrant holiday shopping season, I think not just Tapestry, but a lot of other retailers have to be worried here.
If you look at all the Tapestry brands, Kate Spade has been the one that has kind of weighed down the stock. If you could argue that because there's been questions about the relevancy of the brand and where the strategy is moving forward. At least in this note, it provides a long-term positive outlook. I guess the takeaway is that it's going to take much longer to get to that turnaround than initially anticipated.
Specifically years. Now, they don't specify how many years, but they say, I think that Kate Spade at this point will be able to turn around. Let's just give it some time. But one bright spot for Tapestry, Akiko, is definitely the Asia market. Now, I know there's a lot of concerns out there. Trade war, tariffs, how is that going to affect a lot of the American retailers? But Tapestry has been able to grow sales in Asia consistently for several quarters here. Specifically, Coach does extremely well, especially in the outlets as well. So while there are a lot of negative outlook and sentiment around Tapestry, I think that having a bright spot such as Asia is actually really good, and people should feel better about that.
And you could argue in Asia that secondhand market isn't quite as strong. You've got sort of the luxury buyers who just go for the full price, and then others who are looking for mid-tier, so certainly a good area at least of growth. All right, let's move on to our fifth ticker, and that is Canopy Growth. Seaport Global is downgrading Canopy Growth from buy to neutral, pointing to supply issues. This comes after the cannabis sector was hammered last week following disappointing outlook from competitor Hexo. Dan Halley is back with me. Dan, walk us through the case for Seaport here. Why are they so cautious?
There's too much weed. That's basically what it comes down to. Is there's too much weed to be able to sell at the amount of stores that are available to sell them in. So basically what they're saying is they're going to take hits on margin, and there's just not a way to really move this product right now because there aren't enough opportunities to do so. And that's why you're seeing these kinds of downgrades. And this is something that the industry is going to face even if it's legalized in more states in the U.S., because in addition to legalizing it, they also have to open up different facilities to sell legalized marijuana in. And that's something that isn't exactly easy to come by. Think about how hard it is right now to get a liquor license in certain states or cities. That could be a similar issue that you see with selling legalized recreational marijuana in the U.S. So right now what they're really saying is, look, we've kind of hit a wall here in Canada where we have too much. Let's pivot to what's available in the U.S. right now. And they're talking about things like vape pens and the like, which is actually interesting because we talk about the issue with vapes and this mysterious lung illnesses that are happening, and a lot of them happen to be seemingly linked to some THC, at least in some reports. So there's not really an idea of whether or not it's black market or not, but it's another issue that they're going to have to deal with.
Okay, thanks so much for that, Dan. Let's move on to our sixth ticker of the day. That is Beyond Meat. Shares are under pressure after Wells Fargo initiated coverage at Market Perform. The bank is taking a cautious stance, though, and says Beyond is well positioned in the space. Inez Ferre is back with me. Inez, why the bearish outlook here?
Yeah, it's a bearish wait and see sort of outlook. What this note is saying basically is that, look, there are definitely generational changes when it comes to consuming foods, when it comes to sustainability, when it comes to animal welfare. So you do see a market for this, but their argument is wait and see. Let's look at the visibility of the competitive entrants in this space. Let's look at the marketplace adoption. They're saying that there's going to be a big push by private labels, by challenger brands. And you've seen that in the last months, basically. Tyson Foods, which was an investor in Beyond Meat before they went public, they sold that stake. They're now making their own plant-based products. You've got Nestle, which is shipping now their burgers to the U.S., to U.S. supermarkets, their plant-based alternative burgers. Conagra Brands, Kellogg, Kroger, all of these are either investing in or coming out with labels, their labels for these alternative plant-based products. And so there's a lot of competition coming into this space, Akiko.
Yeah, and as you know, one of the things that's interesting when we often talk about the alternative meat space, it's about how much this kind of demand can last. But one of the arguments here in this note is that the growing demand for sort of traditional meat is going to price some people out, and therefore means that alternative meat is only going to be an even bigger business because that's going to be the only alternative for those who can't continue to push with that higher prices for traditional meat.
Yeah, that's right. And, you know, there has been also concern about the production of this, right? Can they supply enough of this? But this note is saying that there are going to be more processes that are faster, all these issues are going to be ironed out eventually. So this is also playing into that competitive space. And you'll recall that Beyond Meat had recently announced that it was coming into an agreement with McDonald's to test their burgers in Canada. The question is that will that translate into the U.S. market eventually? Because we know that McDonald's has a deal with Nestle in Germany trying those burgers, those Nestle alternative burgers in Germany. And so the question is that will that even that partnership, which is a big one, also translate to the broader U.S. market?
Okay, thanks so much for that, Inez. Well, China's Tencent quietly resumed live streaming 2 NBA games, which were played outside of China earlier today. That's according to multiple reports. That's a sharp reversal from the move last week to block game broadcasts following a tweet from Houston Rockets general manager Daryl Morey that supported the Hong Kong protesters. China's state-backed broadcaster CCTV continues to shun the league. Let's bring in Sam Poser. He is an equity analyst specializing in footwear and apparel at Susquehanna, and he's with me here at the desk. So let's put the NBA aside. Obviously, last week when that whole discussion was happening, the attention turned to brands that are associated with the NBA, like Nike. Have we seen any fallout as a result?
Well, nothing's happened yet, and we think it's much ado about nothing. Nike is a huge brand. It's been in China for 30 years. Every check we've done over the years has been that the Chinese consumer thinks of Nike as a global brand and doesn't think of it as a U.S. brand. Also, basketball is only about 12% of their total sales, probably a little less than that in China.
So the counter argument to that would be that the NBA has had a presence in China for many, many years. It is the most popular sport when we talk about basketball. How much of your case actually overlooks some of the risks that could come from one comment from a Nike-sponsored athlete like LeBron James? As we've learned last week, it really just takes one to create the backlash against an entire brand.
It's the backlash, but if you're a 15-year-old kid who loves sneakers and basketball, I don't know if it's much different in China than it is here. You want what you want, and if you can't have it, you might want it more. So, and also remember, Nike makes a lot of product in China for China. They've been there a long time. I think the government might be doing one thing, and the kids probably are thinking another way, and that's probably why you saw this quickly get this game. Maybe the son of the premier said, "Look, Dad, I want to watch basketball."
Let me push back against that just a bit, though, because we have seen luxury brands, for example, Dolce & Gabbana. This was not a political issue. They had an ad last year that offended a lot of Chinese people. People were burning Dolce & Gabbana clothes. These are people who spent hundreds of dollars to buy luxury goods who are making a statement. I guess my question is, when you've got an international brand like Nike that has a huge presence in China at a time when things are so political, how do you calculate the risk of a company operating in China?
I think you just keep doing what you're doing. I don't think we've heard anything from Nike. Nike hasn't commented on this yet. It's all of the media and analysts and everybody else saying this could happen, this might happen, this might happen. I'm not really. I just think it's a lot of talk, and at the same time, day after I put my note out last week, we had another analyst come in, or this morning, another analyst upgraded the stock who'd been exceptionally negative for quite some time. Nike is just gaining a ton of momentum, and you haven't heard anything from them. I think if we hear something from them, then a lot of these questions become more germane, but they're not there yet.
Okay, let's step away from China and look at the overall strategy for the company right now. You're talking about the momentum that they have. Where do you see the biggest growth opportunity?
It's really across the board. One of the things that we think they got caught flat-footed, pardon me on that one, a couple of years ago when Adidas came up, and they really weren't ready. They didn't think the Adidas trend, Adidas would stay on, do as well as they did for as long as they did. So a lot of product they just slowed things down. Now they're back speeding everything up through their speed initiatives, really doing pretty much everything they can to enhance the brand through direct-to-consumer, through partnerships with retailers that present the brand properly, and so on. So it's sort of everything seems to be lining up, and they're getting their ducks in a row.
And strategy-wise, it sounds like you do believe the brand has turned the corner. The one overhang that you've already pointed out is the tariff issue, because a lot of their apparel, the footwear, is produced or manufactured locally. Is that a risk at all? How do you calculate that?
Not for the, so, and I don't remember all the numbers off the top of my head, but Nike, around 20 to 25% of the product of Nike product, it might even be less than that, that's sold in the U.S. is made in China. Less than over 60% of their business is outside the United States. So you really don't have that much threat, especially with their global presence as a brand. Brands that make a large percentage of their product in China and do a large majority of their business in the U.S., those are the ones that have the biggest challenge. Nike certainly isn't in that, and also innovation, newness, and everything else gives you pricing and brand, and all of that gives them pricing anyway.
Okay, Sam Poser, good to have you in studio today.
Thank you.
Well, coming up are the trade developments between the U.S. and China actually changing the sentiment of U.S. businesses. Plus, how the PG&E blackouts in California have residents looking to ditch the state for good. Stay with us. Well, despite the looming uncertainty of the U.S.-China trade war, a handful of American companies are still reportedly looking to pursue business deals in the Chinese market. Some of those businesses include PayPal, BlackRock, and JP Morgan and Tesla. Joining us is Ryan Patel with the Drucker School of Management, Senior Fellow at Claremont Graduate University. Ryan, what's the reaction in terms of some of the clients that you've been speaking to since the announcement came down on Friday?
Well, the question becomes deal or no deal. Nobody really understands what's going to go down, but I think what was really clear in the 13th round of tariffs, businesses have realized that they have to kind of move on. They can't wait and see what's going to happen, and that they're going to have to place the foundation going forward. And you mentioned about the businesses that want to do business in China. You mentioned PayPal. I think companies like that have to lay out a foundation and a relationship with the consumer and governments. And I think this is one of those things where I feel like we are going to move toward this route. I think companies are going to have to jump the curve before the deal actually happens if they want to make a foundation into the Chinese market.
So you're saying that there are more businesses going into China, or you're saying that, were businesses really holding back in terms of entering the Chinese market to see what the outcome of the trade deal was going to be?
The companies you just mentioned, which is not it's a small handful of them, that this trade deal isn't going to stop them, right? And I think to your point, what I was saying was majority of the businesses, small business, mid-sized, they are on the sideline waiting because they don't know if it's trade deal or no trade deal, so they're waiting and seeing. But this is an opportunity that we've seen some news, especially since last Friday, that there may be some more openings for some of these companies that China has, for example, let PayPal come in to compete with Tencent and Alibaba Pay. That is really kind of new news because in the heat of the trade war, it kind of opens up supposedly that's what's going to happen in the future. Not saying it's going to open floodgates, but it's an interesting conversation to have.
Well, we've also seen in this more than year-long negotiation that has played out on these trade discussions is companies that have been holding back on investment with the uncertainty. Does anything change as a result of what happened on Friday? And if anything, does the added uncertainty only hamper sentiment further?
Yeah, I think the business community sentiment is still on hold of investment. They're not really going spending. Actually, truthfully, everybody's just trying to get through December. They're really excited. Majority of businesses were really excited to see the October 15th deadline be pushed out, that there is no tariff between the U.S. and China, and that now the new deadline is December 15th. And that gives some breathing room for companies to get through the holiday season in the short-term mindset, and then really kind of say, well, let's figure it out in December. I think that gave a lot of breathing room for a lot of businesses to get through the holiday season. It's almost like step by step. They mentioned phase one, phase two. Businesses are looking this as a step-by-step basis. They're no longer looking at a long-term view of what this deal will look like.
And so what happens come December?
Well, that to me, December 15th is a deadline that was thrown down by the U.S. government, and that pretty much all tariffs on all goods will happen. And you would hope next month's meeting in Chile, hopefully with both state heads, will maybe lay out a potential phase two. There is no details on the timeline behind that. I think we will take a big step backwards should there be another round of tariffs by December 15th, because again, when you kind of build up a deal and you build up the confidence of the business community that everything's sort of back to normal, even though everybody kind of is still on edge a little bit, it's not good for the confidence, and it's not good for both countries.
What does this mean from a market perspective, you think? Is it risk off until then, or do you think that, it seems like we were seeing the market move on so many different headlines on trade, and yet come Friday, we saw a bit of a pullback on the back of an announcement that really didn't have a whole lot of details. How do investors move forward without knowing what's going to happen over the next several weeks?
Cautious. I mean, they've seen this story 13 times around the tariffs. They've seen that there's a deal, then there's no deal. There's a deal, there's no deal. You have to look at the fundamentals of each company and each places behind it. I think to react to every single, no offense, to tweet or news that's breaking out on either side of camp is kind of not something that is a strategy that I would want to follow. I think you got to look at it as a holistic view and look at companies that have backup plans or maybe be more aggressive in markets that are looking to go forward, and even on the consumer side.
Okay, Ryan Patel, good to talk to you. Thanks so much.
Thank you.
Let's give you a quick recap of some of the tickers we've covered in this show today. Our first ticker was General Motors. The UAW worker strike is now in its 5th week. As a result, the union is hiking its strike pay to $275 a week. That's up from $250. UAW workers will now also be allowed to seek alternative part-time work as negotiations continue between both sides. Second ticker was Boeing. CEO Dennis Muilenburg being stripped of his chairman title. Boeing says it's to allow him to more fully focus on resolving that 737 MAX jet crisis. The company's current independent lead director will now take over as non-executive chairman. Our third ticker was Facebook. The consortium for its Libra cryptocurrency project meeting in Switzerland today to review proposed charter. It comes after more than half a dozen major backers of the project, including MasterCard and Visa, pulled their support. And it is our last tick of the day. That is PG&E. California residents struggling with blackouts after the utility company shut off power to 750,000 homes as a preventative measure against wildfires. This comes as PG&E rejected an offer by San Francisco to buy its power, like within the city, for $2.5 billion. Yahoo Finance's Dan Howley, Heidi Chung, and Inez Ferre back to weigh in. Heidi, let's start with you, California native. We're seeing PG&E down today. Again, this is something we've been talking about for the last several days. How does the utility company move forward, number one? And do you get the sense that this may be a tipping point for how these utility companies operate in a state like California?
I think absolutely it does. This is actually kind of seen as a potential tipping point here for utilities such as PG&E and Edison in California, especially as they try to deal with mitigating damages from a lot of these devastating wildfires. But this move by PG&E was a way to sort of get ahead of potential wildfires in the Northern California region. It was a multi-step process, and they were looking to shut off about 800,000 homes for electricity. And honestly, hindsight is 2020, Akiko, but this did not go according to plan. Communication was stripped, and PG&E was unable to bring back power to a lot of very crucial areas, such as nursing homes. And a lot of folks out there are saying PG&E was not equipped to properly pull something like this off. And so this brings into question, well, what do utilities have to do then going forward if they're trying to make sure that their equipment, their outdated equipment, is not sparking wildfires such as this? Now, they did reject that buyout offer from the city of San Francisco, but thinking back on it, they said that this severely undervalues their assets. But at this point, what do these utilities have to do in order to make sure devastating wildfires like this don't take place? I think that's the million-dollar question here.
Dan, of course, the big concern, first and foremost, is about the hospitals and some of these emergency services that do need the power to operate. But we've also got to think about where this is all playing out. We're talking about Northern California, a big tech hub as well. What have you heard from some of these companies in terms of how it's hampered some of the operations on the ground?
Yeah, I think for a lot of the big tech companies, they're really just trying to make sure that their own systems are up to date and are able to survive any kind of blackouts. The issue here really comes down to the poor infrastructure that this company has. Obviously, that's why the wildfires get sparked, because their lines are too old, or their substations aren't set up properly, or they're just, frankly, old and need to be replaced. And not doing that is really the key issue here. But how they'll be able to completely redo their system, if that indeed is what needs to be done, I mean, how much is that going to cost them?
Yeah, and let me get your thoughts on this. Obviously, a big infrastructure issue for PG&E. Questions about why they didn't upgrade sooner. This, of course, all stems from the big Camp Fire last year that killed dozens of residents that were there on the ground. But what kind of implications do you think this is likely to have on some of the other utility companies out there?
Well, I think this is also being watched closely, how all of this was really handled, and the settlements that they have now announced with regards to these fires in the past, and how they're handling this now, and the fact that also San Francisco had offered to buy their utility lines there in San Francisco for $2.5 billion, and the company saying no, that's undervaluing our assets.
Heidi, the last word to you. Let's talk about the implications beyond California, because so much of the discussion right now has been about the state, and yet we often overlook the fact that even if you look at the food supply and some of the farmers that could be affected, that is likely to have a ripple effect across the country, right? I mean, this is right at harvest time. A lot of these farms have already talked about how they haven't been able to bring employers in or workers in because they just don't have the power to process some of the things they need to.
Absolutely, and I think that while we are talking about electricity here, it's also hurting the water supply for a lot of these farmers. And as we know, California is a state that has really struggled with droughts, and so that has definitely had an effect on the agricultural businesses out over in Central and Northern California. So that's another area, of course, of concern here. But as we continue to follow this story, I think we have to keep in mind that utilities are still private companies, and it's whether or not a question of should they be publicly traded companies.
Okay, we'll have to end it there. Thanks so much, guys. Coming up, analysts rumble over Apple amid strong China iPhone data. Stay tuned for the final round. That's coming up next.
Hello everyone, Miles Upman here in New York. This is the final round on Yahoo Finance. Stocks not doing a whole lot here. Investors doubting Friday's Phase 1 trade deal. We'll have more on that and all the market action coming up in just a bit. Plus, WeWork is weighing rescue plans even as it keeps pushing its aggressive growth with new locations. We'll have that story. And Wells Fargo getting bullish on Beyond Meat. We'll discuss that call in the Analyst Rumble. Plus, the head of the American Vaping Association says more regulation can end up pushing vapors back into regular cigarettes. He will discuss all of firestorm around the space right now with us in just a bit. Joining me now, we've got Yahoo Finance Editor-at-Large, co-host of First Trade, Brian Sazi. We've got host of Wi-Fi PM, Zach Guzman, and Yahoo Finance Chief Food Correspondent, Heidi Chung. A jam-packed Monday. The bond market closed today, half the market not here. You wouldn't know it looking at this desk. We've got a full house here. The market, of course, not really interested in anything happening today. None of the major averages moving more than 3 basis points, 6 basis points, 7 basis points. It doesn't really matter. This is like the market might as well be closed. And unfortunately for us, since the stock market is open, we're here, volumes down, bond market not open. Of course, many questions still remain about the future of that trade deal that we apparently reached on Friday. Blackstone Chairman and CEO Steve Schwarzman offered his take on the entire trade situation at the Yahoo Finance All Market Summit last week.
We're asking the Chinese to change their system. Their system was brilliantly designed as an emerging market, developing market economy. It's a time for adjustment. The question is, how fast will an adjustment come, over what time frame, and how dramatically at each point? Because no one would give up their entire system because someone else asked them to do it.
I mean, I guess, Heidi, nothing happened last week, right? Like, it just kind of feels like I came in today and then I realized that everything we talked about all last week was just for nothing.
Well, absolutely nothing. But I think this is a lesson in make sure you get stuff in writing before saying anything, right? So it's like deal, no deal, partial deal at this point. All of that is kind of up in the air. But I feel like stocks have essentially been stuck in purgatory for quite some time now. We can't seem to break back above that 3,000 level here. So at this point, going into year end, okay, earnings, a lot of folks out there, a lot of strategists are saying aren't really meaningfully going to move the market. So again, to the point, is it all just trade from here on out?
Yeah, Miles, I just dropped a piece on Yahoo Finance. I'm probably getting ripped to shreds in the comment section below. Always a scary place to be. But no details. Wall Street, everybody that we have talked to today said they do not like the fact there are no details to this. Secondarily, the tariffs are still in effect. And then third, nothing that came out on Friday removes the uncertainty that continues to rip through the executive boardrooms at corporate America. You put that two together, that's where I see this mixed action right here. Time for me to go home.
Far be it from me to come on the final round for the first time in a while and disagree with all of you because...
Really?
I mean, when you talk about the sentiment of the way that we were heading into these talks, too, I know it's a partial trade deal, and you say, what exactly does a partial trade deal even mean? But I mean, you just think about the way that we've changed the sentiment in these talks, because we did get something out of it when we talk about October 15 tariffs and the question about what we'll do now when it comes to December 15 tariffs. I think things are looking brighter when you at least have the Chinese side saying that they want to come to the table.
Well, I will say there was definitely a sense at some point in the lead up to these talks that maybe this would be it. If these went poorly, then we would just never talk ever again, right? And what you got out of it was a delay of the October 15 tariffs. They will not go into effect. So now, I guess, effectively, December 15th is the next deadline for this. But, Sazi, we had Trump on Friday. We took the audio here on the final round. He's saying this is phase 1. We will sign this deal. Then we'll start 2 and 3. And, of course, this morning, China, Beijing is floating rumors out there like, no, you guys got to come to us. We got to talk more. Then we can discuss signing
Miles,
this thing.
we are one Trump tweet away from whatever was reached on Friday to be completely blown up. And I think that's very alarming. If you look at it from a market perspective, look at what has happened in October into these trade talks. The market has been bid up pretty aggressively. Why shouldn't it sell off here? I think it should.
But honestly, I feel like this partial deal or whatever you want to call it is essentially China saying, okay, I'm going to buy $40 billion to $50 billion worth of soybeans and pigs and then call it a day kind of situation. What about the meaningful core issues here? IP theft. Like, what are they going to do about that? None of that has
those results. Political pundits would say they kick the can down the road for the next 30, 40 years.
I mean, that's a Schwarzman point, right?
Yeah.
It's like, just because I said you have to change the way you do, IP transfers in country doesn't mean you have to do it.
Yeah.
But at least there's a can. At least there's a can still being kicked down the road.
Such an optimist.
I'm just saying, you could have had the flip side. There could have been no can.
I appreciate the
That's
optimism there. All right, for more on today's market action, let's go to Scott Gamm. He is live on the floor of the New York Stock Exchange. Scott, a little bit of a snoozer going on down on the floor. What are you seeing?
Well, Miles, look, I think the market is taking a bit of a breather right now after a 1.5% gain on Friday. And just from talking to some of the traders down here, I'm going to kind of echo what Zach just said, which is that, look, stocks are taking a breather, and there's really no necessarily no need for much of a concern down here that what we saw on Friday was such a head fake, right? I think it's too early, just according to some traders, to declare that the euphoria that we saw on Friday has completely faded when you're looking at stocks down a mere 18 points. Now, there are plenty of stock-specific stories today, especially when you look under the hood in the Dow. You've got names like 3M, Nike, and Pfizer leading the way. We've got some record highs to tell you about. Nike shares hitting a record today on the heels of that upgrade from Bank of America. Apple shares hit a record high once again earlier today. Of course, it hit a record on Friday. Apple is one of those trade-sensitive stocks. And then just moments ago, Apple shares moved briefly into the red, but they're kind of wavering right now. And then when it comes to sector leadership, financials are leading the way. That is the best performing sector in the S&P 500 right now. And we do have, of course, bank earnings tomorrow with JP Morgan Chase, Citigroup, Wells Fargo, and Goldman Sachs all set to report third quarter earnings tomorrow morning. And we know bank earnings tend to set the tone for the rest of the earnings season. But look, the stock reaction to bank earnings can be a little bit harder to pin down lately just because there are so many narratives surrounding the banks these days. It's not just about by how much they beat earnings, it's also about the yield curve and some of the broader headwinds facing the financial sector. And then we're also keeping an eye on shares of the cannabis stocks, which today were, well, smoked. A lot of them were down today: Canopy Growth, Aurora Cannabis, and Hexo. There was a report today from independent investment bank Seaport Global sounding the alarm on the cannabis space, talking about an oversupply of cannabis that could hit pricing and margins. So that's one reason why you're seeing some pressure in the cannabis space today, guys.
Scott, we will allow the reference to those stocks getting smoked to pass on this Columbus Day. All right, we'll talk to you in just a bit. So it appears that WeWork's problems are far from over. The Journal reporting yesterday that SoftBank, which owns about a third of the company, has prepared a financing package that would give it control of the startup, further distancing the company from founder and former CEO Adam Neumann. SoftBank will relieve WeWork of its financial pressure. That, of course, intensifies after its IPO plans were scuttled. Very Wall Street Journal-y word there. Sazia, I guess the question now for WeWork is, we know that JP Morgan is basically going to try to line up some kind of debt financing so they can continue as a going concern. Is there a path forward for them to get past this phase and actually operate the business? Because this is obviously not operating the business. This is just fundraising to try to stay afloat.
I would say no. I think what we learned from the S1 and all the coverage since, that this business model has not been proven out. So if I'm at JP Morgan, I understand if you're Jamie Dimon and you have a strong relationship with Adam Neumann, but why are you loaning a company whose business model has not been proven, that is bleeding through cash, and the management team is an absolute complete mess? Why are you giving them $5 billion? At whatever rate, this is absurd.
So I know this was a debate for a really long time. Okay, is SoftBank going to invest more money and double down on its already more than $10 billion investment in WeWork? Or are they going to sort of back out here? And it looks like they might be down at this point. But my question is that a good move?
I think they're all in here. I mean, they've ridden that stock up to, what, a $47 billion valuation? Yeah. Why not now? Why not just go all in?
So, Zach, something we've talked about kind of internally, because we have a number of guests on, and we'll always talk about WeWork, and I think a name that often comes up that I like to bring up is like, how similar is this to Theranos? And everyone gets very offended, very, very offended when you bring that up. But like, basically the company's business model, it involves exchanging money, but it doesn't make any money. It actually increases losses. I mean, it doesn't seem to me that it's that far away from being, it's kind of like a fake business in a way.
I mean, it's a far stretch to go from saying something's a fake business and comparing it to Theranos to just saying that maybe the company's not as efficient as it could be, right? We're talking about, everyone likes to go ahead and compare the fact that, yes, you were talking about a $47 billion valuation. Keep in mind that a lot of that may have been tied to some options when we talk about way that funding was structured. So a lot of people would say it never really was a true $47 billion valuation. And sure, maybe that comes down when you think about SoftBank being the main driver of getting to that point in the first place. And so, yes, if you have a company that's put a lot of money into WeWork, saying, what are we going to do? Are we going to let this company go bankrupt because it needs a lot of cash right now? Or are we going to put some more money into it? I don't know if it's the same as saying, yes, it's a fraudulent, the same way that Theranos was. But when we look at it, I mean, I think there's still something that can be done here.
But more.
There's still a lot that can be done here to shore up, and that's exactly what they're trying to do, to make sure that this company is pacing and on the position and path to profitability. And I don't think it's too unfair to say that it'll get there at some point.
But these two options that are on the table for WeWork, is it an and or an or situation? So can they take money from SoftBank and also this debt deal from JP Morgan, or what's the deal in terms of?
I think it's one or the other.
Okay, it's an or situation.
Yeah.
I mean, the problem at this point for all of the entities involved, JP Morgan, WeWork, SoftBank, is like going forward when you are trying to do similar deals, whether it's invest in a tech company or raise some sort of creative debt financing for a company that perhaps is mostly acting on the faith of investors rather than a proven part of its business model. What does it mean for their reputations?
Yeah.
I mean, I think JP Morgan's probably going to end up being fine, but obviously SoftBank is now kind of a joke in VC circles.
Yeah, I would even add too, Bank of America Merrill Lynch had a good point this morning that a lot of these companies now, if they can't raise money, it might hurt innovation, and we might see a spike in inflation as a result. Go figure. That's their words, not mine.
Yeah. All right, Saz, see you tomorrow.
Watch the DAX. Watch the DAX. It's breaking out.
There we go. We're watching the DAX. All right, coming up here in the final round, Wells Fargo weighing in on the hot Beyond Meat trade. We'll discuss their latest call in the Analyst Rumble. But first, let's take a look at where the DAX and European markets finished on this Monday.
It's breaking out.
All right, time now for the Analyst Rumble. Some of the biggest analyst calls from stock names that you know and love. First, a name that we really love here at Yahoo Finance. That's Beyond Meat. Wells Fargo, kind of a tepid call here, initiating coverage of the company with a market perform rating, $125 price target, so pretty much right where the stock is trading right now. Analyst John Baumgartner thinks Beyond is well positioned to grow in the alternative meat space, but warns of competition. Heidi, you certainly know how crowded this space is becoming.
And I've certainly tried almost all of the competition out there. But that being said, we have Impossible Foods in grocery stores now. So that's already one big...
Only a few fancy ones in Southern California.
No, it's in the East Coast too now.
I thought it was just in Gleason's.
Okay, but it's still available, right?
Sure.
Up until now, it wasn't. So I think that's obviously the biggest competitor right now. But we also have Nestle's Awesome Burger, which also tastes relatively good. It's really on the same playing field, you guys. And we have Kroger coming out with its own private label situation as well. And if you think about it, Kroger is one of the mainstream grocery stores that carries a lot of these alternative proteins. So if you think about them having their own private label brands, how much of their meat section is actually going to be devoted to Beyond Meat or Impossible Foods at this point, right? They're going to put their stuff front and center. So I think that's a big point that we need to make sure that. What's your look at?
Again, I'm not taking the contrarian point here, but isn't the whole point the growth when we talk about Beyond Meat? A lot of that's been coming from their restaurant partners as well, right? So I mean, whether or not Impossible Foods is now challenging them in grocery might not matter as much if you're a growth investor looking at the fact that a lot of their restaurant partnerships are fueling the growth that we've seen in Beyond Meat. When you talk about the McDonald's trial up in Canada. I mean, that's really what's going on there when you think about momentum.
But just to play the other side, there's no guarantee that McDonald's is going to partner with Beyond Meat here in the U.S. I bring up this point all the time because restaurant brands, parent company to Tim Hortons and Burger King, we have Tim Hortons partnered in Canada with Beyond Meat, but we have Burger King here in the U.S. partnered with Impossible. So where's the loyalty there? There is no loyalty when it comes to brand.
Well, and I actually think, I believe it was Barclays' note on this space a couple weeks ago, sort of pointed out the economics of giving to or working with a restaurant partner are actually quite disfavorable, if that's a word, for these companies, right? You make more money if you get into a grocery store and you charge what, like $13 a pound for your meat rather than going to McDonald's who wants to buy in bulk for $3.99.
Exactly.
They're not necessarily exclusive either, though, right? When we talk about if you have something like a Beyond Meat burger in a restaurant that's prepared very nicely, and I've learned this myself when we cooked it up on PM, is that if you cook it at home, it might not turn out great, and then it's not good. So if you go to a restaurant, try it there where they do it well, then you might be more inclined to buy it.
That's such a good point, and I don't want to plug this, but on the move tomorrow, we are going to be
boy, what is going on? This show is just about the other shows.
Because we are going to reveal the results, but Julie Hyman and I tasted a lot of them, and they were prepared by a professional chef. So
big difference.
Big difference.
Okay, great. What time's that on, Heidi?
12:40 p.m.
All right,
Eastern
perfect. Next up today here on the final round, we've got UBS. Still bullish on Apple. That's because monthly government data suggests that overall iPhone demand in China quite strong for the month of September, up about 230% compared to 110% monthly growth last September. So, Zach, basically the iPhone 11 is a big hit in China.
Yeah, and we had this note. You remember Wedbush Securities put out a similar note a couple weeks ago, Dan Ives, and he was pointing to the production numbers over there in China, specifically when it comes to the new phone models there. So it's not necessarily a hot take in this note when we think about everyone else is now coming together to see that demand is a lot stronger than I think a lot of people were expecting there. But also, let's not forget that the rollout for this, too, very much hinges on the way that services will move and do moving forward. Because when you think about the way they were trying to get people excited about the new hardware models and the pricing structure of saving money on Apple TV Plus and all the other services they're trying to roll out as well, and tying it to price reductions in the models, Goldman Sachs taking the other side here, saying that if you move forward, you're going to see the earnings per share dented because of all of those benefits to the pricing structure as well. So it's kind of interesting to say, yes, okay, well, in China right now, things are going well because we're seeing strong demand, but what's it going to be when it comes to
and it seems to me like Apple has been trying to have it both ways with the services business for some time, and they're kind of accelerating that because, Heidi, they're basically giving away the Apple TV Plus if you get a new phone. So I think that Apple TV Plus is not even worth $5 a month. It's actually worth $0 a month. That's what Apple is implicitly telling you by saying, please buy more hardware so we can give you more services and thus continue selling the services story to investors.
Because Apple Plus they haven't proven anything yet, right? So they need to make sure that they have at least some eyeballs to watch the 3 or 4 shows that they're going to offer before they're able to say, okay, we have something here, we have some content, and you should be paying for it. So right now, it is valued at $0 essentially. Right. When we take a look at the iPhone, I don't know about your circle of friends and family or people that you know, but a lot of people have traded their phones in. I know you were thinking about it as well, but the last time Apple saw this much demand, I think, was in 2015 for the iPhone 6 and 6 Plus, and they're saying that the 11 and 11 Pro is doing just as well.
I don't want to name names, but I've heard some negative reviews of the 11.
Wow.
I think I know who you're talking
11
about.
Pro, sorry, 11 Pro.
That's
not going to
big,
name
though.
names, not going to speak on their behalf, but it has made me reticent to give in my iPhone 7, which isn't great, but still works. And I've dropped it dozens of times and it hasn't
So you
broken.
still have the thumbprint thing on it?
Yeah, it's great.
I'm kind of jealous about that.
I'm every time I sign into something, I'm like, oh my God, I'm gonna have to re-sign into all this other stuff, and I don't know any of these passwords. So another reason to keep my phone. Very quickly, let's talk about Bank of America's call on Nike, raising their price target to $98. That's from $70 a share. Shares getting upgraded to neutral from underperform. Unfortunately here, Bank of America notes that they kind of missed the call here. Nike shares just on an absolute tear. But I think everywhere you look, people are still excited about athleisure, apparel, the casualization of everything. And Nike, Lulu, others continue to benefit from that.
Like you said, it's best in class, right?
Yeah.
When you think of getting, I don't know, I don't play basketball, but a lot of people that do, they go and buy Nike basketball shoes, right? They go buy Jordans, and you're wearing a pair of Nikes right now. You're wearing some J's.
But I'm not going to be playing basketball in them.
Well, right, you're for more style. But what I'm saying is Nike is kind of just...
Yeah.
That's the whole point, though, the note is that you don't need to play basketball in shoes like that
Right.
anymore. So you can wear them all around. And you look at their sportswear apparel, which is increasingly less sportswear-y,
There you go.
growing at a double-digit rate for the last 5.5 years.
Those are some anchor shoes right there.
fresh
Yeah,
kicks.
there you go.
22 quarters, guys. 22 quarters
Right.
of double-digit growth when we look at that. So, I mean, that's
All-time
serious.
highs. I mean, the stock is just can't be stopped at
There you
this
go.
point.
It is basically, I think, back to where it was before it split, maybe 5 or 6 years ago. So that'd be a double in my book. All right, coming up here on the final round, the head of the American Vaping Association will join us to talk about why more regulation could push vapors back towards traditional cigarettes. We'll talk about that. But first, let's take a look at where some big tobacco stocks are trading right now with 40 minutes to go in the session. The CDC says that 26 people have died from vaping-related illnesses in 21 states, and we've got 1,299 lung injury cases associated with vaping that have been reported to the CDC. Joining us now is Greg Conley, the president of the American Vaping Association. So, Greg, the Journal reporting that Congress is launching an investigation into whether or not e-cig companies use bots to push products to the public. Now, you were quoted in that article saying that no one pays attention to these bots. So why are you so not concerned, I guess, about something lawmakers are now prepared to look into?
Because engagement is what matters with social media. If you're a bot with 53 followers and you've sent out 1,000 tweets over a 3-month period, you may not equal through those 1,000 tweets the engagement that one person with 10,000 followers will reach from just one single tweet. And so there have been bots, but they haven't been driving the conversation. And there are now thousands of real life vapors on social media that don't want to be portrayed as part of some Russian bot operation.
Greg, I think part of the tension right now between users, between the government, between some of these companies, is the fact that some of this advertising, in some specific company cases, appears to have been targeted at younger users, at teens. I think the advertising conversation around vaping right now is something that has particularly drawn the ire of lawmakers. And so while maybe the bots, in your view, don't really draw those kinds of eyeballs, certainly there appears to be a general displeasure, again, among lawmakers, among parents, most especially, I think, is driving this conversation with the advertising rules or practices of some companies in the vaping industry.
Sure. So by and large, marketing and advertising is low-hanging fruit. What we are concerned about, principally, is the ability of adults to access products that the Royal College of Physicians, Public Health England, and other public health experts have estimated to be at least 95% less harmful than smoking. I don't believe that any of the major companies in this space actually did intentionally market to youth, but you had a company like Juul that very clearly was targeting adult millennials. And you had inexperienced people that had no experience with tobacco and understanding how advertising has spillover. And that's what happened largely with Juul, is that they made a product that's great for adult smokers, but you have advertising to millennials, adult millennials, that ended up reaching teenage audiences, and teenage audiences discovering that with a high nicotine product, if you abuse it, you're able to get a head high. And that's the main problem that we have in the US at the moment, is teens misusing these high nicotine products that help adult smokers get off, but they're using it in order to generate a head high.
And I think a lot of the concerns there, too, is kind of around whether Juul or some of these other companies could have done more to kind of prevent what would have been the inevitable, because we know teens themselves, obviously cigarettes aren't being sold to teens. That was the way that it's been set up. Obviously teens still have access to cigarettes. But I want to shift, Greg, over to the health concerns as well, because bots and advertising is one thing, but increasingly as we open this segment, there are a lot of health concerns built around these things. The vaping industry in general has pointed to the fact that these products are thought to be much safer than cigarettes. A lot of people have pointed to studies saying that they're 95% safer than cigarettes because of the way that some of these carcinogens are measured in the human body. But we just had a professor on last week, the first study to link cancer to vaping in mice, and I think we're learning a lot more about some of these threats here. So how much of a concern on the vaping industry is there that there hasn't really been that regulation when it comes to health? In the way that some of these statements might not be so founded on the science as people continue to look into the health concerns around vaping?
Well, first, as people are concerned about health issues, it's very important people know that across the country, about 13% of patients that have given interviews to the CDC or state health departments are now only claiming to have used nicotine. The problem around this country that the CDC is increasingly pointing to are illicit THC cartridges sold by drug dealers. That is what is causing the vast majority of all of these illnesses and deaths. As for the cancer in mice study that came out last week, the carcinogen that they claim is causing that cancer in mice, that carcinogen has been measured in the body of real-life human vapors. And if it's present at all, it's present at levels that are comparable to what the user of a nicotine gum or patch gets exposed to. In other words, you're looking at total carcinogen exposure magnitudes less than with cigarette smoke. And we know from years and years of science that mice and rat studies actually only end up giving effects that are transferable to humans, maybe 10% of the time. So it's a mistake to really lend too much credence to rat and mice studies.
Well, that was the interesting piece from that NYU study, was the fact that it may have been the case that the way that was measured, the main finding was the way that it was measured in humans might not have been thought to be correct when you talk about the way that you're measuring carcinogens in humans, because the main finding was that some of those indicators might actually stay within the cell rather than coming out of the cell the way that it's measured in saliva and urine, that a lot in the vaping industry have pointed to as facts in terms of saying that they're safer than cigarettes. What if more studies point to the fact that maybe that was an inaccurate way of saying that e-cigs are 95% safer than cigarettes?
So here's the bottom line. In Sweden, they use a smoke-free tobacco product called snus. And Sweden has the highest usage of tobacco in all of Europe by far, but they have the lowest tobacco-related disease and death rate. Why is that? It's because people are using the smoke-free product, and it is conferring health risks about 98 to 99% less than smoking combustible cigarettes. So this idea that exposing people to nicotine in a smoke-free form is something brand new and uncharted, it's not. We know what the levels of these chemicals in the body, and if people want to take disagreement with the measurements, you can look at the long-term epidemiology showing that long-term nicotine use in Sweden is not killing people when it's disconnected from smoke. That's the key in there.
Yeah, and so Greg, something that kind of stands out to me here is we're citing, or you're citing, research done in Sweden, Public Health UK, their studies feature prominently on your website. What is the divergence, I guess, between what the European consensus at this point seems to be around the risks associated with vaping and the conversation here in the U.S.? Because I think over the summer, things really went from sort of background, some teens are vaping, I guess, sometimes, to basically a full-on hysteria in terms of the risks for young users and what's happening to smokers, vapors, I guess, specifically here in the U.S. Why is there that divergence still in your view? And I guess why has the conversation gotten so hostile towards your industry in the U.S. in such a brief period of time when it appears that, on a continent where things are fairly similar to the U.S., we basically do not have any of this going on in the public discourse?
Yeah, so right now we are clearly in the middle of a moral panic in America. And as we saw with past moral panics with marijuana and alcohol, good public policy and good health policy rarely flows out of moral panics. But the bottom line is that we're seeing both youth and adult smoking plummet in this country. We just saw about a 28% decline in high school smoking as the experimentation with these products, which we don't approve of, but nonetheless, experimentation with vaping products is denormalizing cigarette smoking rapidly. But one big difference between the EU and the US is that in the EU, there are nicotine limits on products. And nicotine limits create issues. If you're a 1 pack a day, 2 pack a day smoker, you may need a higher nicotine product to actually get off of cigarettes. But as I stated earlier, in the US, unlike the EU, teens have discovered and they're able to access these high nicotine products that they can get head highs off of. And that's what is leading to so much usage. That's why Juul, likely the National Youth Tobacco Survey for 2019, will show that 70–80% plus of youth are using Juul or Juul-like products, not the refillable flavored nicotine vaping products available principally at vape shops.
All right, Greg Conley, president of the American Vaping Association. Thanks for your time. Talk to you soon.
Thank you.
All right, Zach Guzman, thanks for the special guest appearance. We'll have to do this again.
Always fun,
soon.
man.
We'll see you tomorrow,
come
1
on
p.m. on Wi-Fi PM right here on Yahoo Finance. Coming up today right here on the final round, we will have more, plus Google's big hardware event tomorrow. We've got new phones, maybe a new Chromebook. Dan Halley will stop by to give us his predictions. But first, let's take a look where big tech is trading right now, 28 minutes to go in the session. I'm Miles Ludland here in New York. This is the final round on Yahoo Finance. Stocks not doing a whole lot here. We are in the red across the board. Investors doubting Friday's real trade deal, but of course, bond market closed, volumes low. We'll have more on all the action coming up in just a bit. Plus, Wells Fargo weighing in on the Beyond Meat trade. We will hear from the analyst in our final round call of the day. And Google's big hardware day is out tomorrow. Gadget guru Dan Halley stops by to give us his top predictions. Plus, WeWork is weighing rescue plans even as it keeps pushing aggressive growth with new locations. We have a full story for you later. But coming up now, we've got Yahoo Finance chief food correspondent Heidi Chung. We've also got 24 minutes to go in today's trading session. Let's take a quick look at the markets right now. All three majors lower, not doing a whole lot. The S&P, the biggest loser, down 11 basis points on the session. For more on today's market action, let's go to Scott Gamm. He's live on the floor of the New York Stock Exchange. Now, Scott, don't have a lot going on in the stock market. We do have oil prices lower in today's session. What's the story there?
That's right, Miles. And, oil prices rose 3% last week, and a good part of that gain came on Friday over the excitement with the potential trade deal between the U.S. and China. Well, today, oil prices are giving back a good portion of last week's gain, with West Texas Intermediate down about 2% right now, below $54 a barrel. So when we talk about the euphoria fading from Friday's trade optimism, that is, of course, more apparent in oil prices than with stock prices. Now, adding on to this, you have oil, which is very sensitive to trade negotiations, just because when it comes to trade negotiations, those are, of course, tied to the global growth outlook, and we know oil is tied to that as well. So all this kind of fits together. On top of that, you, of course, have geopolitical uncertainty in Syria along the Turkish border, so that is adding to some of the volatility we're seeing in the oil patch as well. But outside of oil, we're also keeping an eye on shares of Uber as we head into the closing bell today. The stock is up about 3.7% right now amid a report from our sister publication TechCrunch that the company is laying off 350 workers. That's about 1% of its total workforce, and this comes on top of some other layoff announcements that we saw from Uber over the past couple of months, totaling hundreds of workers. And we know that Uber's stock price is still trading significantly below where it was trading on its IPO day back on May 10th when the stock was above $40 a share, Miles.
All right, Scott Gamm, we will talk to you after the closing bell. All right, well, in less than 24 hours, Google is going to formally introduce the world to the Pixel 4 at a Made by Google event right here in New York. Yahoo Finance tech editor Dan Halley joins us for a preview. Halley, of course, nice for you. You don't have to travel across the country to cover a gadget release from a company. So I didn't realize that we were up to 4 pixels already. What do we know about this latest phone? And I guess maybe just kind of the dumb guy question here. Where does Google stand in the hardware space right now? Because as the way I see it, it's like Apple and Samsung and that's it. But are people still excited about the latest Google phones? Because they've always been good phones. I just don't know how big of an audience they have for them.
It is like that big. Their audience,
Oh,
that
very
big. And
sad.
then here's Samsung and here's iPhone. It's a small cult following almost, where people get super excited about these devices. It's really Google's way of saying this is the way you should make an Android phone to the other Android manufacturers out there, and laying out exactly how they want the Android operating system to be used. For these phones, we're expecting 2, the Pixel 4 and the Pixel 4 XL. One will be 5.7 inches for the screen. The other will be 6.3 inches. The big deal with these is that you're getting 2 cameras on the back instead of 1, which is something that Google's been lacking with for the Pixel 3. You now have 3 cameras on the new iPhone. You have 3 cameras on the Samsung phone. So with this, what they're going to do is either do a telephoto lens or ultra wide. The big deal with Google, though, is they are always doing amazing things with the software as far as their cameras go. They were the first ones to be like, hey, low light photos on smartphones right now, they're pretty terrible. Let's use some software magic. And they did that with the Pixel 3, and they blew everyone else away. And now that's why you see that kind of feature with the new iPhone. So we'll be really looking at what they're going to be doing there. They're also adding Face Unlock, which is essentially Face ID on the iPhone. So really big features there. And then we're also expecting a new Chromebook called the Chromebook Go, an update to the Google Pixel Buds, which are their in-ear AirPod competitor, and a new Google Home Mini. It'll be called the Nest Mini, because Google, of course, absorbed Nest, and now they're kind of going through the branding exercises.
Hallie, so when we take a look at Microsoft as well as Google, I recently went to the Microsoft Surface event, and it seems as if like these two companies aren't necessarily the biggest players in the hardware space, right?
Yeah.
So is this a play to sort of tie everything into their ecosystem to make sure that this is a device that people can use all of Google's or Microsoft's software in?
Yeah, and it's interesting because when you look at, Google's been working on its own phones for a while. Before they had the Pixel brand, they had the Nexus brand. So they've had Google phones for some time. With Microsoft, I think they're taking I want to say, more concerted effort in making sure that consumers are aware of those devices and really pushing them forward. I personally think that Microsoft Surface brand is some of the best computers you can get. If you look at the Surface Pro, I'd put that head-to-head against a MacBook any day of the week. So they're really great devices. As far as the Pixels go, they're excellent smartphones. The only issue is it's just never been as catchy as far as consumers go. They don't have that kind of cachet where you go, oh, it's a Samsung. Oh, so it's going to have the best tech. Or, oh, it's an iPhone, so it's got my iMessage. I don't have to be that weird green message person. So I think for
should be ostracized.
they will forever will be. So I think for the Pixel line, it's important for Google to push it forward. But with the Surface line, Microsoft is just killing it. I mean, it's great.
When is this event tomorrow?
Tomorrow at 10 a.m.
Oh, perfect. You'll be back in time for the final round?
Yeah, exactly. We'll see if I might have some gifts with me. Who knows?
All right, Dan Hallie, we'll see you back here right around 3:35 tomorrow afternoon. All right, coming up here on the final round today, portfolio manager George Young will join us to discuss why the U.S. economy is still strong. We'll also have his 3 top picks to capitalize on in the small to mid-cap space. We are back with all that right after this. Welcome back to the final round. Let's take a quick look at the markets right now. All 3 major indexes in the red. This is not the fault of editor-in-chief Andy Serwer, who does join us now. But Andy, we are at lows of the show.
Mr. Lows of the show.
That's right.
You're my new name.
That's right. Of course, this comes, you get the phase 1 deal on Friday. We had the report that's not really a thing. The market, of course, not really reacting today. Bond markets are closed, sort of a slow day on the street. But I feel like, we were discussing this earlier, we did all that talk yesterday and we got nothing out of it. Nothing to show. We're sort of back where we started.
Well, it's surprising, actually, that the market isn't down more. I mean, you could make the case that that was a whole lot of nothing, phase 1, out of how many phases people were asking over the weekend.
That's right.
The Chinese pushed back, over the weekend as well, saying, keep the champagne on ice, and now they want to negotiate further. nothing's been signed. So you guys, it's just very hard to sort of trade up on that. Although, if you subtract what we did on Friday from today from what we did on Friday, it's still a nice
fine.
bump.
Yeah, still
right?
fine.
Because the bias is towards higher still.
That's right.
And not towards, because if the bias was towards lower, we'd have a big sell-off today. But you're right, also it's sort of a quasi-holiday too.
Yeah,
so.
and then earnings season tomorrow. I mean, the roster of companies coming out with earnings tomorrow morning is quite formidable. We'll get to that in just a bit. I want to bring in George Young to talk a little bit more about what is going on in this market. He is the portfolio manager at the Villere Balance Fund. So, George, we're just talking about trade here. The market obviously reacting quite aggressively, I think, to trade over the last couple of weeks. Does it seem to you like this theme will continue as we head into earnings season, or might the market start to think a little bit less about each little development as it relates to trade, considering sort of the last week's developments?
Well, it's an interesting question, and I think what's going to happen is that if this is not the focus, let's say this gets resolved, there's going to be another short-term incident that occurs that's going to focus investors' attention. So I think it's much better for investors to think long-term. What are the best goals for them? There's a problem with short-term trading. One, there's taxes. Two, you always overguess yourself, second-guess yourself, and do the wrong thing. So I think long-term investing is the way to go, and that's what we focus on with our Villere funds.
Now, George, something in your note that does stand out to me, because this is a theme that I kind of kick around with my managing editor here at Yahoo Finance sometimes. We don't talk about too much on the show, is the notion that perhaps the market is really undervalued at like 17, 18 times earning. You look at what you're getting in bonds. You look at the multiple that really you could put those cash flows at, considering the composition of the S&P. Right now, does the market seem concerning to you, or do you see a lot of opportunities? And broadly, do stocks feel expensive at these levels to you?
Well, good question. Sensible thought is that PE ratios shift over time depending on where interest rates are. Because for the most part, investors have a choice of cash, bonds, or stock. Right now, we know cash, which is money market funds, is yielding about 1.5%. Coincidentally, that's about the same rate that you get on a 10-year government. You are locking in that yield. So if you're able to get something like 2% dividend yield from the S&P, that's pretty gratifying, because that dividend yield should increase over time, because dividends will increase based on the earnings power of a given stock. And as you just said, although the S&P is priced at something like a 17 PE multiple, that may seem high, but it pales in comparison to a 1.7% on the 10-year government. So that has to be kept in mind. That being said, we tend to be somewhat particular at the Villere funds about what stocks we buy. We look at stocks that can grow faster than their PE rate, and there's some that are out there. There are others out there where we decided there's too much, the valuation's a little too high, it's time to take some chips off the table. So although we think portfolios should be dynamic, you got to keep taxes in mind, because they'll hurt you long term.
Hey, George, it's Heidi here. So if we look back at the past 6 months, stocks have really been trading in a pretty tight range, and we haven't been able to break out to those all-time highs that we visited earlier this year. So in your opinion, what's going to take us there? We have about 20% of the S&P 500 reporting tomorrow, or this week, I should say. So do you think earnings could get us there? What is it going to take for the markets?
Yeah, I think earnings can get us there, but two things you've got to remember. One is that the U.S. consumer is in relatively good shape when you compare our economy to the rest of the world. And remember, something like 60% of our economy is based on what the consumer is going to do. So the consumer is feeling pretty good right now, has no problem using credit cards. That can cut both ways, I admit that. But the consumer is spending. And again, the valuations are thrown off a little bit because people have somehow forgotten about how bad the fourth quarter of last year was. So if you think about the returns in the stock market versus the bond market in the last year, the stock market is not that far ahead of itself. If anything, I would argue the bond market is ahead of itself. And people have to be very careful with bonds right now, because it doesn't take much for a bond you buy today to go down in value. And that's anathema to many bond traders. People haven't seen bonds go down in value in a long time.
George, we're very much on the same page here. Bonds scare the heck out of me, and I'm a PEG ratio guy too. I love that. So tell me what you're looking at in terms of price earnings to growth. What stocks kind of catch your eye?
Well, there are a couple things that are cheap, and they're cheap arguably for good reason. One thing we're attracted to is something called ON Semiconductor. ON is the symbol, and that's a play on 5G, and everybody knows 5G. You know, it's the one that's coming after 4G. That's simple enough. But what they've done is to make sure that they see more of their equipment in cars, for instance. So from their equipment being something like $500 worth in a given car, it's going to go up to $1,000 in the next couple of years. So interestingly, that stock, which is about $18 a share, we think they've got earnings power of $3, which math is simple enough. It looks like 6 times earnings a few years out. Meaning about 3 years out. So we think it can get there. They don't have a lot of debt. Here's the problem, however, the Chinese trade wars. A lot of their manufacturing is done in China, and that's a problem right now. So for that one reason, it's sort of in the penalty box right now. So I think a little bit of help with the Chinese tariffs, a little bit of help from earnings power. This is a stock that could easily double in the next year or two. That's a stock we love.
All right, George Young, portfolio manager at the Villere Balanced Fund. Thanks for your time. We'll talk to you soon.
Sure. Thank you.
All right, and coming up here on the final round, we'll have the closing bell on Wall Street. That's about 9 minutes away. But first, we'll break down all of the day's late trades. But first, let's take a look at where financials are trading. Big week of bank earnings coming up. Just looking at this, 3 of those names reporting earnings tomorrow. Welcome back to the final round here on Yahoo Finance. About 7 minutes ago in the session, let's take a look at where we stand right now. All 3 majors are in the red. The little change, the S&P is down 7 basis points. That is the biggest move of the day. So not a whole lot going on in the stock market today. But tomorrow night, of course, we have the latest Democratic presidential debate. And just today, some reports suggesting that former New York City Mayor Mike Bloomberg might look at getting in this race. Not the first time, of course, that Bloomberg has floated the idea of getting involved in a run for president. Andy, I know we have discussed offline, extensively kind of where this all stands as we get ever closer towards the next election. And you just made the point. This is the situation we have where Donald Trump versus potentially Elizabeth Warren or Bernie Sanders is what Bloomberg has been warning about now for 8-12 years. But is this going to be enough? Can he really fill that gap that I think has opened up for a lot of moderate voters?
Well, you're right, Miles. I mean, he's talked about this for at least the last 3 elections, presidential elections, sort of tantalizing and teasing people who might be interested in voting for him. But he's always said, and he said this in conversations to me, I need to be the centrist candidate, and they need to be people who are disliked and sort of radicalized on the left and right. Well, if in fact it is, to your point, Miles, Elizabeth Warren, for instance, versus Donald Trump, this is the dream scenario for him. On the other hand, he is now 77 years old, you guys.
Mm-hmm.
And as he said to me, I'm a short Jewish guy from Boston who's for gun control. So, there are things that may not play in certain parts of the country. Yeah. He is also, on the other hand,
Mm-hmm.
worth $50 billion. He's one of the 20 richest people on the planet. So he could just simply step in with $100 million and put himself out there. He has a lot of name recognition. So, he could get himself in the game very quickly, but the question is when and where, not as an independent, but as a Democrat challenging Elizabeth Warren. No love lost between Mike Bloomberg and Elizabeth Warren. He has criticized her vocally and very publicly at times. So this could get really interesting. I mean, the real key, Heidi, is if Joe Biden falters.
Right.
That's the whole thing.
According to the reports, he's looking to capitalize on Joe Biden's recent struggles, but the question is Bloomberg poised to take that spot?
Right.
I think is the main question.
Right. And interestingly, he's a year older than Biden. However, I'd have to say that he's probably a little bit more, shall we say, energetic than Biden is. And, he's older than Trump, but he's certainly got the wherewithal. And I think what's important to know about Mike Bloomberg is he's someone, though diminutive, who could stand up to Donald Trump.
Yeah.
I mean, he has the gravitas.
I think it's for any candidate, it's a big ask at this point to overcome the name recognition gap. And I know we all know him here in New York City, but just thinking broadly across the country, to go from, it's not 0 to 60, but it's like 4 miles an hour to 60 in some very important primary states, I think is a big ask at this point.
And what would the Democratic left do with Mike Bloomberg as the candidate, right?
Yeah.
I mean, we always talk about Trump's base being like, the really conservative voter, but on the Democratic side, clearly a big percentage of them are far left voters or left voters or, people who kind of would go to the polls for Warren or Sanders. Would they go to the polls for Mike Bloomberg or Joe Biden?
Yeah, well, we will find out time, of course. We'll tell Heidi Chung. Thanks for stopping by today. We'll see you tomorrow, I believe, here on the Final Round. Coming up today, we got the closing bell on Wall Street, plus our Final Round call of the day. It's Wells Fargo coming out with their latest on Beyond Meat. We will speak with the analyst right after the break. All right, welcome back to the Final Round here on Yahoo Finance. You were looking at live pictures from the New York Stock Exchange and the NASDAQ market site. Finishing up kind of a slow day here on the street. You were looking at none of the major averages moving. Let's see if I can read that. I think that's in excess of 14 basis points. Pretty low-key day here to start the week. Of course, it is a bank holiday here in the U.S. We did have the bond markets closed. We did have some negative news on trade. Andy, we were discussing just a few moments ago about, surprise. Perhaps the market isn't lower, but at the same time, we are finally moving into the meat of earnings season that we have been waiting for, I think, for some time. Now, tomorrow we have a number of banks reporting earnings. I think most interesting to me is probably Goldman Sachs, because maybe, just maybe, and I know they like to be buttoned up on their call and all that, but we'll get a sense of how the IPO market has perhaps hit some of the investment banking business across the street. Because it's been a lot of anecdata, I think, to this point, but will there actually be losses on the balance sheet of Goldman Sachs?
Right, there's that, and then of course the implications of China on Goldman as well, and on the other banks. And they were trading up today, counter to the market, up going into those reports. So you can see them right there, all these guys. And, of course, interest rates has everything to do with where they are. But, we're going to start to see some of these, really tough comps increasingly, Miles. And so, for these guys, what's the rate environment? What's the China trade doing to them? And what's the sort of, teetering economic activity doing to the business as well? The consumer business is good, so you might suggest that the ones with a large consumer exposure would be doing better. Right. But, those are just a number of themes to look at in these reports going forward.
Yeah, well, and, tomorrow we'll get Wells and JP, I think, will give us a sense on the consumer side. Yeah. Also, a couple names out tomorrow. Interactive Brokers and BlackRock, I think, kind of goes to another story we've been talking about, which is what is going on in the broker space recently. Where is that going? Because obviously charging for the trades isn't worth anything to these companies. And so now everyone is essentially an asset gatherer, and they're trying to make some sort of money on the spread. And it doesn't really matter what service you offer people.
Yeah, and I mean, okay, I understand that business now is officially a loss leader. It was a loss leader at $10, never mind zero. Yep. I mean, so that's fine. You're right. We're just gathering the dollars in. But, it all goes back to my favorite bugbear, which is, negative rates. And, just we're in an era of declining returns. And so I just feel like, Miles, the scenario is just not rosy for, say, a BlackRock, because the returns are going down, and the only way to try to mitigate that is by taking on more risk. Yeah. So you're damned that way, or you're damned this way. And I don't think that's a great story to tell shareholders. I mean, you can talk about the bigger, we're going from 6 trillion to 6.2 trillion, or whatever they're going to say in terms of BlackRock, but still, it's tough.
Yeah, I've heard some people make the case that if you look at sort of bank share price performance from, I call it like 85 until the crisis, that 25, 30-year period, that was like a big collective bubble. And that really, if you look at the economics of a bank or an asset manager, they shouldn't be making outsized returns, right? They lend some money and they get some money back, and there's a spread between that. But really, it's not this big, large enterprise that's, with 30% ROE or whatever these banks are turning in. That kind of whole phase was perhaps a mirage.
I don't disagree with that, except to say that perhaps the way to mitigate that would be through superior thinking and management. Sure. Because to your point, it's not a business that lends itself to differentiation. Yeah. It's inherently a very commoditized business. So, if you kind of believe in Jamie Dimon, and that's been a pretty good trade, then, but what surprised me about Jamie Dimon is I look at JPM, and I guess the difference is execution, because I don't see a whole lot of difference between JP Morgan and other institutions. I guess they just kind of do things a little bit better, and that's because of him. Yeah. But otherwise, it's not like, oh my God, they have these epiphanies and they're doing things so much better than everyone else. Yeah. I don't really see that.
Well, the one thing they didn't do is they didn't sign up customers for fake accounts. So they at least had that going for them.
Yeah, I mean, that's a lot of, you check a lot of those boxes and you win, right?
That's right, and we'll find out a lot of that information starting tomorrow morning. For more on today's market action, though, let's go to Scott Gamm. He is live on the floor of the New York Stock Exchange. Scott.
Hey there, Miles. Well, some modest losses for stocks across the board today. Still, stocks holding on to the bulk of the big gain we saw on Friday. And when you look under the hood within the Dow Jones Industrial Average, you do have the following names leading the way: 3M, Nike, and Goldman Sachs. Nike actually hit a record high earlier today. It was upgraded by Bank of America. Goldman Sachs was up today. You guys were just talking about bank earnings. Goldman Sachs reports earnings tomorrow morning, and I think Wall Street is looking for some updated commentary from these big bank CEOs on how they view not just the economy, but also the trade negotiations between the U.S. and China. When it comes to the laggards in today's session within the Dow, you're looking at names like Cisco, Procter & Gamble, and United Health. By the way, Apple shares hit a record high earlier today and then retreated from that level, ending the session slightly in the red. We should point out that Apple also hit a record high back on Friday. Apple is one of those trade-sensitive stocks. And then outside of the broader Dow, we are following shares of Uber, which ended the day sharply higher today, up about 3.3%. There was a report in our sister publication today, TechCrunch, that the company is laying off 350 workers. That's about 1% of its total workforce. That comes after other layoff reports from Uber over the past couple of months that also totaled hundreds of employees. And we know that Uber stock has suffered over the past couple of months since going public right here at the New York Stock Exchange back on May 10th. Miles.
All right, Scott Gamm, we will talk to you tomorrow. All right, a little bit of breaking news here. President Donald Trump announcing on Twitter that he is halting trade negotiations with Turkey, hiking tariffs on Turkish steel by up to 50%. Let's go to Jess Smith live in D.C. with the latest. Jess.
Yeah, the president just tweeted that he is authorizing sanctions against Turkey in response to Turkey's advance in Syria. Of course, this comes after President Trump cleared the way for Turkey to start this offensive with his decision to remove troops from northern Syria. This decision, it looks like he will put tariffs on Turkish steel going up to 50%. He's also stopping trade negotiations, as you mentioned, and he says he is fully prepared to, quote, swiftly destroy Turkey's economy if Turkish leaders continue down this dangerous and destructive path. Again, President Trump announcing sanctions on Turkey. As soon as we get more details about this, we'll be sure to let you know. But this is news we have been waiting for. We've seen bipartisan support for putting sanctions on Turkey, responding to this situation. And now we have word from the president, but we'll keep you updated as soon as we learn more details about it.
All right, Jess Smith live in D.C. with the latest. Andy, that's just another one of these things that the market feels like it takes in. You know, okay, there is a situation happening in the Middle East of our own making, but we are just going to, ours being the U.S., but the market is just going to ignore all that.
A little bit, but I'm still going to weigh in. I mean,
Absolutely.
You talked about own making. I mean, I call it an unforced error.
Right.
In other words, you have a negotiation.
Let's not be rude to own making.
No, right, exactly. Yeah. So you're the president of the United States. You have a negotiation with another head of state. You decide to do something together. You're doing this privately, so you figure this thing out, and then the guy goes and does something that you didn't like or you didn't want to, or you agreed to it, but now you don't like it. Yeah. It's all just completely crazy to me. I mean, in other words, if you guys are on the same page, then how come you have to do sanctions 10 days later? Right. I mean, or did that call? I mean, you know, it's the usual hall of mirrors from Washington, D.C. and the Trump White House.
Well, of course, this is why you have to have a State Department that's fully staffed, you know, at the very least,
right.
Because when you don't have anybody there to let you know what's going to happen, you know,
right.
sometimes this kind of stuff happens.
Hashtag oops.
Yeah, there you go. The fifth risk, as
right.
Michael Lewis might say.
Right.
All right, time now for our final round call of the day. Today we're talking about Wells Fargo's initiation of coverage on Beyond Meat. Senior analyst John Baumgartner began coverage with a market perform rating, $125 price target on the stock. And John joins us now to discuss. So you write that Beyond Meat is well positioned to grow in the alternative meat space, but we do, of course, have a number of new entrants in terms of competition for Beyond. What are you looking at here as you look at the next few years for Beyond and the space in general?
Well, I mean, this is definitely a new theme here in the industry. What we're seeing, plant-based has been with us for the past, 15, 20 years in the milk alternative market. What we're finding now is technology is improving, taste is improving. We're now seeing plant-based move into the mainstream in the meat space. And, we think it's going to be a generational theme. All of the survey work that we've done, it definitely is very, very on trend with millennials. There's a lot of concern about environmental degradation, health and wellness around, eating more plant-based. So we think this theme is here to stay for the next few years. But what's really not settled right now is the competitive environment, how it shakes out on the retail shelf.
I don't disagree with that. And, what happens when a Tyson or ConAgra really gets into this full bore? That's number one. Number two, how do you model a fad or the potential for something to be merely a fad, or that slice of it at least?
Well, we think with a lot of leeway, and that's not what the stock is really pricing in today. We don't think. We've seen a lot of I think, very bullish expectations, just essentially taking the 15% market share of milk held by plant-based beverages, moving that over to the meat market and saying, here we have it in 10 years, it's a $40 billion opportunity. And we have a lot of questions around that, because you think about some of the differences with plant-based beverages. There's a lactose intolerance issue that you don't really have in the meat space. You have substitution issues in meat where you figure, ground meat is half the market. What about the other half of the market? That's steaks, products, you need a structure to it that right now technology doesn't bring that into the plant-based space. So there should be a lot of leeway. I think the street gives this space, to grow, but expectations that it's not going to be a linear path projection going forward. You're going to have new entrants coming in, private label coming in, and we just don't see that in Beyond Meat's valuation today.
And John, something we talk about a lot here with regard to Beyond Meat and some of the other players is their opportunity to get into the restaurant space. But when you look at growth for these companies and ultimately growth that will lead to profitability, is it about having a strong foothold in the grocery aisle, or is it about getting into a restaurant? Some people are very excited about the Beyond McDonald's partnership that's happening in Canada and think that could be a growth driver. How do you see that shaking out for the company?
Well, we think the food service channel, prioritizing that, it's advisable in the sense that if you're doing that, looking to maximize distribution at the lowest possible cost, you go into a restaurant channel, they're going to shoulder some of that marketing burden for you. They're going to be influencers, spreading the message for you, and that should then kind of snowball into demand for the retail at grocery. So we think what Beyond's doing Impossible, it makes a lot of sense given the budget they're working on. But I think bigger picture, long term, you mentioned some of the other companies in the industry. Conagra, for them, Gardein is 5% of revenue. We're seeing Conagra, Maple Leaf dropping millions of dollars on building out capacity internally to make plant-based protein. So we think that they're going to be in this for the long haul. And the question is, if these companies who are not pure plays in plant-based meat want to get more aggressive on retail pricing to get that shelf space in retail, how do the pure plays really respond with a smaller budget?
All right, John Baumgartner is an analyst with Wells Fargo. Thanks so much for your time. We'll talk to you soon.
Thank you.
All right, coming up here on the final round, it's deal or no deal. We'll discuss what's next for U.S.-China trade negotiations. Are we going to get anything good out of it or just more of the same? David Dollar of the Brookings Institution will join us to discuss right after the break. All right, let's take a look at the sector winners and losers on today's session. Sectors in the red include consumer staples, XLP, down about 0.4%. Conagra, Kimberly-Clark, and McCormick weighing on the sector there. Also had utilities down about 0.6%, weighed down by Edison International, Alliant Energy, and CenterPoint Energy. Sectors in the green, only two of them today. XLF Financials up about 0.2%. Charles Schwab, KeyCorp, and Morgan Stanley among the leaders for the financials there. All right, well, President Trump announced a phase one deal with China last Friday. Then reports suggest that even this agreement remains in some sort of doubt. Joining us now to discuss where trade talks could go from here is David Dollar, a senior fellow at the John L. Thornton China Center at the Brookings Institution. So David, Bloomberg, again, reporting that Beijing wants another round of talks before signing the phase one deal that the president announced with so much enthusiasm on Friday. I guess, does this even phase one agreement, in your view, appear to be in jeopardy?
I don't think it's too much in jeopardy. It's natural the Chinese will want a meeting. What they agreed to last Friday were some general parameters. China would buy more agricultural products. The U.S. would hold off on the next round of tariffs, the next two rounds of tariffs probably. So I don't think it's odd that it takes a meeting to put it down in writing. The two presidents will both be in Chile for the APEC meeting in about 1 month. So it's natural to have a written agreement, have it signed by the presidents. But in a couple times, we've seen the U.S. and China pretty close to an agreement, and then it fell apart. So it's certainly a little bit of risk that this one will fall apart, but it's pretty simple. So hopefully they'll get it down on paper, and the two presidents will sign it.
Yeah, maybe too simple, maybe not enough meat on them bones. I want to ask you about that, but also want to ask you a question about the Chinese economy, David, and that is, how much do you think the trade war is really hurting the Chinese economy?
The trade war is definitely hurting the Chinese economy. It was already slowing down before the trade war started, so that complicates things for them. They have their own deleveraging campaign trying to reduce the high volume of credit in their system. So the trade war came at a bad time. Their most recent official number was 6.2% growth. I think their data probably overstates a little bit, but not too much. Trade war has maybe taken 0.5 percentage point off their growth, so that's not that important. I think it's a mistake for the U.S. to think that we have huge leverage, but still that's significant in the context of a slowing economy. You take 0.5 percentage point off, that's less income growth for people, that's fewer jobs, so they're definitely hurting.
All right, so then going back to that point that I wanted to raise, and I promised I'd ask you, so not a lot of there when it comes to this trade agreement, at least phase one. I don't know how many phases there are, but what's your take on that? I mean, is this really significant or meaningful?
I completely agree with your sentiment. I think it's not terribly meaningful. That's one reason why I'm optimistic that they'll be able to put it down on paper, because it's not exactly rocket science. The real issues that we took up with China are technology transfer, intellectual property rights protection, cyber theft, China's industrial policy. None of that is really going to be addressed. So I think it's clever for the administration to call it phase one, suggesting that all the tough issues will be taken up later. But there is a serious risk that we'll never get around to phase two. Chinese are not willing to completely change their system. We do not have that much leverage. So the question in the next few months will be, is the administration ready to compromise? Are they ready to take some marginal victories in the same way other administrations have gotten marginal victories? Or are they going to hold out, in which case these tariffs, these main tariffs, are going to stay in place? And then it's hard to imagine this mini deal surviving if you're not moving on to phase two. You could easily see one or the other side reneging on this deal within a few months. So I'm afraid business is still facing a lot of uncertainty, even if we put phase one on paper and sign it in about 1 month.
Well, and David, this makes me think about going forward, whether the Trump administration has a second act or not. It seems to me that there is kind of no going back to the U.S. and China trade relationship. And so, 5-6 years down the road, how do you think that this may have reshaped the global economy. It seems in some ways what President Trump has begun is not something that can kind of be put back together, right? You can't just glue the piggy bank back together after you've shattered it on the floor. And it seems that perhaps we're not yet reckoning here in the U.S. with the impacts of a less globalized supply chain that sort of seemed inevitable over the last couple of decades.
Yeah, I think there's no good outcome to this trade war from the U.S. point of view because China is gradually opening up and they're willing to make some changes. And most of our partners are satisfied with those changes. The Chinese are not going to completely change their system at the behest of the United States. So now we're in a position where either we back down, which would probably be smart, eventually declare some kind of phase two because the Chinese are making some opening moves. So you could come up with a phase two agreement. But there will be plenty of critics saying to the administration, you promised us you were going to get China to completely change, and that is, of course, going to fail. So it might be tempting then for the administration to just leave all of this protection in place, but that's a bad precedent for the world. It's a significant amount of import protection. It creates uncertainty for business. Right now it's China, but it means that any emerging market could be at risk. So it's going to have a chilling effect on investment. So I do think it's really permanently reshaping globalization to some extent.
And then just thinking about the U.S.-China relationship outside of trade, because we've got the entity list, there's certainly the Hong Kong situation, now we have the administration speaking out against the treatment of the Muslim minority in China. Does the trade relationship or the trade part of this, is that only a small slice of what is a rapidly evolving relationship between the U.S. and China?
Yeah, absolutely. And I would argue that a lot of these trade issues are not the most important issues we have with China. The trade balance, China's overall trade balance is close to zero, so they're not particularly a villain when it comes to global imbalances. If we're worried about our overall U.S. trade deficit, there are things we can do to fix that. So this is kind of a waste of time negotiating with China over some of these issues. Meanwhile, national security, that's a serious issue. Human rights, that's an issue I take seriously. So we might be putting too much energy into this commercial negotiation, which is really not that important for us when you've got other key issues that we have to deal with concerning China.
All right, David Dollar, Senior Fellow at the Brookings Institution. Thanks for your time. We'll talk to you soon. And coming up here on the final round, we'll have the look ahead. Plus, he's got some clarity now. Superstar DJ Zed is no longer welcome in China because of a tweet. I didn't think they had Twitter in China, but apparently it got him banned. We'll have that story right after the break. right, now let's take a look at some of the stories that'll be making headlines on Tuesday. Well, earnings season is finally here. The lineup for Tuesday is quite formidable. JP Morgan, Citigroup, Goldman Sachs, Wells Fargo, J&J, United Health, Interactive Brokers, BlackRock, BNY Mellon, and United Airlines are all among the companies expected to report results. The main industry in focus, obviously, is financial services. We'll get a sense, perhaps, of how the IPO market is hitting investment banking over at Goldman Sachs. We'll hear if the WeWork debacle is impacting the bottom line at JP Morgan, and we might find out what Interactive Brokers and BlackRock think of the whole free online stock trading thing. But with just 24 members of the S&P having reported results so far, what this week finally gives us is a strong sense of what the damage might be in the third quarter. Now, analysts at Bank of America think that earnings will drop 2% over last year in the third quarter. Consensus is looking for a 4% drop, but really, as always, it appears that the future is the biggest issue here. Now, the market is still looking for earnings to rise 10% in 2020. That's 4 percentage points above where B of A thinks that earnings growth will likely fall next year. And what's more, the firm notes that about half of earnings growth in the last 8 years has been attributable to corporate investment. And of course, softening CapEx this year has been viewed as a sign that the trade war is hitting the economy harder than official data are picking up. That's kind of the Brian Sozzi worldview there, all of which is to say we're entering a crucial earnings period with markets in a fragile place. Then again, it was the same story last quarter, and then the quarter before that, and the one before that, and so on, because just as every earnings period seems different and uniquely important, they are all more or less the same, which is to say they all matter quite a bit. Now, outside of earnings on the economic data side on Tuesday, we'll get the latest Empire State Manufacturing Survey from the New York Fed in an otherwise quiet day. All right, China, oh boy. I don't write these, Andy.
That's hard to say.
China is saying 9 to Zed. The German DJ and producer is now permanently banned from China after liking a tweet from South Park's Twitter account that celebrated the show's 300th episode. South Park, of course, recently attracted controversy for an episode called Banned in China, B-A-N-D, in China, which mocks the nation's strict censorship regime and the American companies that continue to do business there. Of course, Zed confirmed the news in a tweet on Friday. Fine, he's not going back to China. The best part about this whole South Park episode is it was essentially the exact same story as what happened with the NBA in China, but magically it came out before the NBA in China thing.
Right, yeah, it's kind of genius.
Matt and Trey at it again.
Right, and they made it to get the episode banned, which it was, and then the NBA debacle happened, and then they banned all of South Park.
That's right.
It was scrubbed from the Chinese market. This is actually kind of amazing, this little story here, because, wow, if that's the threshold to getting banned in China, I would be banned. And, I've gone to China numerous times as a professional, and if you went through all the things I've tweeted about China, some of them were critical. Some of them were critical at this level. And I think there's thousands of individuals and company Twitter streams that would rise to the level like, hey, that South Park episode was kind of funny.
But at the same point, you know that China's good at playing the game, and they know that banning a prominent member of the U.S. media is a much bigger deal than banning a German DJ. They're like, fine, we will. I
don't think I'm as popular as Zed is in China, though.
But
right?
I think that if let's say you got an email, right? Andy, sir, we're no longer allowed in China.
Right.
That would be a really big deal.
Yeah.
And I think that would go a lot of different places, even though, in fairness to you, Zed is much more popular.
Zed is more
popular. Zed has a lot more clout than you do, but I
know.
think that story would be compelling in a different kind of way.
Yeah, I don't know about compelling. It would be a different story, but I think that other journalists have been banned.
Yeah.
But everything is changing so fast right now that the ground's shifting beneath our feet, and so the rules that applied, even last week, literally last week, sort of no longer apply. Like right now, ask yourself, as someone who does business in China, would you like the South Park Twitter, a tweet put out by South Park?
Yeah.
If you are the CMO of the Boeing Company, of Procter & Gamble, of PepsiCo, of a Hollywood studio, would you dare, ESPN, would you dare like that?
Yeah.
Think about the chilling effect.
I'll say this, I believe LeBron James and the Lakers are happy that they got out of Dodge.
Right.
They played their games.
Yep.
And now they're done. Very
Right.
interested to see what happens next preseason and really for the rest of this NBA season and
kidding.
going forward. All right, coming up here, we'll have more on the final round. Plus, our top take today is WeWork weighing its various rescue plans, even as it keeps pushing aggressive growth with new locations. This, of course, is Zed to play us out.
Oh.
Welcome back to the final round here on Yahoo Finance. Miles London with you in New York. I'm joined by Yahoo Finance Editor-in-Chief Andy Serwer. Let's take a look at where the market settled on this Monday. Kind of a quiet session here. All majors were lower, but the biggest loss, the S&P off 14 basis points. Bond market closed here for a bank holiday in the U.S., so we'll see what happens tomorrow. Have a little bit more action. Of course, a rush of earnings in the morning, many of them from the financial sector. We'll kind of see if that moves the market on a macro basis. But let's turn now to our top take of the day. Today we are talking about the latest on WeWork. So we have SoftBank reportedly prepping a financial package that would essentially rescue the company for now, but give SoftBank more control over WeWork. They're already the largest outside shareholder. They control about 30% of the company. Another potential solution being reported would be a debt raise with JP looking at leading the charge there. So, Andy, I think what's amazing at this point is the company filed for its S1 about 8 weeks ago. I don't recall in the S1 a risk saying we could run out of money by Thanksgiving if the filing is not successful, but that is essentially what the latest reporting has suggested with We.
Yeah, and I mean, if this does turn into the ultimate stink bomb, will this be emblematic, the metaphor of the end of the top? And, I talked to Adena Friedman, the CEO of NASDAQ, at our All Market Summit last week and was sort of trying to press her on this. And of course, she didn't particularly want to go there, either in terms of, WeWork being a metaphor for being at the top of the IPO business and the problems that they have, or the fact that this was going to be very, very long in the tooth. But, we've talked about the behavior. We've talked about the multiple classes of stock. We've talked about the leverage. We've talked about the profitability. Yeah. We've talked about the hubris. And, and then we've talked about the fact that the model doesn't appear to be anything that can be particularly protected. Yeah. And man, that is a lot to add up, right?
Yeah, and I think, we constantly talk about it in our meeting where we say, all right, what are we going to do with the latest WeWork story of the day? And it's gotten to the point, frankly, where it's like sometimes you can say, oh, we could pass on that, right? But, this is essentially a number of different threads coming together and suggesting, more or less, can WeWork continue as a going concern? And then we're getting to the point of, well, what happens, right? I mean, did the owners of the building, which in some cases are Adam Neumann, but in some cases would be, whomever, whichever major CRE player in New York, did they just end up assuming these leases? Are companies going to end up finding their doors are locked one day? I mean, what really happens here? Because you see it in some of their UK, they're pulling back in the UK, they've pulled back in Ireland, they're selling or they're going to get rid of the school, they're selling the jet, they're really trying to, hunker down here, but is that going to involve closing some offices that are existing in major U.S. cities? And then what happens?
Right. And, then you wonder, right, like, what's the end game for this at this point? And, how, first of all, it's a good thing. It's not particularly systemic to anything, I don't think.
So it's not too big to fail, I suppose.
I guess, but everything is so, in this instance, I don't mean everything, which is the unicorn, so geared towards that, exit, right? And there's no, you kind of get to the point of the runway where you got to take the plane off. But what happens if you don't have enough thrust to clear the trees, which is sort of where we are right now. And what my point is that it's too bad that there's not an option. Well, we're going to really keep this thing private for another 2 years. Now, you may see that with Endeavor, right? And, it's not a coincidence you're maybe seeing these things at the same time, right?
But of course, I think the market probably looks at Silver Lake and says, okay,
those
guys have a plan here.
Right.
SoftBank might just be a patsy.
But it's interesting. I mean, they're sort of similar in a way. They're these big honking pools of capital that have this vested interest. Having said that, they were both very different. But there are parallels as well. So I don't know. I mean, these things get shut down. Well, on the other hand, the Miles Udland School will get a nice lift into the end of the year, and these things can just like take off and like, oh, they got over the tree line. I don't know where they're going from here, but at least they just took off.
I'm a nervous flyer. So
I know it's not a good metaphor.
So that metaphor,
okay, sorry.
I'm saying, every time the plane accelerates, all I think about is, just
hitting the trees.
Just please get the lift, right?
Okay, right.
Don't go into the water by LaGuardia.
Yeah.
All right, you know what? I suspect, Andy, that we will be discussing WeWork.
I bet we will.
At some point in the near future.
Yep.
Let's move on here. Let's talk about the consumer. Of course, consumer spending, pretty much the main point when looking at how the economy is doing, right? Consumers continue spending money. The economy in general will probably continue to grow. Refinitiv has released its Q3 consumer spending preview, and joining us now to discuss is Refinitiv's Director of Consumer Research, Jeroen Martis. So, Jeroen, University of Michigan Consumer Spending Report reads positively for the U.S. As you look at third quarter earnings here, what kind of trends are you guys expecting to show up in the numbers?
Well, the consumer is still engaged, and the strongest sector that we're expected to continue to see until the end of the year is the home improvement. For the third quarter, they're expected to see a 4.2% same-store sales growth. Now, just so you know, 3% reflects healthy consumer spending. So they are facing a difficult comparison from last year, and on top of that, they're expected to post stronger than last year, which right now in this climate, it's very unheard of. And with the Fed lowering interest rates, we can continue to expect seeing that sector continue to grow. On the other hand, we continue to see the apparel and the department stores struggling, and this might not be the end of it. Of course, with the Chinese tariffs and a lot of the apparel being produced abroad, the department stores also suffering by extension because they sell a lot of Ralph Lauren and Calvin Klein. And, that might not be the end of it. When you look at our Starman combined credit risk model, it shows that the department stores are the highest at risk of, with a high probability of filing for bankruptcy and of default. And if we are hit with higher prices later on in December, this actually might be the group that will be hit the first and the hardest. They just can't afford passing on higher costs onto the consumer. Macy's CEO last quarter even said the consumer has no appetite for paying higher prices.
Well, and I think what's interesting is I almost read the apparel retailers continuing to struggle as a positive sign, if only because that's a trade that's been in place for years now, right? We continue to hear the same secular trend of apparel retailers can't make it, but if overall spending is going to basically buoy the economy, then it seems to me that it's okay.
Well, it's more of a competition between who's doing well and who's doing bad. You know, the consumers are really rewarding those retailers that are able to give them a fast and efficient, very convenient way of shopping. And that's why over the past earnings seasons, we've been hearing the retailers being very vocal about spending a lot of money on their omni-channel presence and e-commerce, because they're doing everything they can to lure those shoppers into every channel, be it app, online, brick or mortar, and they're using that data to really study the consumer and manage them, and it's paying off. It's paying off at the Walmarts, it's paying off at the Target, especially at Target, who's done a really good job at not only, you know, trying to win over the millennials, but win over all the generations.
Right. What about restaurants and food? Because that's such a dynamic area, and we're just seeing a lot of these restaurants introducing all these crazy new sandwiches and stuff. Is this all working?
It's actually working very well. In fact, the restaurant sector is expected to do much stronger than last year. 3.3 same-store sales growth for the third quarter, on top of last year's 2.6%. So it's showing you that it continues to grow, especially the quick sector.
QSR.
Yes, and when you look at the ones who are doing the best, you know, the wellness movement has really pushed the consumer to like go to those restaurants that have bowls and salads, and one of them that benefits is Chipotle with a 9% same-store sales. So also underlining your point that the hotels and restaurant spending has gone up, which suggests that consumers are feeling good about taking their families out and spending money.
And then just thinking, you know, kind of the economic data point that I look at often, but often don't know what I'm like, how useful it is consumer confidence in general, right? We have a few different measures, number of different polls out there. As you look at consumer confidence, how does that tend to track alongside of same-store sales growth, kind of for the consumer names broadly?
Well, the consumer is a little bit concerned about all of the alarms going off regarding the recession, a possible recession, or even increasingly being more aware of paying higher prices come December. So, but having said that, the consumer saving rate is also at 8%, meaning they have a cushion in case things go bad. At least things won't be as bad as in 2010 recession. And the consumer is spending. Now, you mentioned how close it is to consumer spending. The one key performance indicator that has the strongest correlation with consumer spending is the unemployment number. And that just hit a 50-time low. So if the consumer feels that at any point in time their job will be jeopardized and they see that unemployment number, you know, really deteriorate, which they do understand that economic indicator, then they're going to put their hands in their pocket and hold back on spending.
All right, there you go. Jerome Martis with Refinitiv. Thanks for your time. Andy Serwer, editor-in-chief here at Yahoo Finance. Thanks for stopping by. Talk to you soon. And coming up here on the final round, we'll have what you missed today on Yahoo Finance on a busy day. We're back right after this. right, it's time now for all of the best moments that you missed today right here on Yahoo Finance.
The market's giving you the collective sigh again here of the classic, again, he said, she said, where the U.S. is touting a amazing phase one global trade deal. And China's saying, wait a second here, we will come to the table to negotiate, but there's nothing that has been inked.
I think that investors just need to determine how much real positiveness they need in the market to commit new funds to potentially drive the market to new highs going into the end of the year.
If you're at JP Morgan, why are you loaning this company money? By all intents and purposes, we dug into the S1. They may not be in business. It's that simple. They have not proven that this model works. I get why SoftBank is involved here. They have a lot of face to save because they have been completely embarrassed throughout this whole process. So I see them getting involved. But if you're at JP Morgan, why are you stepping up here with $5 billion?
We have to make sure that it's real first. We've been promised large sales to China more than once over the past 18 months, particularly this spring and March. When we supposedly had a deal and then it fell apart.
Something happens right before the C-suite and the corporate board, and we want to change that. And the way to do that is by implementing a rule that would force people to interview well-qualified candidates. They will get hired.
I do think that it's positive that Mnuchin has stated that all the things that were included in this negotiation were the things that the Chinese said they were ready to make compromises on. So, we could yet see a written agreement.
The U.S. consumer is in relatively good shape when you compare our economy to the rest of the world. And remember, something like 60% of our economy is based on what the consumer is going to do. So the consumer is feeling pretty good right now, has no problem using credit cards. That can cut both ways, I admit that. But the consumer is spending.
And coming up here on the final round, the head of the American Vaping Association says that more regulation in the space could push folks back towards traditional cigarettes. We will discuss all of that conversation coming up right after the break. The Wall Street Journal reports that Congress is launching an investigation into whether or not e-cigarette companies used bots to push products to the public. The president of the American Vaping Association, Greg Conley, joined us earlier today with his take on what this means for the vaping industry.
Because engagement is what matters with social media. If you're a bot with 53 followers and you've sent out 1,000 tweets over a 3-month period, you may not equal through those 1,000 tweets the engagement that one person with 10,000 followers will reach from just one single tweet. And so there have been bots, but they haven't been driving the conversation. And there are now thousands of real-life vapors on social media that don't want to be portrayed as part of some Russian bot operation.
Greg, I think part of the tension right now between users, between the government, between some of these companies, is the fact that some of this advertising, in some specific company cases, appears to have been targeted at younger users, at teens. I think the advertising conversation around vaping right now is something that has particularly drawn the ire of lawmakers. And so while maybe the bots, in your view, don't really draw those kinds of eyeballs, certainly there appears to be a general displeasure, again, among lawmakers, among parents, most especially, I think, is driving this conversation with the advertising rules or practices of some companies in the vaping industry.
Sure. So by and large, marketing and advertising is low-hanging fruit. What we are concerned about, principally, is the ability of adults to access products that the Royal College of Physicians, Public Health England, and other public health experts have estimated to be at least 95% less harmful than smoking. I don't believe that any of the major companies in this space actually did intentionally market to youth, but you had a company like Juul that very clearly was targeting adult millennials. And you had inexperienced people that had no experience with tobacco and understanding how advertising has spillover. And that's what happened largely with Juul, is that they made a product that's great for adult smokers, but you have advertising to millennials, adult millennials, that ended up reaching teenage audiences, and teenage audiences discovering that with a high nicotine product, if you abuse it, you're able to get a head high. And that's the main problem that we have in the US at the moment, is teens misusing these high nicotine products that help adult smokers get off, but they're using it in order to generate a head high.
I think a lot of the concerns there, too, is kind of around whether Juul or some of these other companies could have done more to kind of prevent what would have been the inevitable, because we know teens themselves, obviously cigarettes aren't being sold to teens. That was the way that it's been set up. Obviously, teens still have access to cigarettes. But I want to shift, Greg, over to the health concerns as well, because bots and advertising is one thing, but increasingly, as we open this segment, there are a lot of health concerns built around these things. The vaping industry in general has pointed to the fact that these products are thought to be much safer than cigarettes. A lot of people have pointed to studies saying that they're 95% safer than cigarettes because of the way that some of these carcinogens are measured in the human body. But we just had a professor on last week, the first study to link cancer to vaping in mice. And I think we're learning a lot more about some of these threats here. So how much of a concern on the vaping industry is there that there hasn't really been that regulation when it comes to health, in the way that some of these statements might not be so founded on the science as people continue to look into the health concerns around vaping?
Well, first, as people are concerned about health issues, it's very important people know that across the country, about 13% of patients that have given interviews to the CDC or state health departments are now only claiming to have used nicotine. The problem around this country that the CDC is increasingly pointing to are illicit THC cartridges sold by drug dealers. That is what is causing the vast majority of all of these illnesses and deaths. As for the cancer in mice study that came out last week, the carcinogen that they claim is causing that cancer in mice, that carcinogen has been measured in the body of real-life human vapors. And if it's present at all, it's present at levels that are comparable to what the user of a nicotine gum or patch gets exposed to. In other words, you're looking at total carcinogen exposure magnitudes less than with cigarette smoke. And we know from years and years of science that mice and rat studies actually only end up giving effects that are transferable to humans, maybe 10% of the time. So it's a mistake to really lend too much credence to rat and mice studies.
Well, that was the interesting piece from that NYU study, was the fact that it may have been the case that the way that that was measured, the main finding was the way that it was measured in humans might not have been thought to be correct when you talk about the way that you're measuring carcinogens in humans, because the main finding was that some of those indicators might actually stay within the cell rather than coming out of the cell the way that it's measured in saliva and urine, that a lot in the vaping industry have pointed to as facts in terms of saying that they're safer than cigarettes. What if more studies point to the fact that maybe that was an inaccurate way of saying that e-cigs are 95% safer than cigarettes?
So here's the bottom line. In Sweden, they use a smoke-free tobacco product called snus. And Sweden has the highest usage of tobacco in all of Europe by far, but they have the lowest tobacco-related disease and death rate. Why is that? It's because people are using the smoke-free product, and it is conferring health risks about 98 to 99% less than smoking combustible cigarettes. So this idea that exposing people to nicotine in a smoke-free form is something brand new and uncharted, it's not. We know what the levels of these chemicals in the body, and if people want to take disagreement with the measurements, you can look at the long-term epidemiology showing that long-term nicotine use in Sweden is not killing people when it's disconnected from smoke. That's the key in there.
Yeah, and so Greg, something that kind of stands out to me here is we're citing, or you're citing, research done in Sweden, Public Health UK, their studies feature prominently on your website. What is the divergence, I guess, between what the European consensus at this point seems to be around the risks associated with vaping and the conversation here in the U.S.? Because I think over the summer, things really went from sort of background, some teens are vaping, I guess, sometimes, to basically a full-on hysteria in terms of the risks for young users and what's happening to smokers, vapors, I guess, specifically here in the U.S. Why is there that divergence still in your view? And I guess why has the conversation gotten so hostile towards your industry in the U.S. in such a brief period of time when it appears that, on a continent where things are fairly similar to the U.S., we basically do not have any of this going on in the public discourse?
Yeah, so right now we are clearly in the middle of a moral panic in America. And as we saw with past moral panics with marijuana and alcohol, good public policy and good health policy rarely flows out of moral panics. But the bottom line is that we're seeing both youth and adult smoking plummet in this country. We just saw about a 28% decline in high school smoking as the experimentation with these products, which we don't approve of, but nonetheless, experimentation with vaping products is denormalizing cigarette smoking rapidly. But one big difference between the EU and the US is that in the EU, there are nicotine limits on products. And nicotine limits create issues. If you're a 1-pack-a-day, 2-pack-a-day smoker, you may need a higher nicotine product to actually get off of cigarettes. But as I stated earlier, in the US, unlike the EU, teens have discovered and they're able to access these high nicotine products that they can get head highs off of. And that's what is leading to so much usage. That's why Juul, likely the National Youth Tobacco Survey for 2019, will show that 70-80% plus of youth are using Juul or Juul-like products, not the refillable flavored nicotine vaping products available principally at vape shops.
And that was Greg Conley, president of the American Vaping Association. So let's take a final look at where the market's settled on this Monday. Kind of a weird day here in the U.S. Bank holiday, bond markets closed. A lot of kids not in school, but the stock market was open. As you see, all three majors finished lower, but not a whole lot going on. 14 basis points, the decline on the S&P. That was the biggest decline of the three majors. Tomorrow, earnings season gets underway. JP Morgan, Goldman, Wells, Citi, among others, all reporting before the bell. We'll have the numbers for you live right here on Yahoo Finance. That's all for now from New York. I'm Miles Ubben. This has been the final round on Yahoo Finance.